Okay, the other side of the ledger is that it looks like earnings revisions in the PMI strength for the world indexes is maybe ebbing, maybe cooling somewhat. Jeff, is that a bad thing, or does it mean that it will keep central banks from pressing the brakes too hard? How do we view this last chart here that does see a little bit of rollover the last couple months?
Yeah, no doubt about it. So this is a chart you're referring to of the Global Purchasing Managers Index, survey of business leaders and their outlook. And it's done a really good job historically of predicting where analysts are going to move their estimates 3 months from now. So it kind of leads the analysts, which of course leads the actual earnings numbers. And that's why I like to take a look at it. And you're right, it's hooking over, but that's no surprise to see earnings growth slow after a blockbuster year last year. The key to me is that this number at 53, what you'll notice is 50 on the PMI lines up with 0% earnings growth, right? So anything above 50 means growth over the next, year or so. So as analysts look out over the next 12 months, we're still seeing an environment of earnings growth, and that's encouraging. Now, it's probably single-digit growth relative to what we've been used to over the last year of double digits, but that's still a positive outlook, I think, in that investors are genuinely concerned about a dramatic slowdown in growth and the potential for recession. What this is telling us is that not yet, the outlook for earnings still remains positive, and that's a plus. Again, single digits, not double digits, but though it's hooking down, it's still in positive territory. And again, sort of adding to my trifecta of maybe a positive take on the market today.
All right. Jeff, great stuff. Really great context for us. Appreciate the yield curve analysis in particular. A nice way to look at it. All right. Have a great day, Mr. K. Thanks a lot.
Thanks. You do the same. Talk to you soon.
Okay. Jeff's the Chief Global Investment Strategist, Charles Schwab. Yield curves, not curve. And a much less alarming way to look at it. Okay. When we come back, stock talk. Russell turns positive, and Carnival Cruise says that they've got more people on the boats than ever.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Stocks opening mixed right now. The small caps have turned positive. NASDAQ down a little bit here, even though we've got some big moves in the social media space again. Twitter is up 7% right now to $55, $54. Elon Musk will be joining the board. Tweets from Parag Agrawal, the CEO who took over after Jack Dorsey. Also a tweet out from Jack talking about how they've been in discussions. They're excited to have Elon on the board. Took a 9% stake. And stock loves it. We got Sean Cruz joining me here in studio, our contributor on the TD Ameritrade Network. All right, Cruiser. So Elon, I guess when you're worth $250 billion, you just do whatever you want. Buy a company, they invite you into the door. Trojan horse or a change that they really wanted. I mean, I guess, do they have much of an option? You can buy the shares, which he did, and then from there, I guess they only have a choice to either fight, push back, or welcome him in. And we know Jack and Elon kind of cut from the same cloth in some ways. They both have been pretty communicative about their friendship in the past, et cetera. So what do you think? I mean, is this all in goodwill, or is there major disruption coming?
I think it could be actually in the long run end up being good for Twitter. If you think about it, what is it? Only like 5%, 10% of the U.S. population's even on Twitter. I would say the bulk of the conversation on Twitter is just a bunch of blue checks who probably already have side threads talking amongst themselves.
I got a blue check. Actually, no, I don't anymore. I lost it. I lost my blue check.
Well,
I got too bearish. They took it away from me.
there you go. Well, you stay bearish on Tesla, they might not give it back to you now.
Yeah.
But yeah, I mean, I think it's actually a good opportunity to bring a lot more people and turn Twitter into a place that isn't just a bunch of blue checks tweeting at each other. I think it could actually be interesting if it drives engagement from a more broad base.
Okay, so is he going to bring over the Truth Social, who the people who are on the Truth Social app and bring them in?
I mean,
they're going to bring Trump back? I mean,
I'll see what they do, but I think if that's what this ends up driving towards is maybe opening up Twitter a little bit more. Yeah, it's definitely going to be controversial.
Right.
There's going to be some people who are happy with it, people who are not happy with it. But I think in the long run, Elon Musk is visionary. He definitely understands tech.
And his stock is doing a lot better than Twitter. Okay, maybe not. Yeah. I mean, hey, Block too. Keep in mind, Jack Dorsey's other project had a big sell-off as well. As all these tech-forward businesses have unwound over the last several months, Tesla has remained extremely strong, just below the highs. So, I mean, obviously, social media is not cars, but at the same time, his track record is just technically a little bit better, right?
It is, and I think if you look at Tesla and how they're doing in the electric vehicle space, I think it's interesting that Tesla just seems to, no matter what, every time you start to think one of the automakers, GM is a good example, is really making headways into the electric vehicle space, you start to get the delivery numbers and some of the actual sales numbers, and you still see Tesla as just far and above, a little bit of a separate space from. There's a lot of a distance there, just in terms of performance and their ability to execute. Tesla is, we had the IMX for TD Ameritrade out yesterday. Tesla was a popular name as a net buy once again over the month. And I think it sort of bared out when we started to get the vehicle sales numbers out yesterday.
Okay. All right. So maybe Elon will bring some excitement to a stock that has been very disappointing over the last year for investors. And prior to that, too, I mean, Twitter did pretty good during the pandemic bubble for the market. But prior to that, it wasn't a terribly rewarding stock either. And they couldn't figure out the profitability side of it either. Twitter had peaked in 2014.
Well, that's why bringing more people, that's why I said if this ends up drawing more people in than just, all the blue checks. Yeah. If you get a bigger base in there, and that's why I say it could be very good for not just the platform in and of itself,
I agree,
but also the company, because that actually makes them a more valuable ad targeting marketplace where they can now start maybe getting a little bit more ad revenue coming in the door. Yeah. I think that could be the actual stock value case for Twitter, but you're going to want to see what changes.
I agree.
If that brings more people in.
A true unfettered town hall in a way that I do think the company can still make strides to. Obviously, he's already having fun with this, talking about the edit button. I mean, in my opinion, look, I tweet a lot. I don't really care about an edit button. I found it more kind of disingenuous, and I think it was negative for the stock when, in the same breath of banning the president, Jack Dorsey put in a plug for Bitcoin. That to me was like the straw that broke the back for me and kind of trusting Jack as a leader. Frankly, it didn't seem like it had any role. He was, I think, very preoccupied by that stuff. And in finance Twitter, there's total just crypto corruption. You can't even make a tweet about Bitcoin without spam. There's fake accounts. It just seems like the problem that many people, at least in my circles, have tweeted about and talked about. He never did anything to change. So people were sick of a lot of that spam stuff. People were sick of the fake accounts. And so at least Elon is very in touch. He seems more in touch with the user base than the current CEO. I mean, Parag has only tweeted like twice since he became CEO. It's kind of a weird thing for the CEO of Twitter to not tweet.
Yeah.
You know, I mean, Jack was fairly prolific in his latter years, and Elon uses it all the time. All right, so we'll see if he uses it for good. Hopefully he doesn't just use it to pump Dogecoin, or else this is going to the simulation is going to get exhausting. All right, let's talk about a few other things. Speaking of Jack's other projects, PayPal and Square, let's hit that just real quick. Wells Fargo comes out and says buy, but the price targets are not too lofty for PayPal, $30 above where we're trading right now, 165 for Block. So the analyst is saying that these stocks are okay to own, but they don't have very far to go. What do you think?
Yeah, I mean, I think some of these stocks have really been beat up recently, and it was a little bit counterintuitive. At first, they were doing really well. They were surging higher because all of the online buying was actually good for them. Some of the people moving away from cash, small businesses having to, find ways to take payments. It was a good space to be in, but they really just started getting beat up over the course of the past year. And it's one of those things when you start to see stocks like Square or even PayPal, I mean, just take it on the chin the way they have. Think about, Block at one point was up at 280, got down to just above $80. It's a $200 drop in the $200 drop in the share price in less than a year, which is to me is pretty breathtaking when you think about it. So you knew at some point, though, along the way, that there was going to be some sort of a bottom where, okay, this is where buyers at least see some sort of a value case coming in here. And it looks like that happened right around that $100 price level was where you finally saw that selling pressure moderate. You got a little bit of a base going, and now analysts are coming in, taking another look at this and saying, look, the bloodshed is over. In this name, there's actually maybe some tailwinds coming up here.
Right, but who goes
a case to own?
Who goes for Block to get $20? I mean, you know what I mean? That's not a big lofty price goal. I've noticed that with analysts cutting the targets. It seems to me that any price target for traders in these high growth companies below the previous high is not going to be something that really draws them in when they're used to just printing gains in these companies. I mean, bullish for 165. I get that the analyst is being true to their analysis, which is, I'm not, arguing that. What I'm saying is that for traders, are they going to get that psyched up? I mean, it doesn't look like it. Block's actually down this morning 2%.
It is, and it looks like there's some other news, unfortunately, that came out alongside this, where they were, saying that there was, a breach. And anytime you have to say,
Cash App breach, a former employee accessed U.S. customer data.
Yeah. So, and anytime they say we don't see material impact from the incident, that means there's potentially something there.
Right.
So I think that's certainly going to be a tough hill to try and battle back from when the market's still trying to decide if they want to use, this is an opportunity to come in and find some upside here. But I think once they get away from this, we get a little bit more comfortable. That $165 price target that Wells Fargo put out there, I mean, that's something that might draw some people in there, at least as a little bit more of a speculative type of a trade. But if nothing else, I think looking at some of the price action you've seen and seeing, that $100, $110 level be some sort of an area where you start to get a little bit of a firming up in shares and a little bit of a support level, that just having a defined support level and you're not too far off of that, sometimes that'll at least bring some speculative buyers in.
Okay, so we established some support and the strength in these growth names over the last couple of weeks. All right, by the way, there's a Twitter downgrade from MKM saying it's now neutral, no longer a buy, price target $49. So they're basically saying that their bull case for the price has been realized and jumping ship. Nothing too fancy in this analysis.
No, and I think if you're someone who's buying this because you think Elon Musk's going to bring in a lot more users, it's going to make it more valuable as a place for ad placement, which will drive more revenue, that's going to take a little bit of time to turn around. So I don't think this is just going to overnight, Elon Musk is on the board, everyone's going to come flooding in. There's going to be a little bit where you're going to have to see if that actually does play out. And I think those daily active users, those user numbers are going to be very, very important once you start seeing some changes implemented to the extent that there are going to be any. We still don't really know what that is. An edit button isn't going to turn this ship around. It's going to have to be quite a few things.
People are really obsessed with the edit button. Delete the tweet, redo it. If you made a mistake, who cares? I don't get the obsession with the edit button. If you want to make it, I guess give it a couple of minutes, let it be edited. But people freak out about the edit button. All right, let's take a look at Carnival. This is probably the most interesting fundamental update for the day. More bookings than ever. I mean, is this a typo? Is there a need for an edit button here? Is that the real headline? I mean, that's pretty amazing stuff.
Yeah, and I think it's certainly a step in the direction you want to see.
Late yesterday, they told us this.
They did, and they actually, I think, have all but one of their ships back in service and out there operating, and that last ship expected, I think, to make its return voyage May 2nd. So they're going to have the full fleet there. And when you get years like we've had for this industry, the past 2 years, the one thing that I think it is worth noting for a lot of these troubled industries, they tighten things up and become incredibly efficient. Almost they have to. It's sort of the key to survival there. So they tighten things up, become incredibly efficient. And so now when things do snap back, they're probably going to have some incredible profitability. They're going to scale really well. So those incremental passengers that they're bringing on are probably going to drive more to the bottom line than we had previously expected. I think the next thing is going to be one that return to full-on profitability, before you get into depreciation and everything else like that. So profitability return, cash flow is going to be key. And then we're going to start looking to see when can we expect dividends, share buybacks. Those are going to be the things that investors are going to say, okay, look, you're getting everyone back in there.
Right.
You've optimized your fleet.
And can they do that right now? Just share buybacks and dividends? I mean, aren't they supposed to figure out how they're going to make the new model work with the testing and the higher costs for them to maintain employees?
I wouldn't expect to see that until later this year at the earliest.
Okay, so you're saying that'll kind of be a health check that says, all right, worst definitely passed if the management is able to do that. I
think you're going to want to look and see. I mean, and last week they said it was a record week, busiest booking week they've had in the company's history. But I think it was double-digit increases over the previous record. Mm-hmm. So a lot of people are finally comfortable getting back out there. So you're going to want to watch and see how, just the general cash flow profitability situation improves over the coming quarters. But once they get there, and you're asking yourself, well, is this sustainable, or is this just a big bounce back, and then we're going to maybe see profitability or cash flow moderate once again? When they go out there and start talking about share buybacks and especially dividends, that's usually a very good signal to the market from these companies that we are comfortable with our cash flow situation moving forward. So I would watch for continued booking strength, see how that shows up in the company numbers in terms of cash flow, and then the next thing to keep an eye on after that will be the return of capital to shareholders, be it buybacks or dividends.
They're not going to get a pass on the next earnings anymore. That's, not that they did. Well, they rallied on the last report. In fact, they rallied on the one before that, too. The stock ultimately faded down, but both earnings events in the last 6 months led to positive price action short term. Now, they faded every time. And we are right in line with the downtrend here, where you could fade and be perfectly in line with this downtrend. So it's a very interesting moment here for Carnival to see if these bookings can break it out of this downtrend. If it gets above that February high, really big deal for this stock chart. But I do think that now that they've got a biggest week of bookings ever, that means it's going to have to show up on the bottom line.
It will.
That's the revenue. And then how much does it, make its way to the bottom line for the next quarter? They're not going to get as easy of a pass. That's my 2 cents.
But if you look at any of the cruise liners, and you can look at Royal Caribbean Group, you could look at Norwegian Cruise Lines, they're all going to probably have a very similar path to recovery.
Sure. Yeah. Okay. All right. You cruising, Sean?
I don't take cruises.
Okay. Yeah. Me neither. Maybe. I don't know. I've been on a cruise ship for a report.
I've never done it.
Yeah. Me neither.
So.
All right. Maybe
I'll do it and I'll love it.
Sounds like they're pretty popular.
Yeah.
Okay, me and Cruiser are going to figure out which cruise to do. Hey, cruising with the Cruiser.
It's not. Well, that will never be a segment.
Okay. All right. All right. When we come back, nice work, Sean Cruz. Let's talk some defense stocks, not defensive, defense, like missiles and GPS and drones. Companies that had a huge run that is holding on over the last few weeks. Some of the defense companies not at their highs when Russia first invaded Ukraine, but stocks are still looking pretty good right now. Let's talk about them next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm Jenny Horn. Here's a few more of this morning's movers to kick off the trading day. Morgan Stanley reiterated its overweight rating on Apple and said it sees App Store growth accelerating into the rest of 2022. The firm said this would help to dispel the bearish concern of a more permanent rather than temporary COVID year-over-year comp-driven slowdown in App Store revenue growth. Mizuho reiterated its neutral rating on Coinbase while also lowering its price target to $190 a share from $220. The analyst said they are concerned about costs associated with launching a digital assets non-fungible tokens. They are estimating Coinbase may spend up to $300 million in 2022 on NFTs, contributing to an overall 130% increase in operating expenses year over year. And General Motors and Honda announced developing a series of affordable electric vehicles based on a new global architecture that will start at roughly $30,000 per unit. The new partnership is anticipated to strengthen the ties between the two companies regarding all-electric and autonomous vehicles. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Defense stocks and missile makers soared at the beginning of this year, and they're hanging out near the highs, but some of them haven't quite broken back out as some of the cooling from escalations in Ukraine. But over the weekend and over the last 48 hours, more reports of major casualties from Ukraine and some intense stories obviously have us thinking about the events still very much. Colin Scarola joins us from CFRA, Vice President, Equity Analyst. Colin, welcome back to the show. A lot of times we talk about airlines, but industrials also include the missile makers and defense stocks that you cover too. Are these companies waiting for incremental developments in the situation? What's going on as far as the price action in these companies the last few weeks?
Hi, Oliver. Thank you for having me. So, as you mentioned, it's been a very strong start to the year for the defense industry stocks. Call it roughly 20% year to date for some of the big guys like Northrop Grumman, General Dynamics, L3Harris, Lockheed Martin, kind of around that high teens, low 20s returns, obviously doing much better than the market overall this year. And a big part of that was even before the Ukraine war got started, as sort of the reality of higher defense spending being a strong bipartisan support issue was settling in, as opposed to last year. A lot of these stocks were on sale because the thinking was that a Democratic sweep in the federal government would lead to lower defense spending. We didn't buy that. We had a lot of these stocks at buy and strong buy last year, but we took some chips off the table as we got through this run up in Q1. We're down to just Raytheon and Lockheed Martin because we think you still want to be careful with these stocks because it's going to be really hard for the government to grow defense spending ahead of inflation as high as it is. And most of these companies have at least 50% of their revenue coming on fixed price contract. So inflation is a really important headwind for a company that has those fixed price contracts. You can't up your prices in real time like a lot of other businesses can. So we don't want to own these stocks at a premium given that risk. So the last ones that we think are still pretty attractive valuation wise are Lockheed and Raytheon.
So Lockheed, Raytheon, the charts, I mean, look pretty similar right now, but both are sitting just below those recent highs. Earnings are coming around the corner. Do you expect them to give specific guidance related to what's happening in Eastern Europe, or is this still a domestic spending story primarily?
Well, I think, given how sensitive this sort of arms dealing is, either U.S. giving arms to NATO and then those NATO countries giving them to Ukraine, or the U.S. directly bringing arms into Ukraine, that's a pretty sensitive issue that I don't think the administration or Congress wants private companies broadcasting what's going on there. I don't expect to get too much information on that.
Okay, so
I do think that
they're basically just going to say revenue from the government, and we'll connect the dots, right?
Right. So I think you'll probably see guidance go higher for a lot of these companies, because we were writing about this last year. They were setting their 2022 guidance on a pretty conservative President Biden budget request that came out in the first half of 2021, calling for about 2% growth in the defense budget this year. It actually landed at about 5.5% growth, more like 6% if you include the special Ukraine bill. And we're going to see another big increase this year going into 2023, because you tend to see both sides really pump up defense spending in a midterm election year. So we'll probably see a nice increase in the earnings guidance from these companies coming up on the Q1 releases, but probably not any specifics around how much sales are related to arms sales, but specifically to Ukraine. But one thing we think is interesting is the last stocks that we think are attractively valued here, among the big defense names, Raytheon and Lockheed, we've still got at Lockheed at buy, Raytheon at strong buy. We actually think those companies, they're the cheapest, and yet they're also the ones who are going to have the most benefit from what's going on in Ukraine. These are the companies that make and sell the Stinger missiles that you hear about, the Javelin missiles, and not just for these arms that are being used in high quantities right now, but as NATO allies and our allies in the Pacific, they start to see that they really need to beef up missile defense as a result of this Russian aggression. You probably see a really nice boost to orders for things like PAC-3 missile systems from Lockheed. So we think these two stocks are probably the biggest beneficiaries of what's happened in the last 2 months, and yet they're still attractively valued. So we just definitely like to stay in there with buys and strong buys.
Okay, all right, we're going to trade it in line. Colin, thanks for the thought here. And bullish on Lockheed and Raytheon. We're going to get trades ready for that. Colin Scarola joining us from CFRA. All right, Tom, standing by. Mr. White, welcome back. Okay, Lockheed Martin, bullish. Both these shares right below their highs, but you've got two slightly different approaches you're going to take for those with different risk tolerances. The first one is a little bit more bullish in Lockheed. How do you structure that?
Well, you've got to realize they've got earnings coming up, so that's going to be an event risk, but just going out probably in duration. He mentioned the inflationary pressures that they might have on some of the products and natural resources that they use to build a lot of their products. So going out to the June monthly cycle, so about 73 days till expiration. So giving myself plenty of time. We might see some added volatility going into that earnings event. Shares are still up about 25-26%. so far this year. That all-time high of $480 may become resistance in the near term. So I kind of structured it around there, where I'm going to buy the June 445 strike call and then sell the 480 strike call against it. There's still quite a bit of option premium out in there, and I can, contract the price of what I'm paying for a bullish stance on this by selling that 480 call against the 445 call. It's $35 wide. On this call vertical. If you pay roughly about a $13.50 debit, it's probably trading closer to $15 right now. Stock is moving higher. But if you pay $13.50, that's going to be your risk, right? $1,350 per spread. that spread can expand to $35 if it goes back to those all-time highs that we saw last month. If I pay 13.5, my break even 458.50 over the next 73 days. So really good risk reward setup on this one if you think that LMT over the next 2.5 months is going to continue to move higher.
Okay. All right. 480 call, 445, buying and selling. Calling vertical, looking for some upside. What about Raytheon? You selling downside instead?
Yeah, you know, maybe a pay to wait thing. They have earnings at the end of April also, so might see some added volatility there. All-time highs just above $104 a share. So with a 2% dividend yield and maybe some added volatility going into that earnings event, I looked at a covered call strategy where I get paid to wait on this stock if it does not go higher, if it does, kind of consolidates here around $100 a share. So for every 100 shares of stock you buy in RTX, you sell a May 105 strike call just above those all-time highs. That reduces the price of your long stock position. If you pay roughly a debit of $98.75 for that, that's going to be your break-even point on this covered call position. You get to collect that 2% dividend yield. You've got 45 days until expiration, and then you can add or sell another call against your long stock. So for every 100 shares of stock that you buy in Raytheon, you can sell a upside out of the money call against that to reduce your exposure on that. And as you continue to sell calls against your long stock, you're still collecting that dividend because you own the shares, but then you also get to collect option premium on the calls that you sell on that. So this might be the way to play it going into that earnings event over the next month, where I can get paid to wait on a bullish strategy.
Okay. All right. Paid to wait or buy to gain. Two different ways to get bullish on two stocks near the highs ahead of some earnings. Thanks, Tom. All right. The defense trade still looking pretty good. Raytheon and Lockheed, the favorites from Colin at CFRA coming up. Stocks and pizza. DPZ, the morning trade. It's food, but it's also tech. Don't forget, only problem is it hasn't been working all year. Domino's literally peaked day one of trading in 2022 at an all-time high, and it hasn't taken part in the bounce back. What's going on? We'll take a look at a price target cut on the stock from an analyst and trade it when we come back.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes away.
Wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
welcome back to Morning Trade Live. We are in hour 2 of the show here, 30 minutes into trading, and markets are a bit mixed. We just looked at defense stocks sitting strong near highs. Dow is doing a little bit better today than the broad market. S&P's okay too, so you don't have tech leadership. You've got a little bit more of that either defense or defensive strength, but I think welcome after transports got blasted last week. So we'll see where it goes and if there's any real follow through. This morning so far has been a little bit of chop. Russell was leading out earlier and it faded too. So not a lot of conviction in today's trade. We're going to take a look at some data here. We got PMIs and ISM to look at in a sec. We're going to talk Domino's Pizza. As the market's bounced back and tech names have rallied, Domino's is still down in the dumps. Literally peaked at the high as we started 2022. So perhaps the return back to some normal means less pizza getting ordered in. I don't know. We're going to find out. We're going to talk about it. And the Chartmaster's got some other analyst upgrades and downgrades for us, but mostly downgrades today. All right, Ben, let's talk some data. Let's talk ISM services and PMI, looking at just some of the numbers this week that are really adding on to existing readings from these. We did get some numbers on Friday, too, last week as well from this particular data set.
Yeah, and Oliver, for the most part, they're pretty good across the board. You mentioned kind of mixed activity in terms of the indices. Maybe this will help us get kind of a more uniform type move to the upside here. Okay. Again, numbers coming a little bit better than expected. I think we could begin with this morning's numbers at 9:45 a.m. Eastern. We had the market services PMI, the market composite PMI. And while both of these numbers came in, well, kind of mixed relative to expectations, they were both above prior levels. So the market composite PMI coming in, as you can see, at 57.7. Again, a little bit below the estimates, Oliver, for 58.5, but prior at 55.9. Look at the services index. We want to see this again on the move higher. And as I mentioned, below estimates for 58.9, but still a nice uptick from 56.5, no question. And then to back this up, Oliver, with what we're seeing here this morning from the ISM data, this was actually pretty strong. We know that labor conditions here in the U.S. have been very strong, so you'd expect the employment number to come in very strong, as it did right here in the middle. You'll see 54 up from 48.5, but look at new orders up to 60.1 from 56.1.
Wow, nice. Okay.
Take a look, though, at prices. They continue to inch higher, but not necessarily at an alarming rate, I guess.
And not as big of a jump compared to the manufacturing, because we got ISM manufacturing last week. The prices paid were hot.
And look at the non-manufacturing PMI here today as well. Business activity increasing as well. So as mentioned across the board, better than prior levels. A little bit of a disappointment in terms of expectations here, Oliver, but with the uptick right now, I don't think that the expectations are really going to get in the way. This will be something that we'll possibly hear Kashkari discuss today. He's one of the Fed speakers that's scheduled for this morning at 10 a.m. Eastern. But I think the focus is, as we talked about earlier this morning, commodities, crude oil, remaining relatively elevated, holding above $100 a barrel. Ultimately, keep an eye on any headlines related to comments from the president of Ukraine addressing the UN ultimately. But yeah, keep an eye on the indices again.
Take
Look at
down
this.
For the NASDAQ here.
Wow, coming under pressure to say the least here,
So,
but mixed bag.
Yeah, this is pretty interesting because I was wondering, looking at those numbers, how bonds were going to respond. I don't know if this is related, but it does look like we're at lows of the morning for bonds. Prices dropping. Yields jump a little bit.
Looking at it, about 2.5%.
Yeah, looking at it right now, the 10-year future now down almost 0.5%. So I think that maybe is what's going on here. We were wondering which is going to break out first. This is the way I've been framing the market. Which breaks out first, the 10-year or stocks? And the tech stuff, it's kind of looking like right now the 10-year might be ready to break out.
Keep in mind, yesterday the NASDAQ led to the upside, so to see it give a little bit back relative to the broader market here, maybe
now
not
Russell
as big
rolling
of a
over
concern.
too. This might be a different headline. We'll see. I mean, look, the employment situation pretty good. We know that's what Powell's looking at. This is not a number. I mean, look, this is the thing. This is where we're in the catch-22. These good numbers, Powell's looking at this saying, hey, I'm in the clear. I've got employment ticking up. I've got services coming back, the area of the economy that was the hardest hit, and bonds selling off as a result. I think we've got a pretty decent explanation here for what's going on. Futures are really getting drilled now. Wow, 30-year down, now 80 bips almost.
Yeah, well, rates to the upside again. We talked about some of these headwinds for the indices, whether it's commodity prices on the rise or ultimately rates continuing that trajectory. You've got a couple different factors to consider.
So we talked about it this morning.
That's right.
Yeah, all right. Inflation on our mind, economic strength, but higher yields maybe causing a little disruption. Ben, thanks for the update. PMI, ISM, the final reading, and services, a look at a pickup for employment in that sector. We'll watch markets and let you know if selling gets rougher. In the meantime, Michael Keeley's looking at a stock that hasn't been able to bounce back. Mike, what's the deal with Domino's? I mean, I guess nobody's ordering pizza anymore now that the pandemic's over. Give me a break.
You synthesized some of the really relevant key themes, as you so impressively and often do, Oliver.
Thank you, Mr. Keeley. Likewise to you.
Technology helping with the cost structure to a degree, the stock peaking. But what's the story? Well, this Cowen analyst is not alone. We've got a lot of analysts that have swung over to the hold side, which in the parlance of a lot of the sell side Wall Street analysts really means sell. And we see here that the stock is under pretty intense pressure with not a whole lot of basing just yet, but some support at around 380. And so the thinking here is pretty rational in that, business conditions are going south, and it's based upon a couple of main factors. One would be the fact that Domino's is hugely tied to the low-income customer base. And when we run projections on the impact of inflation on discretionary expenditures, it's not, unknown to economists, but it may be somewhat surprising to some of our viewers to know that, this really takes its toll when inflation is raging on the discretionary purchases of the low-income side. And so Domino's has that to contend with. And this analyst is concerned about international business. That's not, that's not to be brushed aside, because they do have substantial business operations outside of the country, but those operations are not nearly as profitable. And you've got 250 franchise stores in Ukraine and Russia, which they have to worry about. So the shortfall from the international openings that aren't happening is taking a toll. And then, here's the real impediment, Oliver, is the cost of the food inputs. When we take a look at that, margin as a percentage of revenues diminished from nearly 22% last year at the same time to now 19.7%, and that's almost entirely attributed to higher food costs, cheese being the primary input for Domino's. And the labor expense is down, which that surprised me, but not you, with your mention of technology, because I think technology really is the offset to the labor expense. But it's not enough to combat these food input costs. And when the analysts are projecting out into the not too distant future, after this plus 4.7% increase for Q4 in food input costs, they're now thinking that overall food input costs are going to swell upwards of 8 to 10% for the full year. You flash back a few months to last fall, and that projection was 2.5 to 3.5%. So it's very challenging for the organization to offset that degree of food input cost. And then you pair that with the fact that the low-income customer base accounted for nearly 30% of 2021 sales. And are they going to make up for that with the middle to high income crowd? Likely not, say the analysts.
Boy. All right. So it's a surprisingly nuanced business, the business of pizza, especially for Domino's, because of that tech element. They've deserved and earned a higher valuation than anything in restaurants, the stock movement. That's why it's been such an interesting one. It's traded more like a tech company the last decade. I think COVID, of course, throws on another bullish catalyst on top of that. And so it's just tough to know where valuation compression might end if that's the story for Domino's, which it kind of sounds like. It's not that these analysts hate the stock. It's just they're trying to, they're having difficulty maybe seeing what isn't already known about this, like what's the wild card? What can they do? More Senate sticks? There's not a lot of big surprise here, it doesn't seem like.
Right. Well, the average analyst target out there at the consensus price target level is around 470. So generally,
okay, so below the high.
But this analyst at Cowen did point to that international sphere of business and said, hey, those international stores run at 60% of the rate of the U.S. stores and half of the royalty rate. And so that's not going to offset the fact that business conditions in the United States are not altogether stellar right now either. So his lowering of the price target down to 480 brings it more in alignment with the consensus of the more than a dozen sell-side analysts that are out there. But you know, looking at the chart, here's a 5-year, which is helpful to look at as well. We can see that you know, those old highs from 2019 appear to be the next possible resting place here in the 390 range, where the stock is, you know, kind of forming a floor at this point.
Okay, nice analysis, Mike. I like the technical look there too. Some equilibrium reached at 370 for a good chunk of that chart there over the last year. So maybe some of the worst selling might run into a little buying resistance, a little support perhaps down here at 360, 370, maybe 400. I mean, somewhere around there is an interesting spot. Down 2%, but market's down now 1.25 as well. So the cut here maybe adding a little bit of additional selling pressure onto Domino's, but still not an analyst that hates it, right? Still a neutral. Though I do like your point, Mike, where neutral from analysts oftentimes is kind of an implicit sell because buy is the baseline. They almost always say to buy. Okay, nice, Mike. Good stuff. Hey, what's the pizza choice out there in Salt Lake?
I'd say pepperoni is probably the most popular.
Okay.
Another thing, Oliver, for those investors.
I was thinking brand, but pep works.
Investors that are keeping their eyes peeled on the restaurant businesses that have a big impact from the low-income cohort not doing as much business, keep your eyes on companies like Taco Bell, QSR as well.
All right, you got it. You're the man, Mike. Thanks for the note. Let's trade it now. Tim Bigham, lead option strategist at Delta Derivatives and deep dish aficionado. I don't know, Tim, I'm throwing it out there, but I feel like you're a deep dish guy.
You know, normally actually a like really thin crust guy.
Oh, I got it opposite. I flipped a coin and landed the wrong way.
Lose will always be number one in my heart. So.
Okay, I'm a Paisanos guy.
Okay.
Which you could do thin crust there too. It's pretty darn good.
Yeah, it's all good in Chicago. You got that right.
That's right. I'm a believer. Hey, all right, how do you want to trade it, Tim? Does that mean you're going to buy Domino's or sell it?
I'm kind of doing more of a neutral trade here, more of a kind of, you know, volatility capture trade, Oliver. We have earnings coming out in late April here, so kind of playing that month as my long, shorter-term selling. Some premium that I think is a little inflated given the recent move in the stock. So 385 is kind of that support area, give or take. So I think the stock may retest that support over the coming couple weeks. So I'm just going out and buying the 380 puts in the earnings week. I think Dow will continue to remain elevated there, and then selling shorter term puts against that, paying about $6.50 right now for that trade. Then I have the 21st options to resell against that trade structure, bring in more premium. At the end of the day, if we do have that move towards that kind of 385, 380 level where support is, this trade will probably be a doubler. So more of a, I'm pre-positioning to be long some earnings vow and hedging that, selling some non-earnings vow before that event takes place. And I think Domino's, you know, given the fact it's still languishing, will continue to. You alluded to the fact that it's almost considered a tech stock, so it may get caught up in any, you know, tech sell-off as well here. So I think the best days are kind of behind it as far as for a stock for Domino's, and maybe for a company, given those input costs that, you know, Mike alluded to. I think it's going to be tough sledding here for, you know, restaurants, to say the least, going forward with higher input costs and lower discretionary income. So, you know, kind of the best of both worlds during COVID has turned 180 for Domino's.
To be honest, I was kind of surprised that Domino's still caught some of that unique tech delivery bid, because every other restaurant adopted something similar with delivery and tech adoption. You know, it seemed like then the relative value proposition for Domino's delivery, because they had just nailed that so good, that system, but then everybody started delivering. I thought maybe that would kind of pull their edge away, but they still made the highs during COVID, and to your point, it has gotten slammed this year with the general tech stocks. I mean, it's pretty wild. The ETF I look at for restaurants, PEJ, is unch on the year. So Domino's is not getting treated like a restaurant stock. You know, to your point, it's getting treated like something different, a little bit more growthy and tech COVID specific. So you're not betting that it's going to crash. You're just really betting that it's not going to have any more upside from here.
Yeah, no major upside. And I think, you know, it got over its skis, you know, previously. That's why it's underperforming, you know, where it should be in the restaurant brand this year. Plus, I think, you know, kids back to school is probably one of the biggest drivers for Domino's. When they were at home, you know, parents would be like, yeah, we'll just get some Domino's, in my opinion, right? I am past those days, but certainly lived through those days. So the fact that kids are back at school, I think affects Domino's more than higher end pizzas, to say the least. I don't see, you know, many of the, you know, elites really having a Domino's app on their phone. It's more of the parents with the younger kids.
All right. So restaurants and reopening themes and that ETF is still down on the day, but Domino's getting hit worse. Tim Bigham with the trade, looking for a little potentially more downside here, at least no upside in the next month. Thanks, Tim. The thin crust, Tim Bigham, lead option strategist at Delta Derivatives, but still a Malnati's guy if you had to pick a local Chicago. I'm Paisanos, people not from around here, no idea what we're talking about. Come find out, folks. Everything you hear, all the stories are true. Damn good stuff. All right, coming up, let's talk emerging markets again as we began our discussion with Jeff Kleintop this morning about international companies that have a good month of April. 9 years running, Mr. Kleintop told us that April's been a great month. We saw the chart, so if it rings true again, then we could finally have some liftoff for EM. The only problem is right now the U.S. dollar is back up and it's moving. As stocks come under pressure, investors are hiding out in the greenback, and usually that's not a great thing for emerging markets.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the Chartmaster is in the building. Trends, support and resistance, key patterns, and technical indicators. The Chartmaster has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Welcome back to Morning Trade Live. We're looking at equities rolling over since the open. It was a soft start, but selling really escalated after we got some decent economic data here. Beating expectations, ISM PMI showing a strong economy, improvement in the employment situation, everything Jay Powell is looking for to hike rates. But what does that mean for the rest of the world? As the dollar firms up, is that going to be a problem for emerging markets and non-U.S. assets? Christina Kemp-Mounty joins us, senior portfolio manager of global debt at Invesco. Christina, welcome to the show. Glad to have you here.
Good morning, Oliver. Thanks for having me in.
Okay, so the dollar looks like it might be breaking out here, trying to again, at least after about a month going sideways. Does that have big impact on non-U.S. assets? Does it make it tricky to own EM right now?
It does, but you know what? When we look at the world, emerging market, especially foreign exchange, looks really attractive to us here. And one of the reasons is because emerging market central banks have preempted the Fed. The Fed just started their cycle in March, and they're poised to go more, and the markets are pricing that. But when we look at emerging market central banks, many of them are close to the end of their cycles, which makes foreign exchange look attractive.
So when we talk EM central banks, what should we be focused on? And do they have enough sway over what the Fed and the PBOC are doing? I mean, it seems like, to your point, if we look at China, they're cutting rates, and I mean, that's kind of China's impact on emerging markets is adjacent enough to be powerful. What should we track over there when we think about the main kind of policy impulse?
So I think when we look at what central banks and as a result what foreign exchange looks most attractive to us, really LATAM sticks out, and Brazil in particular. Brazil is close to the end of their cycle, and they continue to reiterate this should be close to their last hike, if not one further one. And again, if you look across the board, right? Chile, Colombia, all of these LATAM central banks, even the Bank of Mexico, are closer to the end of their cycles to the beginning. And CE in Eastern Europe also is in that region, although it's a little bit more dicey now with what's going on with the Russia-Ukraine crisis.
Brazil stock market's been jamming on the year. I mean, it seems like then, to your point, there's a kind of a gaming situation an investor can do where you avoid the central banks that are tightening, try and chase the ones that are loosening. But are they doing that because the economic outlook is not as strong here? Or what's that trade-off? I mean, a lot of times we think about hiking from a central bank as showing strength in the economy. I mean, is that the case? I mean, it seems like if Brazil is rocking here with all the commodity boom, then maybe you can get a scenario where there's economic strength and loose central banks. I mean, that's kind of like the dream case, right?
It is. And I think part of the storyline is that inflation picked up more aggressively in the emerging markets in the last 12 to 18 months. And if you really think about it, if you think about the U.S., even the storyline from the Fed, 6 months ago, 9 months ago, the argument from Powell and the Fed was still that inflation was transitory. We weren't overly concerned. We weren't in a panic. And in the last 6 months, and especially in the last 3 months as we've started the year, the U.S. narrative has changed to the labor market is red hot. We already had inflationary pressures from supply chain and over the 2 years of COVID. And now, again, the geopolitical situation and increase in commodity and food prices have kind of doubled down on the issues for commodity for developed markets. But again, when you pivot back to emerging markets, a lot of these central banks have acted aggressively early in the last year and a half and have addressed that already. So I think you do have that divergence. And when we look at EM foreign exchange versus DM foreign exchange, that's one of the most attractive trades in the last 12 to 18 months, and a very high Sharpe ratio trade of owning EM FX against non-US DM FX.
Now, Christina, obviously you're coming from the bond perspective, the debt perspective. Is that the corporate debt in these areas? Do you want to get exposure to companies, or is this just sovereign looking at regional and debt from the countries that you like, the bonds that they're issuing? I mean, is it both? What's the best way to play it?
We do look at both, and I think local, we think probably the next 3 to 6 months will give us the optimal entry point there. Again, just because we are still in these final stages of the hiking cycle, and sometimes it's when do you step in and have we seen the end of it yet? But I think both remain attractive, and especially again in LATAM, I'd point to there are a lot of very strong corporates in Brazil, for instance, And you mentioned the Bovespa earlier, and that is much more heavily exposed internationally than actually Brazil's economy, the equity market. So we do think that there's interest in some of these very strong corporates in the region.
Interesting. Okay, so you get a little bit of a different exposure, kind of based on what asset class you're looking at. Does the bull case for EM hinge on commodity prices staying elevated? How does that trade-off work? I'm always kind of confused by that because a lot of the commodity production is happening in these countries, which is good for their growth, but at the same time, sometimes it can backfire a little bit if that inflationary force kind of slows the Western world's demand in any way. I mean, I know that's a pretty complex thing to try and track, but where do we stand in that trade-off right now?
Yeah, absolutely. And I think it's not a black and white, one answer fits all across emerging markets. And with the rise in commodity prices, there are a lot of countries that benefit from terms of trade. I go back to LATAM with Chile and Colombia and a lot of commodity exporters and metals. South Africa is another standout as one of the largest producers of palladium, which again, you're not getting out of Russia currently because of the embargoes and what's going on there. So you do have improvements on the other side, right? Japan is a big, and this is not EM, but Japan is a big importer of oil. So is India. So like there's give and take across the regions. But I think there are a lot of EMs that can benefit from rising commodity prices.
Okay, if it's more than half, then I guess our broad ETF exposure, we were just looking at EMO, is potentially on the verge of breaking out. It's trying to get out of this downtrend. Christina, thanks for the context. Great stuff. Really important subject that we got to keep our eyes on outside the U.S. Appreciate you coming back to us.
Of course. Thanks so much for having me.
Absolutely. Always. Christina Ketmani, Senior Portfolio Manager covering global debt at Invesco. We also just had the ETF up there with the EM exposure from Invesco. Another one of those charts in a long-term downtrend over the past year, but so close to breaking out, just need a little bit more oomph. Okay, speaking of breaking out, how about going out? Ralph Lauren is on the list of our companies we're looking at next. If you recall, I contributed an anecdote onto this program about Ralph Lauren, my experience on Mag Mile looking at $400 jeans. To me, that doesn't make sense. It looks to me like it's a struggling biz if you gotta charge that much for a pair of pants, and stock's not doing too hot either. Let's come back and take a look at the chart for RL and some other names with the Chart Master. Analyst notes and downgrades coming up next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Let's talk some charts and let's talk some downgrades. Analyst notes this morning, Ben Watson on RL in particular, a downgrade here from Wells Fargo. You got 3 downgrades for us, by the way, Ben.
Yeah, it seems to be a theme this morning.
Yeah, it's kind of a negative vibe out there right now. NASDAQ down almost 1.5%. Wow, look at bonds, by the way. Apologies to viewers, I did not give an appropriate update. The bond market is really coming under some pressure here right now. Sorry to distract from the chart master. 10-year yields up 25.3 on TNX, 2.53%. That's going to be a new year-to-date high. So heads up, folks. Exactly the thing we talked about this morning as being the risk point for equities. Okay, Ben, let's talk RL, risk point for my wallet. I wandered into a store on Mag Mile a couple weeks back and $400 jeans. We discussed it. I opted for the Levi's $60 instead. I don't understand how Ralph Lauren can work if they have to charge people that much for a brand that, frankly, I don't know. I mean, RL, is it that cool anymore?
Well, no, and that's the thing, right? I mean, that's always been the cachet about, marquee brands like Ralph Lauren is that they do charge that much. And
I like the restaurant.
Yeah, exactly right. Hey, people go to the guy with the salt and that whole thing because they charge so much. And there is that element of, hey, I get to pay this much, therefore, it must be better. But at the same time, normal consumers, as they're faced with that, as you've seen, pivot elsewhere perhaps, and that might be part of the challenge in terms of the growth story looking forward. So Ralph Lauren's been in this kind of trapped in this long sideways trend with a little bit of volatility increasing over here on the right-hand side in the last quarter. You can kind of see that oscillation moving to a more significant degree, but this has been a wide, kind of very obtuse symmetrical triangle centered right around the 115 mark. We get a little bit of a gap down rally on the downgrade counterintuitively. So kind of sitting right along that lower diagonal at the 111 mark. The potential is there for a bounce back up to the midpoint around the 115, then maybe up to 119. The top of that diagonal is right around the 122 at level. If it breaks down the other direction below that lower diagonal line, that diagonal uptrend line, 105 really becomes kind of the base of that symmetrical triangle. But long-term sentiment beginning to rise once again up into just kind of tickling that overbought range. Intermediate term sentiment down and oversold. It's flattening out a little bit. So, I mean, there's some kind of mixed forces at work here. We're mid-earnings cycle here. This won't release until late in the into the next earnings cycle as you get into some of those retailers. But I'll tell you what, it's kind of coming to the point where if it gets nearer to the apex of this triangle, the likelihood of a big break to one direction or the other perhaps mutes a little bit as it kind of goes sideways.
Okay. All right, so it's going to have to pick a direction here pretty soon. You would think it kind of does this a lot. The last year has been a lot of up and down in RL's chart long term. A lot of up and down. And at this point, though, with the cut from the analyst and the downgrade from the buy, that kind of implicit sell, but a rating with a number right where it trades, 110. So this is not particularly, I think, applying pressure, but who knows? I mean, it's down 3.5%, so the note seems to be resonating with someone, as Mike pointed out astutely in the previous hit, that many times the neutral rating on companies is kind of treated like a sell by the market because it's such a rare thing.
Sure, absolutely. And sometimes downgrades are treated in the opposite direction as kind of a counterintuitive, counter-trend type of move.
Hey, you lose a bull, you lose a bull. And the analyst was bullish, so now that they're not, bearish reaction here. And they cut the price target too by $25, which is a pretty sizable amount, unless you're buying a pair of jeans, in which case it's negligible. It's the tax on those jeans. I'm not going to let them live that down.
Nope.
Hate to say it. I've had some few Ralph Lauren gifts, products over the years. They're nice, not trying to knock the brand, just saying very absurdly expensive, at least here in our main shopping area. How about Starbucks, Ben? Not quite the same nominal cost for their goods, but maybe a little bit pricier for some of the customers in an inflationary environment. Downgrade here too. Starbucks didn't like the buyback slash by Howard Schultz. Down another 3.5% today. Ouch.
Yeah, it was looking and has been looking as if Starbucks kind of coming potentially out of this long downward trend, building a bit of an inverted head and shoulders. That seems to be invalidating itself here at this point as it's violating this right-hand shoulder support at about the 85 mark where it started this morning. A couple of things going on. You mentioned the buyback slash, one of the other things is they're facing labor challenges with increasing unionization pressures. Howard Schultz also suggesting that they're getting into NFTs as everybody else is, right? So a lot of things going on here on this right-hand side, and you get this downgrade that takes it down below that support level at the 85 mark. Now, it can still bounce back up to that 93.70 roughly neckline of that inverted head and shoulders, but perhaps some of the bullish effect of this higher low goes away the longer it stays below that diagonal or that horizontal support. But long-term sentiment's rising, intermediate-term sentiment falling below mid-range, so kind of moving in cross purposes here. So we may see this go sideways simply from a technical perspective between this 85 support and that neckline at the 93.70 until it can gain perhaps some traction to break out and move to the upside.
Okay. So Starbucks trying to put in that three-pronged bottom, that inverse head and shoulders vibe. We've seen a couple charts like this. But Ben, what happens if it slips through that third platform there? Then is hope lost?
It's not necessarily lost, but I think it becomes more of a continuation of that long downtrend that the stock's been in, perhaps even an acceleration, especially if it breaks down below the 79 mark, which would represent kind of that inverted head portion of this pattern.
Okay. All right, nice look here at Starbucks. Not a happy one for bulls, but I think a really interesting analysis looking at it technically. Ben, last one. PACCAR. PCAR is the last one on your list today. And, and one that doesn't really get too much attention, but in a market here dealing with some of the industrial complications that we're getting with trucks and pricing and stuff, it's a pretty interesting one to think about as a industrial stock. But, it hasn't done very well, and especially these last 4 days. This is one of those Dow transport companies that just got blasted the last couple, like 3-4 sessions.
Sure, absolutely. It had been in kind of this intermediate to long uptrend, a little bit of an intermediate downward move, ultimately kind of building into this long symmetrical triangle that was centered right around the 87 mark, and we get this gap down sell-off today that takes it down below that diagonal trend line. So now it's picked a direction, going back to this argument about those triangles. That direction now is to the downside. The potential is there for this to continue to move to the 81 mark, the base of the triangle, that horizontal support down around the 77. If it does gain some traction to the upside, however, back into the triangle, you've got the center of that triangle, right around that 87 mark. So it's got to get back up in there and get up to those resistance levels. But long-term sentiment falling, intermediate-term sentiment falling. Intermediate-term sentiment, in fact, diverged a little bit bearishly prior to this drop to the downside. So from a technical analysis perspective, not necessarily out of the blue in terms of this downside move. There were some warning signs first, but it certainly seems to be taking more of a bearish bent coming out of this triangle.
Okay, so a longer-term version of that triangle we were looking at earlier. It's kind of a similar idea, lower highs, higher lows. Someone's going to have to win out, but the slippage below the uptrend suggests maybe bears are already trying to get ahead of the move.
Yep, absolutely. Hey, Oliver, I feel like I have to speak up, though, for Utah Pizza, because...
Okay, yes, please, Ben. Yeah, Mike Keeley, love him, but, the pep answer wasn't what I was looking for.
When you come out here, Oliver, I'm going to have to take you to the Pie. This is the OG college pizza place here locally, and it's pretty good. And if we go to Chicago, I'm coming at you with I see your Malnati's, but I'm going to come at you with Pequods.
Oh, okay. Yeah, good, tasty crust, but a lot of it.
Yep.
A lot of crust. So, hey, there's whatever part of the pie you prioritize. Chicago's got one devoted solely to it. If you're the crust guy, I mean, it's Pequods, right? I think holistically, Paisanos is still the move. All right, we're going to get Mike Keeley out here and introduce him to some juicy stuff, or I'll come out there to Salt Lake again, and you guys take me to your choice. All right, the pie. I trust you, Ben. Okay, appreciate it, Mr. Watson. When we come back, it's market meetup time. Bond yields just broke out. That chart we were looking at this morning, I've framed the market the last few days as a race between bonds and tech. Which would break out, the 10-year yield or Apple? Which would break out, the 10-year yield or Bitcoin? Guess what? The 10-year yield just broke out.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the Income Investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
I'm Jenny Horn. Here's a few more of this morning's movers to keep on your radar. UBS maintained its buy rating on shares of Meta Platforms while raising its price target to $300 a share from $280. The firm said that while near-term ad checks continue to be mixed, conversations debunk some of the biggest fears with Android privacy headwinds and Apple fingerprinting crackdowns. In terms of catalysts, it said any improvement in engagement data on Meta's first quarter earnings call could drive shares higher. Wells Fargo initiated Shopify at an overweight rating, saying it sees sustained share gains for the e-commerce company. The analyst said that Shopify's ongoing launches of value-added products and services is a positive for the company, and also highlights vendor consolidation, which they expect should drive sustained share gains. And RBC Capital downgraded Carvana to sector perform from outperform, saying it sees negative risk and reward. The analyst said that they need more confidence in unit growth necessary to justify the capacity, hyper-expansion, and cash generation. This will support Carvana's ever-rising balance sheet leverage and future capital raises. This has been your TD Ameritrade Network Market Update. Now back to Morning Trade Live with Oliver Rennick.
Welcome back to Morning Trade Live. Time for our market meetup panel to discuss some of the other news flow this morning that deserves attention. Nick Theodorakis joins us, Financial Risk Management Director at TD Ameritrade. And we have Mr. Dan Grant, Senior Specialist of Retail Trading at TD, here with us in studio. Okay, Mr. T is all caffeinated up over there, and Dan Grant is automatically jacked when bonds are on the move.
Collapsing.
They're collapsing.
Yeah, yields spiking higher, and I loved your lead into this segment. Which was going to break out? 10-year yields, 10-year yields, Apple, Microsoft, Bitcoin. What's breaking out?
Right.
10-year yields.
Yeah, the dollar too.
Correct.
It's the dollar and bonds in one camp, and then it's Bitcoin and stocks in the other. Risk on, and then not necessarily risk off, because the bond is moving like this for pretty good reason. Our data this morning was pretty robust, right?
58.3 for the ISM. I don't see that the markets, they're not taking out the Fed's rate hikes, right? We're still showing 2 rate hikes by June.
Yep.
Right, July at the June meeting.
Yep, 50 bips.
50 bips. The market's inverting. You made a case that last week that they might be over putting too much importance on the 2s to 10s inverting.
Yep.
3-month to 10-year note is still quite steep. 3-month Treasury bill.
Quite steep.
Yeah.
Jeff Kleintop had a great chart for us this morning showing the percent of the yield curve, all the different yield curve permutations. Actually, we've had a lot worse. Even as recently as the pre-COVID yield curve inversion, a lot more of the curves were inverted. The other thing, too, is Lyle Brainerd's commentary this morning, right, Dan?
She's measured hikes, right? Okay. Continue to raise rates all the way to the end of the year. We're showing at 2.5% by the end of the year on Fed funds rate, and they're talking about a rapid runoff of the balance sheet, more quicker than they've ever done. So,
and she's a leading contender. Well, she is the nominee, right, for the news vice chair. Yeah, she's Biden's nominee. Yep. The Minneapolis Fed. So she was talking to Minneapolis Fed. That's where Kashkari is. But the fact that she's talking about balance sheet unwind. That's kind of the other wild card here, Nick, where the market can price in the hikes as they have, but the balance sheet is the one that we haven't had a whole lot of certainty on, and many describe that as being a more relevant one for asset prices. I don't know the math and the sophistication behind that theory. I think it all matters. Tightness is tightness, but the balance sheet part is one that we don't have certainty on yet. So if Brainerd wants to start rolling it off pretty quick, a bit of a shock for markets. What do you think, Mr. T?
Well, if I were in the office today, Dan and I would probably walk out of the studio together talking about what that roll-off looks like relative.
You can talk about it here on air.
Meaning,
I don't mind.
We'd probably get into it for more than the 5 minutes we have here, right? But what does it look like in terms of the rate hike equivalents? How many more hikes is it going to feel like when this balance sheet rolls off? That's what you're really trying to get to. And I think you said it, Oliver, at a high level. The tightness is tightness, right? Regardless of how it's happening. And we don't really know the impacts. They've never had a balance sheet this big, and they've never certainly committed to rolling it off this quickly. So I think both of those are going to be fascinating. The off-putting piece of the counterweight to that is there's a lot more in savings, right? People got a lot of cash. And what are people going to do with those funds? What is the consumer going to do? So I come back to sort of it's the Fed versus the consumer, and I think those two kind of are the most interesting, huge macro U.S. trends right now to watch. The Fed's going to tighten things up. The consumer has saved a lot of money relative to other periods in history. That money's worth less now, though, right? So those things balancing are really the macro kind of fight that we have here. Can they slow this thing down enough and make sure that people are still feeling empowered with the cash they have to abate inflation further, but not put us into a situation where the consumer feels completely like inflation is still real and they have no buying power. Because I think when that fear strikes and consumer confidence really goes down with this roll off, with these rate hikes, then you have that problem of the economy is going to grind to a halt because people are stashing it under their mattress. And that's, I think, that to me is what the soft landing means. They need to avoid that.
Yeah, definitely. The Red Book this morning, brick and mortar retail sales, a little bit slower growth than the previous reading, but we've got a vacuum for data this week, pretty much. A lot of bond auctions on Thursday, and of course we get weekly jobless claims.
Minutes tomorrow.
Yeah, and minutes tomorrow. But data is pretty much done. So this is all going to be about Fed language. We talked earlier on the show about the minutes potentially having some volatility-inducing capacity. I guess we just confirmed that with Brainerd.
And we've been watching the minutes since August when they first started talking about the tapering.
Exactly.
Microsoft was on its way to all-time highs and is down, went down close to $100 from its high. We've climbed all the way back, I think 313, 320 today. I didn't even look at the last on it.
Hey, you're a Microsoft guy, Dan.
I am.
Is that your bellwether fang?
I'm a Windows thing. Yeah, I've always been a Windows guy. I've always had the Microsoft stock in a portfolio. Sorry.
Nice. No, that's okay. I think
not a recommendation to buy.
Okay. Hey, if you own any passive fund, you own Microsoft.
Exactly.
So big tech is kind of slowing down a little bit. Apparently, the Elon juice only goes so far. Nick, maybe it's Twitter specific after all, but yesterday even Meta was rallying, but today it's pretty quiet. This big story we're tracking is, I think, pretty specific just to this particular company. It seems to me like the mega cap fangs are going to be more contingent on the macro stuff we're talking about than anything Elon does.
For sure. I mean, like, he's going to be an influence, right? He's not going to sit quietly by with this investment, but it's one or two or three or four or five companies, whatever he's influencing, right? He's not influencing the whole world, really. You can argue that he's making trends happen, and that does change things, but much more glacially than just the pop we saw yesterday. So those are pretty much idiosyncratic type events. But look, yesterday we talked about how much the overall market was up and wow, great rally and everything, but there were still sectors down yesterday, right? And today, we're down a little bit. The Nasdaq's down 1.5%, but there's more sectors up on the day today. I think there's 7 sectors up and 4 down right now. So don't miss the trees by looking at just the forest either, right? There's a lot going on under the surface right now. And, on a day where it feels like the major indices are all down across the board, most of the sectors are actually up. Today, yesterday was a Twitter Elon day. Today is interest rates are up, tech is down, but everything else is sort of hanging in there. And I think from an overall recovery standpoint, from where we were, a month ago with the war starting, and it feels like this isn't certainly a washout kind of day. This is much more of a stable day with tech readjusting, given the fact that rate expectations have gone up. And I'll just say, Oliver, I'm ready to move on from coffee and into some Paisanos here, because I'm with you.
A little early.
Overall, great play. We can't charge Starbucks versus Paisanos, but I wish we could.
All right, you're a Paisanos guy. What about you, Dan Grant, since we're talking Chicago pizza?
I think they turn their ovens on at 8:30 in the morning, so when you're having that Thursday morning or Friday morning early pizza, I'm pretty sure they got that oven going by 8:30. They don't take orders before that. I do know that.
Okay, Dan's I can tell you're very serious about this. I trust you as well.
I'm a Malnati's guy too, so I'm interested to see what he was saying about the pie out in.
All right, we'll do a little trip to Utah.
Exactly. I don't know if they can figure it out. Maybe we have some people that have moved out there. Something else out there, commodities are ripping higher this morning.
They are, yep.
So is that an inflationary thing? Apparently.
On the move. Crude faded a little bit, but wheat and some of the others could be jamming here. But I think actually Paisanos did push up their prices a little bit. All right, thanks, guys. Dan Grant, Nick Theodorakis, fun panel here, conversation. Dow Jones is positive, as we do have a very different spread this morning between tech and growth companies as yields are ripping. Trading 360 with Nicole Petalides is coming up next. I'll see you this afternoon for Market on Close.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
Good morning. We are 90 minutes into the trading day. Welcome to Trading 360. I'm Nicole Petalides, live on the floor of the New York Stock Exchange on the corner of Wall and Broad. Glad to be with you today. You are seeing the markets under some pressure. We'll take a look here at the exact numbers as we're seeing tech and consumer discretionary weighing. The Dow is down 3 points, 34,918. The S&P is down 16 points at 4566. The Nasdaq, tech-heavy Nasdaq, down 1.3%, down almost 200 points at 14,962. And the Russell is down 1.1% at 2070 for the small caps. Now to some of the biggest stock movers in the markets. Of course, Twitter continuing to climb higher. I think it's losing some of its momentum, but the social media company appointed Elon Musk to its board of directors. The move comes after Musk purchased a 9.2% stake. Musk tweeted this morning that he is looking forward to working with the company to make significant improvements in the coming months. And cruise lines are higher this morning after the Carnival announcing that the period from March 28th through April 3rd was the busiest week for bookings in the company's history. The double-digit increase from the previous record one-week toll. The company announced that 22 of its 23 ships are back in operation, with the final ship returning to service on May 2nd. Tigris Financial Partners' Ivan Feinseth will join us to discuss the cruise industry. Wells Fargo initiating coverage of both PayPal and Square with overweight ratings. The analysts there seeing a $1.5 trillion in annual revenue for fintech companies globally and expects 6% annual growth over the rest of the decade. And Goldman Sachs with a call on Generac, upgrading to a buy, $410 price target, adding it to the firm's America's buy list. Stock today's disruptor, and Tom White is standing by, and we'll have more later in our show. And here's a look at the top futures products. You are seeing Bitcoin pulling back, down 185 at 45,900. US dollar with a little strength, 99.14. Gold, 19.34 a troy ounce. And crude oil, 102.56, down 0.75%. And the VIX at 21.88. Let's get some insights. The news shaping the markets, and for that we welcome in Rob Fleming, Senior Market Analyst with Schwab Center for Financial Research. Rob, thanks for being with us. There's so much going on. We're getting a lot of Fed speak from Brainerd and Esther George. But what's your big picture here? We had this rally. We're seeing some weakness today.
Yeah, good morning, Nicole, and I'm really enjoying the new location there as well. That's awesome.
Thanks, Rob.
Yeah, and the Fed's definitely top of mind right now, especially with tomorrow's release of the meetings, March meeting minutes as well. And then you'd mentioned Brainerd's comments. She's still a nominee for vice chair, so her comments will carry a lot of weight. And well, that's what we've been looking for: some clarity, some details on their plan for their balance sheet reduction. So I thought that was a little bit of why we're seeing some action in the bond markets as well. And given what we've seen in terms of stock performance this week, we saw some growth leadership from the heavyweight sectors yesterday, and a little bit of a give back today as we bump up against some of those February highs we saw in the S&P 500.
Yeah, what's interesting is the swings we're seeing in technology. I mean, I was looking at the 1 month on the NASDAQ, which was up 12.5%. So people who had tech and it sold off, I mean, it's really heart-wrenching when you feel like you're losing in a big way, but came back. But look at the big swing even today.
Yeah, we've definitely seen some sporadic movements there, especially what we're looking at is the speculative names, non-profitable companies that really got flushed out early on in the year, and as of late, looks like they're getting a little bit of a bid right now. Then we've had some different leadership as well through this whole 4-week rally. We had some defensive plays like REITs and utilities, consumer staples take the leadership for a while. And then we saw yesterday, the big cap growth companies step in as well. And we're looking at, we've seen some improvement in the breadth when you look at the 50-day moving average. We've seen it along the S&P 500, the NASDAQ, and the Russell, but when we broaden it out, looking at the 200 days, still a little bit of a weaker story there. S&P's improved, but Russell and NASDAQ are still got a little ways to go.
Yeah, and I know you were dusting off the recession checklist. What does that mean? What are you looking for? As I said, Esther George was looking at the conditions, saying go faster than before. But as you said, Lyle Brainerd, watching the yield curve for downside risk.
Yeah, we're looking at a few things. The yield curve's definitely one of them. We got the inversions there, and that's caused a lot of chatter on the street there in terms of potential recession. But when you look at the 2- and 10-year inversion, that has a pretty historic track record of predicting recessions. The problem is the recessions are inevitable, but it's the timing of when it's going to happen. And if you look at the more shorter end of the yield curve, like the 3-month, 10-year spread, still pretty steep. So our chief fixed income strategist, Kathy Jones, thinks it's a little premature to be calling for a recession, and we might be looking at that event maybe late 2023 and early 2024.
Right. Yeah, I know you're watching for consumer expectations and what people are thinking. We don't have much data left as far as some of the big numbers. We've gotten in a lot of that, and we'll hear from the banks next week. We're going to be talking about that later in the show. But, the big picture here is how strong the investor really is and consumer while they still face the high inflation situation.
Yeah, definitely. If you look at the consumer sentiment reports, it's a toss-up between the inflation concerns and how they view their household finances looking forward. But you look at the labor market with rising wages as well as a little bit of an offset. But we're keeping a close eye on how fast inflation is outpacing the wage growth there. That could be an issue with consumption moving forward. But yeah, we're still seeing pretty solid activity from the consumer, even though we're seeing some poor sentiment readings in terms of expectations.
Yeah, and what do you tell the investors, short term, long term? What's the approach?
Yeah, right now we've few weeks ago we moved to a neutral stance in terms of sector tactical movements. So we still need some clarity there, and until we get that, that's a temporary move. It's not going to stay there forever, but until we get some clarity, we'll make some tactical moves there. But we're still in the camp of quality, especially with earnings season coming up. It'll be a good tell to see who's got strong balance sheets, good cash flow yields, low volatility stocks. We think that those are the factors that have been outperforming as of late, and we think that'll continue to do so amid this volatility.
Sorry. So last but not least, as you look at what's going on here, we'll hear from the Fed, or at least we'll get the minutes. And is there anything that could be a surprise in the minutes at this point? I mean, the minutes feel so backward looking.
Yeah, it definitely is. I think what we're looking at is we want more details on the balance sheet plan, how that's going to play out in accordance with the rate hikes. definitely, markets are expecting, pretty aggressive on the rate hikes with a 50 basis point in May and potentially another one in June there. But looking at details of the balance sheet and then also trying to get some clarity on where they feel the neutral rate is, which is the rate at which, they don't want it to be too high where it curtails economic growth, but not too low where it spurs inflation. And the longer term projections still have the nominal rate at 2 to 2.5%. So any kind of details on how they're thinking about where the neutral rate should be, that could give us a clue on how aggressive they will be as well.
Yeah. Rob, thank you so much. I'm glad to be back at the New York Stock Exchange. When you're in New York City, you'll come visit us. Rob Fleming, Schwab Center for Financial Research. Thank you so much, always. Plenty more to come right here on Trading 360. We're watching Carnival. Carnival's in our 360 spotlight after the company announced record bookings last week. Ivan Feinseth from Tigris Financial Partners tells us what this means for the cruise industry overall. And Generac is today's disruptor after an upgrade over at Goldman Sachs. Tom White has the details and an example trade for you. And we are ready to talk bank stocks ahead of next week's earnings in our 360 round. Don't miss it. But up next, the big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein goes through the technicals. Alan Nuckman from bullseyeoption.com takes us through the trades for eBay, JD.com, and Cleveland Cliffs. Next, here on Trading 360.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Trading 360. I'm Nicole Petalides, live in New York City. Thanks for being with us, live on the floor of the Stock Exchange. New York Stock Exchange, the big three, okay? Big three. 3 stocks, 3 charts, 3 trades. Ben Lichtenstein will take us through the charts, and here to take us through the trades, Alan Nuckman, Chief Market Strategist, bullseyeoption.com. Thank you both for being with us. So I'm glad we have some good ones here to take a look at. I love the titles that you put on each one. With eBay, you said, tech is not dead. Tell me a little bit about your eBay thoughts here, Alan.
Well, I'm the optimism wins guy, and that's what we said a couple weeks ago when I was on with Ben, and we saw the breakout and the confirmation that the bottom base was in. So you look at tech, we're still 10% off the top, but we are 15% off the lows. So looking at this stock, I'm looking at eBay. It's a stock that's 30% off its October highs. And what's interesting here is that it's down 10% in the last year versus the NDX, which is up 15%. We've got a double bottom, a great technical setup here. in the big picture, it's been trading between 80 and 50, so its midpoint is 75. That's kind of a magnet sometimes. And it's consolidating between 50 and 60 for the last 2 months. That took a breakout to the upside at 70. Again, my strategy is always stock substitution, where I'm buying in-the-money calls. I'm looking at the July 50 call. Again, 50 is that bottom base. And that option's trading for about 8. It's $7 in the money, 3 months of time. And if eBay gets to that 70 level, that option doubles in value.
Ah, okay, so you do see some upside potential here, because today it's at 56.32. Now it's Ben's turn, because he's going to take a look at the chart for us. Ben.
Good afternoon or good morning, guys. Alan, I see what you're saying in terms of potential bottom in right now, but I think the market is really at a high inflection point right now, critical juncture in many ways, as I've been calling it. And at this point, we've really yet to see the bulls do the heavy lifting that's necessary, especially in a stock like eBay, considering, as you mentioned, how it's down versus the NASDAQ being up. The NASDAQ's been a lot stronger than eBay in terms of coming off these most recent lows. Let's dive right into the chart, though. Take a look at what I'm talking about, the move off the February lows. And I agree with you, Alan, in terms of potential for a bit of a bottom to form here at this point, but I just don't really see the enthusiasm to the upside. Look at how we failed to take out the Feb highs while the broader market was able to. The NASDAQ back up above 15,000, the ES up and through 4,600. Now, yes, they're all rolling over, which is what concerns me, because eBay failed to take out those upper levels, and now it's starting to come off. You guys know how I feel about it. If we build momentum through the middle of this range that's been forming, I'll call it $61, $60. We'll call it down to the lower extreme, 47. If we build momentum through 56, 54, we open up a door for the retest of the lower extreme. So that's not what the bulls want to see. Speaking kind of to that point, again, it looks like we're now, after a recent brief visit up above the 50-day moving average, potential weakness today could bring us right back down below it. We've been holding below the 200-day moving average, but look at how RSI is starting to roll over. Potential a bit of a precursor in terms of us working our way back through that range, as I mentioned, through, again, the 55, the $50 level opening up a door for 55 to 53 level opening up a door for a retest that lower extreme again below 50. But take a look here. You can also notice how volume's been a little bit limited, but look at this. Since the beginning of the year, down 15%. Since just this month, we're down 1.5%. Over the last week, we're talking down 2.33%. Now, there is one thing I'm noticing is take a look at this bit of a double bottom here. So again, that's encouraging for the bulls, and especially as we take a look at the weekly time frame, because it kind of reminds me of this double bottom that we saw back around, if you remember well, way back around 2018 December, and we're talking the spring of 2020 off the pandemic lows. So again, potentially something to build on here, as Alan alluded to, but I think that as of this point, we've really yet to see, as I mentioned, the bears do the heavy lifting that you need to see to get up above some key levels, and eBay just has yet to do that.
Yeah, it's interesting. I like that you showed us the double bottom now versus the double bottom prior, which could be encouraging, but really stating the obvious here, which is look at the selling that's happening in tech, and it's been so volatile. I was saying earlier how the NASDAQ over 1 month is up 12%. But today, you can see the big sell-off that's happening in tech. So, Alan, make your case here one more time here for eBay before we move on for your trade.
Number one, it's a 3-month option. It's 100 days. It's deep in the money. It gives you the right to be long from 50. So essentially, you have the right to be long from the low. It's $7 in the money, and it's trading for $8. So my time value component is very small. My expiration break even is very, very light lift there. And if Ben can go back to one more chart, look at that chart, that the double bottom that we're seeing in eBay. Tell me that's not exactly the same chart that we saw in the S&P about a month ago.
Right, okay. So that's for eBay. Let's move on and talk about what's going on here with these Chinese stocks. So they've certainly been volatile. There's been warnings, don't get in them. Others who say, hey, that's where growth is and it's a great place to be. And you've had some cooperation from China recently, which gave them a bit of a boost. Alan, your thoughts on JD.com?
Well, China, I say optimism wins. You know what else wins? Capitalism wins. And I think they finally realized that they have to support the capitalistic, stocks. And they are now opening their books, so to speak. We'll see what actually happens. But that's getting us a little bit of a relief rally. So if you look at this JD.com, it's been between 60 and 70 now for 3 weeks. But in the big picture, It's traded in 5 years. It's traded from 20 to 110, $65 midpoint. Also traded here in the last 90, $40, $65 midpoint. If you look at this technically, you can see lower highs and higher lows with an apex at 65. A breakout on 65 is a big deal. I'm looking for an in the money again here, a 255 call for trading around 2.5 months at a time. And if we get to that 80 level, then that option gains 100%.
Yeah. You know, and the chart right there, I can see the big dip, and Ben will comb it out here. But the truth is that volatility and huge sell-off that we saw mid-March was tough. Some big gaps, too, Ben. Tell me about your thoughts.
Nicole, some enthusiasm has come back into a few of these names that came under pressure, to say the least, amidst that China crackdown recently. And the dip, as you mentioned, really well spells it out here in terms of some of the selling that we saw. Now, take a look, because we came off of the end of November, beginning of December highs that we were trading up around the $90 level, 91. And then again, it was all the way down to $40. You can see 40.55 actually was that bottom that we saw. And we've come off that lower level. Now, a V-bottom type pattern. So it was a bit overdone, it seems like, the downside. But I do want to point out just the horizontal sideways consolidation, overlapping rotational, and then the vertical nature associated with this price activity with very short-lived balances on the way down. So again, you can see the V-bottom type pattern, how we're now kind of in this elongated, direct, kind of low conviction sideways pattern. I just don't have a lot of lean one way or the other in terms of JD.com. When I look at price activity like this, we do see the recent volatility. I think it's still a scary stock for many when you see that kind of a move over such a short period of time. And yes, we've rallied back, but still unable to take out the $75, the $80 level, which I think is key. Again, similar as we were just talking about with eBay, while the broader market took out the Feb highs, well below the Jan highs still. Again, keep in mind, in terms of the ES and the Dow, that's an all-time high back in January. But taking out the Feb highs, you can see how JD.com, much like eBay, struggling relative to the broader market. Take a look, still holding below the 50-day moving average. A similar situation in terms of eBay, where RSI is just not really giving the bulls much to hang their hat on. And then, again, as I mentioned, when you look at the weekly, there's just not a lot here. The one thing that I think is somewhat encouraging for the bulls is we talk about how markets get a little bit overdone. We saw that to the upside, 108. Again, talking about the February 2021 highs, and then definitely a bit overdone to the downside. And again, reflection of that being that V-bottom we just looked at on the 60-minute time frame. We always talk about that a bell curve type pattern where you get an upper extreme, a lower extreme, and kind of the beef of the bell curve forms sort of in the middle of it most oftentimes. Well, that would form right around 80. So there could be some potential to the upside here if we were going to get our way back into the middle of the range. And, well, you know how I feel about it. With energy and follow through, conviction, participation through the middle opens up a door for a retest of the upper extreme. But we're still a ways off that middle ground, so to say, that $80, $85 level. But again, swift rejection of the lower extreme. And we've got some upper and lower extremes here now established at this point, but just not a lot of conviction here at this one. Not a good lean, I guess, is the best way of putting it. We did see some conviction off the March lows, but again, unable to take out the Feb highs.
Yeah, I like when you said a swift rejection of the lows. I mean, you know, the truth is it is under the 50-day, and, you know, these stocks can be very volatile, and they're not doing particularly well this year, which may be a good reason to get in, Alan, because they are beaten down. You know, is it overdone? For example, JD.com, year-to-date is down 12%. 1 year's down 25%. And to your point, some of these are probably have some good potential, Alan.
You're making my case. It's about risk reward. It's got some time to develop. I have limited risk. And this wedge is so significant from a price standpoint. A breakout above this 65 level is solid. Then we could quickly chase to 80 because the sentiment has been so negative for these Chinese stocks. You see how quickly they do bounce. So I'm with Ben that I need to see some follow through, but a push above 65 would be a great start. And again, you know, the theme here for these two stocks is not just yet, but I'm looking for this future action to the upside.
Right. Okay. So we'll leave that in the Chinese stocks there, and then we'll get to Cleveland Cliffs, which you're looking at as a momentum play. Tell me a little bit about that, because we haven't had too many momentum plays lately.
That's right. A commodities comeback. And this is a stock that I'm very familiar with. It's a momentum mover. It's 1,000% off its COVID lows. All right, but at the same time, here at new highs right now today, it's at half of what it was in 2012, and it's at a quarter of the price it was when commodities topped out in 2008. So there's a lot of upside potential here. They've been trading 20 and 30. So at breakout above 30, that target's 40. We're about 33 or so right now. So I'm looking at the July 25 call. 25 is the midpoint of that range. And I'm leaning on that as a support level to buy in. I'm looking at the July 25 call, trading about 950. It's 850 in the money. It's got a high delta. And I'm looking for a modest move, a move up to the 40 level. That option would gain 50%.
Yeah, I mean, just an unbelievable move just here since, the beginning of the year. Right. And to your point, I mean, I know you were looking back further, and I know that Ben might do the same, but just even seeing what it's doing over 1 year, up 85%. Ben?
Yeah, guys, of all three of the names that we're looking at here today, I think it goes without saying this is the one to get really excited about. I can understand why Alan is somewhat bullish CLF, and I like it mainly because it's a textbook example of what I look for, those two separate phases of price development. You have the horizontal phase, which transitions to the vertical, and it constantly transitions from one to the other, sometimes more well-defined than others, but in this instance, it's very well-defined to the upside, a trend environment, almost like a staircase type pattern. You can see that, and this is what I think is important for traders to do, is kind of take a step back and not necessarily look at the market tick for tick, but in terms of these areas that form. And again, here you can see kind of consolidation around the $19 level into the end of February before the vertical phase comes into play. We stop right around 27, 28, and then go horizontal again right around 25, 26 before another breakout in the middle of March. The vertical phase comes back into play before we go right back into that horizontal. Now, we're attempting that vertical again here. That's that breakout type phase where you see conviction. In this instance, it's been to the upside, higher highs and higher lows. You're looking for good energy, participation, as I always say. And ultimately, it's not really as big of a deal as it may seem to break out of a range. That gets everybody really excited. The bulls, at least, the bears are kind of like, here we go again. But what you're looking for, again, in the instances that we've seen each time that we broke out, basically going all the way back to these lows since the beginning, middle of January, is you get formation of that new horizontal area at a higher level. So I kind of like to think of it as footprints along the sand. The market's kind of leading us. The path has been higher. Take a look here, holding well above the 200-day moving average, a sign of the strength we've seen above the 50. Look at RSI. It's a little bit overextended, but that can remain overextended for a while. Just want to point out here again in terms of you can see how we kind of bottomed out around 345 and just this huge move to the upside. And then speaking to the vertical nature associated with what we're seeing here, and we just looked at on the 60-minute time frame, the run up again off these Feb lows. Take a look here on the weekly time frame, breaking out of the bit of consolidation that we've been in again for the last couple years here around 22. So this will be interesting to watch here, definitely tied to commodities on the rise. I mean, you've got the tensions between Russia and Ukraine, which have eased some, it seems like, but a very volatile situation there, to say the least. President of Ukraine is addressing the UN Security Council here today, potential more sanctions to come from U.S. and the EU. So again, we could see continuation of this pattern of the upside, but at the very least in a well-defined trend up as we stand right now. No rejection of these upper levels as of yet.
Yeah, you know what's interesting? Both of you, pro traders, look at this momentum and don't see it as tired, that it just will keep going. That was the first thing that you said, Ben, when you were, commenting after Alan brought it to us. So, Alan, your final thoughts here, as Ben seems to be on board with you here.
Well, I wanted to give something Ben to agree with, and so you see this, but it consolidated around 30, so that was another level. So markets need to take a break and consolidate. So it consolidated around that 30 level. Now it's broken above that. That target's 40. So there's two schools. You can buy dips, or you can jump on momentum plays once they consolidate and regroup for another energized move higher. So it's important about this money management that we stay above 30 on a closing weekly basis. And that 25 call is deep in the money, gives you the right to be long from that lower level. And you tie up so much less money and you have less risk with this strategy. I like to say that I position for success.
Okay. Good to see you both. Thank you very much. Always fun to do the big three. Love having you both on. Thank you for a great conversation today. Alan Nuckman, bullseyeoption.com, and Ben Lichtenstein. Thank you both for being here. We took a nice look at JD.com, eBay, and Cleveland Cliffs. Thank you. Coming up next, ready to spotlight those cruise lines, Carnival reports record number of bookings, right? Is there a lot of pent-up demand? Can it continue? Is this a good time to get into these cruise stocks? Well, Tigris Financial's Ivan Feinseth is standing by. He'll explain coming up.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network. Welcome back to Trading 360. I'm Nicole Petalides, live from the New York Stock Exchange. Thanks for being with us. Quick look here at the markets. We've seen some pressure today creeping in as technology and consumer discretionary are on the downside. The Dow is down 45 points at 34,876. The S&P is down 22 at 4563. That's down about 0.5%. But the tech-heavy NASDAQ 100 is down 1.5% at 14,928. And the Russell down 1.25% for the small caps at 2068. Time to spotlight the cruise lines. Carnival Cruise Lines announced a record week of bookings. It was in our movers this morning. Ivan Feinseth's with us, Chief Investment Officer at Tigris Financial Partners. Amazing, Ivan. Thank you so much for being with us. So they basically said in the last week of March into April that they got so many bookings. In fact, it was a record. Are you surprised?
No, not at all. First of all, the cruise industry is very resilient, and there's a tremendous demand for people who want to cruise. And most importantly, the cruise industry offers the consumer the best value for their travel dollar. The all-inclusive nature of a cruise and all the amenities and activities that cruise ships offer make it a compelling value when you take a vacation. And there is huge pent-up demand because the cruise industry has seen significant passenger growth every year for the past 20 years. The peak year in 2019, over 30 million people took cruises, and that was projected to grow in 20 and 21. Unfortunately, the pandemic derailed that. But you have the pent-up demand of people who normally take a cruise every year, people who, the new to cruise that continue to join the cruise industry, and all the people who were not able to take cruises for the past 18 months. So that creates a lot of demand. And plus, you have an incredible number of new and exciting ships that have been recently launched and are going to be launched over the next few years. The cruise industry is a really compelling investment story.
It's interesting, especially because you said how it really provides value for folks. And in a time where we're facing a lot of inflation, people are feeling like they've been locked at home or they're just, really could use a vacation, this very well could be the way they're doing it. And it was really evidence here, as Carnival said, from March 28th through April 3rd, they saw the record bookings. And to your point, ships, more ships. They have 22 of 23 ships now on the go. The last one will be ready to go the first week of May, so that's not far away. But to your point, even more ships will be available from these cruise lines, right? And that'll get people in as well?
Well, I think by the second half of this year, all three of the major cruise lines will be fully operational. 100% of their fleet will be back in service. Plus, they are adding new ships. All three of the big lines have just recently added at the end of last year or are adding new ships this year. And the cruisers love to go on the newest and greatest ships, so it attracts a lot of demand.
Right, without a doubt. So now, do we differentiate here as an investor between the three majors of Carnival Cruise, Royal Caribbean, and Norwegian? As an investor, do you like all three, or does one seem better than the others, and why?
My top pick is Norwegian. It's the smallest with the youngest and most feature-rich fleet and has the most leverage to the recovery. Now, what we've seen is that through the pandemic, the industry has cut costs, and I think there's huge earnings leverage to the snapback in revenue, and I think that's most evident in Norwegian, especially that Norwegian has the most number of ships coming out in the next few years that have a significant. Norwegian's fleet will grow over 40%, and with the ships that were recently introduced but not really in service, almost 50% over the next several years. So I think Norwegian, we have a strong buy on Norwegian and a buy on Royal and Carnival.
Oh, okay, so and a buy on, yeah, and a strong buy. What's interesting too is as you talked about the resiliency of the consumer, I wonder if it pans out. Will this pan out to the booking sites, the airlines, the casinos? I mean, just in a broad-based way. I know you haven't, you're not on to talk about all of those, but just how are you feeling as an investor now?
Well, I've recently been traveling. I've actually went on several trips so far this year, and every time I go to the airports are packed, the flights are packed, and they are getting higher and higher prices. So all across the board, you're seeing strong travel demand, both for leisure travel, which has snapped back strongly, and you're seeing a recovery in business travel as well.
Mm-hmm.
More
what's interesting
companies are
because
hosting events.
Oh yeah, absolutely. I mean, the latest results from. I'm going to keep talking only because I see we have a delay. So, Carnival Cruise, for example, in its latest report in March, it really wasn't so great in some of the numbers that it provided, but this record number of bookings going forward really shows some optimism. The other headwind might be the costs that some of these companies face, whether it's for gasoline or for labor and food.
Those are the three biggest cost components. I believe all three tend to hedge at 50%. I know that Norwegian does. They don't want to speculate on fuel costs, so they're not experiencing the full impact of the recent rise in crude prices. However, because there's such strong consumer demand, they have strong pricing power. Everybody felt that the cruise industry would have to massively discount to try to incentivize the consumers to come back on board, and it hasn't been the case. Really, the strong demand has driven record high prices. I mean, post-pandemic high prices, and they are seeing strong levels of onboard spending as well. So the prices, they may have been experiencing some inflationary pressure, but their pricing position is extremely strong and they are overcoming it.
That's a big deal too. Once the people get on, are they just taking their free Bahama Mama and calling it a day, or are they spending? Are they spending in the gift shop, spending, etc.? And that's a good point too.
The upgraded dining experiences, the spas, the excursions. There's a whole lot to do once you're on a ship. While the ship, there's a lot of activities. There's also a lot of premium features available that travelers are opting for.
Certainly sounds like fun. I've never done a cruise like this, but it really does sound fun. Ivan, thanks.
And I only recommend the cruise stocks, but I recommend taking cruises as well. They are very enjoyable. I've been lucky enough to have been on several cruise ships, and I love to cruise.
Oh, see that? Ivan Feinseth, Tigris Financial Partners. Always great to have you on, Ivan. Thank you very much. A good look there at those cruise lines. He had a strong buy on Norwegian and a buy on Carnival and Royal Caribbean. Coming up next, let's take a look here at Generac. Tom White is with us. It is today's disruptor. It is up over 2% as we speak. Goldman Sachs adding this one to America's buy list. Tom White has all the details and a way to trade it. Coming up.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy. A measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Welcome back to Trading 360. It is time for the disruptors, and with us right now, Tom White, here to take a look at today's company, and that is Generac. You know, it's an incredible chart. I saw when it went up to about $500 near the end of last year. Tell us a little bit about this one with a great call from Goldman Sachs today.
Yeah, Nicole, upgraded at Goldman Sachs, and I think if you see that pullback of nearly 40% from those all-time highs just a couple of weeks ago or a couple months ago, you probably understand why the compounded annual growth rate for this company, you know, their primary services making generators is about 19% on a year-over-year basis. So it does lead this particular sector. Company makes generators, power, and you think about the uses for this, right? Clean energy products, solar power products, residential use. And then, you know, there's homes being built that require a backup generator system, and Generac is in there. They've got some competitors in the space, whether it's Cummins Engine, Honda Motor Company, Solar Edge Technologies, Enphase Energy, and some others, but they are definitely the market leader in here. And if you think about the increase in storms, power outages, utility issues, all these challenges with climate change that have affected utilities, that's why I think you're seeing the upgrade here today in Generac from Goldman Sachs today.
Yeah, you know, I think it's a really exciting company. For years, we've been talking about this one. Every time there's a natural disaster, you know, the homes that had generators, and while others are out without electricity for a week, the homes with generators fare better. And so this has been an ongoing story. And just this move into clean energy and the tie-in that they have here in the solar battery, and that being extremely popular and powerful, you know, I'm not surprised to hear some optimism here. So I'm curious about your trade, how you're looking at this one in the big picture.
Yeah, you make a good point. It's not just the personal generators that you see this company is making. It's the power grid systems. It's the backup systems for those solar grids that are becoming more and more prevalent. So the potential total addressable market pretty significant here for this name, and they're basically domestic, you know, in North America, but they have started to expand internationally. So if I wanted to look at this for a trade, it seems like it's got some support at about $298, which is about that 50-day moving average. It's bounced off of there to the upside over the last few weeks. So I looked at a strategy that takes advantage of higher implied volatility, which we have in the overall market due to geopolitical risks and inflationary pressures. So I looked at going out to the May cycle, so just over a month and a half until expiration on this one. And because implied volatility is elevated, I'm going to collect more on a cash secured put, which is a neutral to bullish option strategy here. This is a high price stock. You got to remember that. So using the leverage of the option market might be the way to go when you're looking at potentially getting into specific names like this, as opposed to buying the shares of stock. So looked at selling the May 300 strike put. The credit that you can collect on that is about $12. So $1,200 is your potential reward on this. But if the stock does fall below 300 at expiration, you get to buy the shares at a discounted price, which is $288, which is the break even on this particular trade. So you're below that support level at the 50-day moving average. The stock is only up about 2% today. It's fallen from session highs on this upgrade. But like I said, this stock's down almost nearly 40% from those all-time highs, about $520 over the last couple of months. So it gives you that opportunity to get into the stock at a lower price, or just take advantage of that higher implied volatility where you get to keep that credit that you collect on this neutral to bullish strategy.
Yeah, neutral to bullish, and as you said, a month and a half to do it, and you have that support level just below the 300 mark near the 50 days. So a good one to take a look at today. Thank you so much. Excellent, Tom. Thank you. Tom White with our disruptor today, Generac. Thank you. Coming up next, let's talk about the banks. They're reporting next week. Earnings season is on. Fed rate hikes. Jamie Dimon, who talked about potential losses yesterday. Much to discuss here with our 360 round panel next.
Let's walk through charts, one of the most commonly used features on thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select time frame to adjust the time intervals or to favorite a time frame. Select style to change the appearance of the chart. You can add drawings by selecting drawings, drawing tools, and then type of drawing. For symbol comparisons, select studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
to
wow, I
board.
gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. Ah, they're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim Trading from TD Ameritrade.
Lichtenstein here with your TD Ameritrade Network futures market update. A sharp move lower just after the cash open for stocks and stock index futures products in reaction to comments from Fed speakers. We heard from Federal Reserve Governor Lael Brainerd. She said she's watching the yield curve and other data for suggestions of increased downside risk to activity. Yesterday, she said inflation's much too high and she expects the balance sheet to shrink considerably more rapidly than in previous recoveries. Esther George, the president of the Federal Reserve Bank of Kansas today, said 50 basis points will be an option we have to consider, and conditions easily argue for going faster than before. The Nasdaq's back below 15,000, down around 1 3/4%, with the TNX 10-year yields back above 2.5%, and the 5-year to a new multi-year high up to 2.71%. Rates on the rise and indices coming off partially due to commodity prices, which are also pointed north and adding to inflation concerns, with Ukraine's President Volodymyr Zelensky addressing the UN Security Council today. The possibility of further sanctions from the EU and the U.S. have crude prices, well, hovering around unchanged to now slightly lower. They were higher on the day after a big move up yesterday, 4% to begin the week. The WTI is, again, hanging out just below 103. Keep an eye on the natural gas, though, back above $6, as well as grains, with geopolitical tensions still a factor to consider. Beans and corn are up 1%, while wheat is up over 3% as Russia, the top world wheat exporter, Ukraine is the 5th largest, a factor to consider. This has been your TD Ameritrade Network Futures Market Update. Now back to Trading 360 with Nicole Pedalides.
Ben Lichtenstein, thank you for that report. Welcome back to Trading 360. I'm Nicole Pedalides, live at the New York Stock Exchange. Thanks for being with us. It's time for our 360 round, and today we're talking about bank stocks. Kicking off earnings season next week. Eric Compton is with us, Senior Equity Analyst at Morningstar, and Dave Hardin, CIO at Summit Global Investments. Thank you both for being with me. So, we're getting ready for the big banks next week, but as we kicked off this new year, it was an incredible record 2021 in many ways for the banks. The banks were booming, earnings season was starting, and that's how we started off this year with some good news for banks. Is the picture different on the heels of what we heard from Jamie Dimon yesterday? Eric, I'll start with you.
Yeah, so I don't think things are different. I mean, obviously, Russia's invasion of Ukraine has changed some of the macroeconomic, geopolitical outlook a bit. But, that aside, I don't think much has changed. I think it's more just the valuation. A lot of these risks have always been there. So through much of 2021, even towards the beginning of 2022, we were kind of warning that we thought the sector was fully valued, even slightly overvalued at different points. And we said, hey, there's a lot of rate risk in here. And if this higher rate, positive economic story starts to lose a little sentiment, these things could start to come back down. Some of those risks are starting to materialize. You don't always know, which risks are going to materialize. This time it was something that I would have never predicted. But I think it's just valuations reacting as the risk sentiment changes. But underneath, the economy is still strong. It's just it's hard to tell exactly which risks are going to materialize and when. And so I think the banks react.
So Eric worried a little bit about some headwinds being fully valued, some volatility, I guess. Dave, that may make sense to you. We did hear that when I talked about what Jamie Dimon of JP Morgan said yesterday. He said, look, it's not Russia specifically that is the problem. It's just the Russia-Ukraine, U.S.-China trade. These are big events, economic relationships that could have geopolitical reach now for the next decade, he was saying. So it's not just today. What are your thoughts, Dave, on the group?
Well, you're absolutely right. We're a global economy. If you look at the S&P 500, over 30% of the S&P earnings come from outside the United States, right? And these banks that we're talking about, the JP Morgans of the world, the Wells Fargo, the Citi, et cetera, Goldman Sachs, these are global players, right? JP Morgan talked about, Jamie talked about that they have some exposure over to Russia and over in Europe. It's going to impact. And market volatility does something else. These banks make money on IPOs. And we've clearly seen in the first quarter the IPOs slowing considerably. So analysts are trying to revise their numbers, right, as fast as they can. Deutsche Bank came out today and was the first bank that really came out and said, hey, we forecast a major recession in the US because of the yield curve inverting. These things cause risk. So we need to be aware that all of us see interest rates at 5%, mortgage rates at 5%. All of us see interest rates going up. The Fed is way behind the curve with inflation. So we see interest rates in a year a lot higher than it is today. We know that that makes a possibility for banks to make more money, but the yield curve has to steepen. And we really haven't seen. We've seen very, very steep in the front end of the curve, and then the back end of the curve extremely flat, even inverted from 2 to 10 to 20 to let alone 30.
Right, right. Okay. So, and I appreciate that you mentioned the forecast there from Deutsche Bank too. Really, just some tough words there when you hear the word recession. That spooks folks. So, Eric, which names would you consider first as an investor? You know, what would you say? Should anybody get into the banks at any time? What should they look for? Is it the big banks? Is it the regionals? Is it fintech? I don't know. Or is the whole group just sort of overvalued and you're very much in a wait and see mode? Eric.
Yeah, so banks are off roughly 20% from their highs in the past plus. So they're not, I wouldn't say they're overvalued anymore. In fact, they're starting to trade slightly below our fair value estimates on it. Okay. So they're not super cheap. You know, you're still playing with some rate and economic risk, but they're not as high as they used to be. And so in this context, we're telling people the ideal is you want a bank that has low rate exposure, ideally, and a cheaper valuation. So there are a couple names we've highlighted. One, only for investors that understand what they're getting into. It's not a pretty story, but Citigroup actually fits the bill. Unfortunately, they have the largest international exposure, but they have the lowest rate risk exposure, and they are very cheap. You have to understand the time constraints you're dealing with, the time horizon risks, and turnaround risks. That's one. Among the regionals, we've also been highlighting First Republic. That's one that does not have a lot of the franchise issues that Citigroup has. If anything, it's a strong franchise, fastest growing under my coverage, also low rate risk. So I think that's the way to play it now, while also keeping in mind just managing exposure to the sector, understand that risks can materialize.
Right. All right, so Citigroup and First Republic. Dave, same question to you. I mean, are there names that you would buy into now, or which ones are you getting ready to buy into when they're ready to do so?
Well, I think it's a great question. And Eric puts well, I mean, you know, Citigroup would get a pass in my book. They had a lot of issues, but they've recently sold off some of their consumer banking business. They've reduced some risk there. But risk to this. And we are in a very volatile area of the market, and you have to look at downside risk of all of these firms. And if you're looking for something that doesn't have any downside risk, maybe there's nothing here, right? It's like buying a horse. I don't know if you can get a perfect horse, right? There's always something wrong. You have to determine what you can live with. We can live with JP Morgan. We like JP Morgan from a standpoint.
Okay. Oh, JP Morgan. Okay.
Yep, we like that. We like Citi, and we would stay away from Wells Fargo. Wells Fargo still, they're just dealing with a lot of turmoil within their C management group. I don't think they got everything squared away from their problems. So that's one we'd probably avoid. We'd probably lean towards JP Morgan and Citi.
Thank you both. Wonderful to chat with you. I think this was a great conversation to have ahead of next week's earnings so we could be a little more realistic. Eric Compton, Morningstar, Dave Hardin, and Summit Global Investments, thank you. Thank you, friends, for joining me here on Trading 360 every single weekday at 11 a.m. Join me, and then I'll see you at 2 p.m. Eastern for the watch list. I'm Nicole Petalides. Fast Market is next.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock, takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Good afternoon, traders, and welcome to Fast Market. I'm Tom White, and we've got a great show lineup for you today, including discussions and example trades in Home Depot, TJX, and also UPS. Now, 2.5 hours into the trading day, stocks are falling as traders weighed hawkish Federal Reserve commentary and a potential ban on Russian coal by the European Union, increasing global tensions over Moscow's invasion of Ukraine. Fed Governor Lael Brainerd said the U.S. Central Bank will continue to tighten policy methodically and shrink its balance sheet at a rapid pace as soon as May. The 10-year Treasury yield rose for a third straight day and a 3-year high, with the spotlight remaining on inverted yield curves that may signal an economic downturn. Now let's take a look at the four major indices, which are all deep in the red, led by the NASDAQ 100. Which is down 1 3/4%. The S&P 500, the benchmark, down 0.7%. Dow Jones Industrial Average was bouncing between green and red, but now down 0.25%. And the Russell 2000, the small caps, down nearly 1.4% on the session. But to help me break down this market action, let's bring in my co-host Kevin Hinks, and also joining us today is Sean Cruz, a contributor on the network. Welcome to the show, Kevin. Welcome back, and welcome back to me. I haven't seen you for about, it seems like about 2 weeks, so I'm going to go to you first, get your market take here. You know, the markets were basically hovering around the flat line. We had some positive data today, but then you hear commentary out of Brainerd today, the Fed Governor Brainerd, and that's probably about as hawkish as I've heard her comment on the economy and the potential for shocks as far as rate hikes.
Yeah, she came out with comments, you know, not far after the market opened this morning, and they were extremely hawkish. I have them all right here. She talked about, the one that really got me was rate hikes and balance sheet runoff to create a more neutral Fed policy. So she's talking about, you know, accelerating the runoff of the balance sheet. She's talking about raising rates potentially at every meeting was part of her comments. And so I think the market, bonds and notes were already down before she spoke. So yields were already rising this morning. That just accelerated these on the downside, weakened the overall market. You can almost see to the minute when her comments came out. But I've got a bullet point here of about 12 comments, Tom, that Lael Brainerd made, all of them hawkish, Tom, all of them talking about how inflation is of paramount importance for this group. So I believe that, yeah, some of the data it's all secondary data. I think the Fed minutes tomorrow are going to be potentially explosive in terms of their release. But as a little preeminent strike here, Lael Brainerd came out, Tom, and she was extremely hawkish.
Yeah, guns a-blazing on the inflation front here. And I liked her Captain Obvious quote here: inflation is much too high and is subject to upside risks. Where were you 6 months ago, Lael Brainerd? Because you could have been that hawkish then, too. But, Sean, if you take a look at the Treasury market, it's kind of driving the equity market at this point. You're seeing a big drawdown in Treasuries. Yields are rising to basically 3-year highs for the 10-year yield. Do you think that's going to continue to impact the equity market? Because I don't think stocks like it at this point.
Yeah, and I think it's almost like things are stacking up here a little bit. If you look at Jamie Dimon's annual letter he put out yesterday, he actually said the Fed might need to hike more aggressively than what the market is pricing in. And the market's already really pricing in 50 basis points at the May meeting. They're pricing in some sort of a move higher in rates pretty much every meeting for the rest of the year. So that was already priced in. I think the market's saying, look, does Jamie Dimon onto something here where they might have to get even more aggressive with tightening policy, and that can come in the forms of a lot of the other levers that they have out there that they can pull, particularly on the balance sheet. So I do think it's interesting that the market is reacting to this, because I think everyone was pretty well communicated the 7 or so rate hikes this year, but now it looks like the market is starting to ask itself if we're starting to get some of the more dovish members become hawkish and concerned around what the Fed's going to have to do, does that mean that they might even have to go beyond what is currently priced in, and not just in terms of rate hike, but I would just say in general terms of tightening monetary policy?
Yeah, and you see the crude oil futures now in negative territory after trading above $105 a barrel earlier in the session. So a little bit of risk off here today. You've got strength in the dollar index. Gold taking a little bit of a hit here on the strength in that dollar. But Kevin, I was reading a note this morning, and it was, basically a bear market rally. We're seeing the NASDAQ and both the Dow Industrials are, hitting resistance points at their 200-day moving averages and falling from that. Do you look at the technicals here and say, hey, maybe that snapback rally that we saw over the last 2 weeks might be fading a little bit?
Yeah, well, that's what we're going to learn in the next couple of days. Now, this market is jittery, right? For all obvious reasons, it's jittery. There's Fed minutes tomorrow that, remember, are going to show, even though they raised by a quarter point, it's going to show that James Bullard dissented. So I think the results of the Fed minutes coming out 1 o'clock Chicago time tomorrow are going to be pretty explosive. Now, they've got an extreme amount of rate hikes already priced in to yields and bonds and notes. So, it's going to be all about expectations versus actions. And they're starting to be extremely transparent about larger rate hikes than a quarter point. So it's going to be well choreographed before they do it. And you're starting to get that flow of information that tells me they're going to move more than they think, right? More than we think, and at a quicker pace. I mean, Lael Brainerd's comments were extremely harsh in that sense. So I expect that to start really growing in momentum up to the next Fed meeting. So they're going to get this involved. Now, the question is, what do the markets do on those announcements, right? Because a lot of it's priced in already. So don't just think that rates are going up and stock market's going down. That's not necessarily the case. So that's what traders are trying to figure out right now. What is this new market that we find ourselves in? Raising rates, right? Taking out all the stimulus that was in the market. What does that mean for economy that's still putting out good numbers, guys, in terms of economic data? So that's what I think traders are wrestling with today, guys.
And Sean, I was trying to go over the sectors that are doing well. You see the 10-year yield there getting close to 2.56% to the upside, just off of session highs for the 10-year yield as it continues to rise. If you look at the S&P 500 heat map here, I look at this and I'm like, okay, the S&P 500 is down pretty significantly today, down about 0.65%. But then I look at healthcare leading, consumer staples leading, utilities leading, real estate, financials doing okay, but the big banks are not. This doesn't look to me as a equity market that is getting led by the right sectors at this point, at least in today's session.
Yeah, I think so. This to me is really two things playing out, and that is that the traditional concept that equities are a good place to be in inflationary environments. You'd rather be in equities and fixed income. So that you're seeing, okay, so we're going to go with that case. All right, I want to be in equities, but then, well, where do you want to be in equities? And it looks like now they're looking at just more of the traditional defensive sectors. But one thing with the big banks moving lower, and what that indicates, you look at JP Morgan, Bank of America also down. That to me indicates that there's a little bit of a concept here of a slowdown in economic activity. So the inflation sensitive areas are moving lower, especially when you look at the information technology, what that means for higher rates. But seeing the banks moving lower, the big diversified banks, to me that indicates a little bit of a moderation. At best, it's a moderation in terms of what this means for the economy with a Fed that right now the market is expecting the Fed to be at 2.5% to 3% on Fed funds by the end of the year. It looks like they're saying that might actually really have a significant impact on the economy.
Yeah, Kevin, we've got the big banks up there all down pretty significantly. Even with interest rates rising, you would expect the opposite, right? But Piper Sandler comes out with a note on a bunch of the major banks here and basically is stating that, ahead of earnings, remember, earnings starts next week here. Is this trying to get ahead of what we potentially might see come earnings that, hey, this analyst is cutting his price targets because there might be some commentary on these financial reports that aren't going to be positive for the stocks?
Yeah, I look at the heat map and you look at rising yields and lower bonds and notes, and normally that reaction is financials higher, real estate and utilities lower, right? Because they carry more debt. It looks like a bizarro heat map here. Why are financials soft and utilities of all things, right? Which have big debt and need to constantly refinance that debt, and real estate. So yeah, there's some strange reactions to these rates higher this morning, Tom. But a flattening yield curve takes some of the energy off of higher yields for financials. So we'll see how this plays out. But yeah, there are some head-scratching reactions here to the higher yields today, guys.
So, Sean, another area, we're seeing the financials coming under pressure due to those price target cuts out of Piper Sandler, but at the same time, rising interest rate environment typically supports those financials. But some of the other areas, I just got back from traveling. The airports are full. Carnival Cruise Lines comes out with this report that they had their best week ever for bookings. And if you look at the price of flights, because I'm trying to, fly again somewhere in a couple months, the prices of flights are about 3 times what they normally were at the end of 2019 and the early stages of 2020. I know you travel quite a bit. Kevin just got back. I mean, the prices on hotels, travel, rental car, airline flights, it's just astronomical. It's got to be denting the consumption figures that, a lot of people expect to remain pretty solid because, higher energy prices, everything else is going to hurt the consumer. And we've already seen the savings rate pull back here a little bit. Your thoughts on the travel industry as a whole and the ability for the consumer to continue to support it at these record levels? Because I know everybody wants to get out there and do something.
Yeah, and I think that's going to be one of the key items is they're passing through the cost, clearly. That's why you're seeing ticket prices going up the way they are. But the question is, how much does that actually impact demand? The one thing I would say, and I talked about this morning with Oliver, was if you look at what a lot of these travel industry companies have done over the past few years, they have optimized their businesses in almost every way possible. They've been modernizing their fleets. They've been cutting down on the low profitability routes that they have. So they're running pretty lean and very efficiently. So I think that might be helping blunt some of this a little bit, but it really is something we're going to find out just how sensitive the consumers are to some price increases. And at some point, there is going to be a point where you cross this threshold of you start really taking out massive swaths of your potential customer base with some of these price increases. And yeah, I was looking at booking some flights, and it is at least 2, if not 3 times more expensive than what you're used to seeing. And that might make some people a little bit more hesitant to go ahead and book that travel, and that would be bad for hotels and a lot of the other industries that rely on a lot of tourism as well.
Yeah, I think traffic on those travel websites have picked up, but I don't know how much booking's being done on those travel websites, because you look at the prices and you go, hey, maybe they'll go lower tomorrow or the next day, and they don't, as capacity's been cut across the board. But Kevin, we got some positive economic data this morning. ISM PMI rebounding from probably the lower numbers that we saw in February due to the Omicron variant. But what was your takeaway from here? Because I think I read, as far as PMI goes, it was the 20th straight month of expansion, so we still are in that expansionary territory, despite maybe all the inflationary headwinds.
Yes, a little bit of unexpected strength out of some of the PMI and the ISM numbers. International trade in goods, a little bit bigger of a deficit there, negative 89.89 billion. But remember, this is all secondary data. I don't think the markets reacted very, I thought they were all within a range that didn't make the market really react. I think the market today reacted to Lael Brainard's comments. I think there's some jitteriness ahead of the release of the Fed minutes. I think that's the big data point of the week, frankly, guys, is the ensuing response to what we'll see in the release of the Fed minutes. But this market had a great day yesterday. It was starting off a pretty mild, moderate trading day today, just soft on the downside, and really picked up speed when Lael Brainard's hawkish comments came out. So I think the economic data that came out was not real far from being out of line. It was pretty in line with some of the expectations, slightly better, which is good for the overall economy. But that being said, this market right now is reacting out of Fed minutes tomorrow, anticipation of that, and Lael Brainard's comments today, guys.
Yeah, definitely. And I think if you take a look at some of the components in here, Sean, it talks about inflationary pressures, but it doesn't seem to be hitting the numbers as they continue to expand as far as contract, and we haven't seen that. We've got some numbers from overseas that were actually pretty positive, minus Russia, due to the Russia-Ukraine conflict. But one of the stocks I wanted to kind of talk about today, because this is all about the consumer and spending, and it's discretionary spending, and that's Home Depot. This stock's down about 26% so far this year, off severely from highs that we saw just about 4 months ago, Sean. And if you look at the technicals, it's below its 50, it's 200-day. It's got a death cross over the last few weeks. And that's Home Depot back down to 305 after hitting all-time highs of $420 just last December. Sean, your take here on Home Depot, is this a barometer or a canary in the coal mine for the consumer, because they just maybe don't have the money to spend that they did in 2021 and 2020 coming out of the pandemic, where, hey, now we're making decisions that, hey, we're going to travel instead of buying stuff for our house that's already full of stuff we don't need?
Yeah, I mean, the question, I think, for Home Depot will be, if you look at it's sort of established, it's bounced off that 300 level twice, so it looks like it's trying to establish some support there. But the reason why that can always change is if something new comes in where the market seems like it's priced in quite a bit of negative news here, coming from 420 all the way down to 300. That's a pretty big just complete destruction there in terms of just expectations moving forward. So the question is, do you start to see what we're seeing in some other names as well that have had a very similar chart where you have analysts come in and say, maybe now there's the multiples or the valuation looks like you could make a case here. The question will be, are we going to get maybe a whole nother sort of second round of inflationary pressures or whatever that might be, that then start hitting demand for people going out there doing home repairs. And the other thing here, if you're looking at Home Depot or Lowe's, one thing they talked about over the past couple of years was getting into the professional market, and that is getting those contractors to get all the supplies, materials they need for that job coming to Home Depot or coming to Lowe's. That was one thing they were looking at going into, and you have to ask yourself, is this not only going to affect someone who's trying to do-it-yourself project, but is this also then going to start affecting demand for people who are looking to hire a contractor to come in and upgrade a kitchen, a living room, whatever that might be, put in a deck, anything like that? Are they going to say, you know what, it is so expensive right now, not just for the labor, but now also for the materials. When we thought it couldn't get any more expensive, it did. If that's going to start clipping demand for those contractors, which would also be another area that would really hit these companies, because those professional customers they have usually do a lot of bulk purchases for larger projects. That might be the one thing to look at here, if there is not just the retail customers, but the professional customers as well.
Great point there by Sean. Kev, 5% of their customers are contractors, right? Plumbers, electricians, whatnot, but 50% of the revenue comes from that group, so pretty substantial there. But when you look at this space and the inflationary pressures, I think that have been putting pressure on this stock. Yeah, it's sold off about 27% from those all-time highs that we saw just before the start of the year, is the fact that, hey, interest rates are going up, so you're going to pay more for your mortgage, right? Maybe you're not going to take a home equity loan out to help fix up your house. And the comparables from 2020 and 2021 are going to be difficult to match, even though they had really good, solid years, right? The growth was astronomical for them on a historical basis. But when you look at this, is that this stock, that canary in the coal mine where, hey, March traffic hasn't been good for these stores. That's not good going into their big sales season, which is the spring, and that's why you're seeing the stock under pressure over the last several months.
Yeah, it's tricky, right? This is one of those names where, with the evolving U.S. economy, you used to say a lot of good things about Home Depot. Mm-hmm. It's got a 2.5% dividend yield. Well, that was a lot more attractive until yields got to 2.5%. Right. That makes that less attractive, right? It's got a 19 PE. That's fairly attractive for this sector, but this stock has been discounted, like Sean said, about 25% off its highs. It's back to, I can draw a pretty good line here. It's back to some pretty significant, just under 300. There's some pretty significant support down there from a couple years ago. Guys, went the last time it was down here. So, this is the constant argument or discussion that a trader must have with himself. What's the next move in Home Depot? Because this move of 25%, it's already happened. Everything that we're seeing now in consuming and digesting in Home Depot is in this stock. What's the next move? Is it back up? Remember, you don't need it to go to $420 to have a really good run here. If it went from $3 to $350, you'd have a great run. So now the question is, what's the next move at Home Depot? Because a lot of information is already in this name in terms of demand pulled forward and higher inflation prices and people maybe doing less work on their homes. A lot of that's in this stock now. The question now is, now what, guys?
Yeah, you wonder about those margins and the pressure that they might come under due to the fact that they've got raising their wages for their employees, which is going to put pressure. The cost of these products to get them in is definitely going to maybe start to dent those solid margins that they've had over the last several years. But Kevin, if you have that chart of Home Depot up, can you bring up the 3-year chart? Because I think this is what people forget about.
Sure.
You look at that 1-year chart and you're like, hey.
That's what I was looking at, Tom.
Yeah, it's still
look
up.
At this.
It's up.
It goes all the way. Look at that level right there.
Yeah, it's up 50% from 3-year ago levels. I mean, that's a pretty good run for a stock, even though it's pulled back pretty significantly due to the forward pull up of from the pandemic spending, Sean. But when you look at this, Kevin's made some great points here. It has pulled back, but that doesn't mean this 300 level can't hold. But if you look at this from an example trade point of view, because implied volatility is elevated, RSI is getting below 40 here, so maybe oversold, but maybe some more room to the downside. Your thoughts here on an example trade here in Home Depot?
Yeah, I mean, I think when you're looking at some of these moves and you're asking yourself, where do I either want to try and pick a bottom where I think there could be support, or do I want to maybe say, this is a level it's going to stay at and I don't see it recovering anytime soon. There's different ways to approach that trade based off what your sort of thesis is. But if you want to maybe look at that 300 level and say, you know what, it's served as support twice, maybe everything is all the way priced in here, if that's sort of your thesis on the future stock price, then an example of a trade you could put in place would be just going out, not to this week, but next week. So keeping it shorter in duration, because these things can really move around as new data comes into the market. Also, once we start getting into earnings season, I think even if for companies that aren't reporting earnings, you might see them reacting to some of the more up-to-date news we're hearing from companies that are reporting. But cutting that down a little bit, so looking out to next week, maybe selling that 300 put, and then just in case you are wrong and the worst isn't priced in and this thing takes another leg lower, a significant leg, you could look at buying the 295 or the 297.5 put to define your risk. So you're not going to sit there, and I think, Tom, we knew a trader years back who shorted Home Depot, I think from like $20 all the way up to 80 or 90 on the stock because he swore the top was coming tomorrow for I think about a year. But when you're looking at this, defining your risk lets you avoid that I swear I'm going to be right tomorrow mentality. You're setting your risk and reward and your time period on this trade from the outset. So by the end of the next week, you'll have a better sense of how this trade is going to play out. But no matter what, when this trade expires, these options expires, you can move on to the next thing, and you'll be out of this trade, or you can choose to put on something else very similar, whatever it might be.
All right, so Kev, you've got the 290 short the 300 put in the April 14th, the monthly series that expires in just 9 days on this one, because remember, expiration next week is on Thursday, not on Friday, due to the Good Friday holiday. So selling the 300 put, buying the 295, you're collecting roughly about $1.20 on that spread. Go ahead and break down that one first here, Kev.
Yeah, I put up both of Sean's trade, the 295, the 297.5. One's taking in about $1.18 credit, the other one about 65 cents. And you can basically do the math on what is a better return, right? If you doubled the 297.5, that would be about $1.30 in return, right? If you did two of those versus one of the 300 and 295. So a little bit of added value there if you were to do two of the smaller ones versus one of the largers. And what does it have to do? Size of your account, risk tolerance, overall view on Home Depot. So both of these are collecting data, or theta. Both of these are risk defined. Both of these are medium to high probability. And so Sean has controlled his risk here. The risk is obviously 118 minus $5 on the bigger spread. It's 67 cents minus 2.5 on the smaller one. So there's different trade-offs for both spreads, but this is a moderate way to short a put vertical, or a little more of a big boy spread that Sean has, but very short in duration, only 9 days, guys.
Yep, and if you collect $1.20 on the 300 295, you've got about $3.80 at risk. Your break even $298.80 on that one. If you collect $1.20 on it, on the other one, which is only $2.50 wide, if you collect roughly about 65 cents on that, you've got less risk on it, but you're going to collect less total credit on that. Your break even about $299.35 if you can collect 65 cents. So you do have some downside risk on that one, about $1.85 in risk on the $2.50 wide short put vertical, while $380 risk, $380 in risk per spread on the 300 295 straight short put vertical. So two good examples to cover here for a neutral to bullish stance using that $300 price, which has become an area of support, which doesn't mean it won't in the future, but it has bounced off of there 3 times in the last 52 weeks. So good look at a couple example trades taking advantage of positive time decay and short Vega. All right. Thanks to Sean Cruz, a contributor on the network, for joining us. But coming up after the break, Kevin and I will be joined by Megan Brantley from Likefolio for discussion on retail stocks, including TJX, which got downgraded today. Fast Market will be right back in about 2 minutes.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watchlist. When the default list appears, select the name box, then Create Watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watchlist, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Welcome back to Fast Market on the TD Ameritrade Network. I'm Tom White, joined by my co-host Kevin Hinks. But let's bring in our next guest for our cash tag segment. That's going to be Megan Brantley, the Vice President of Research at Likefolio.com. Welcome to the show, Megan.
Thanks for having me, guys. It's good to chat with you.
Yeah, you too. So we're talking retail. We just covered Home Depot, which is a stalwart of the retailers. Today we got a couple downgrades in this particular space. Ralph Lauren got downgraded, and also TJX. But what kind of consumer sentiment data are you seeing? Are people turning away from shopping for goods? You've got a high-end retailer like RL. You've got a lower to mid-tier retailer like TJX. Are you starting to see a slowdown, or is the consumer still on fire at this point?
So whenever we look at this, we're looking every single day to say, okay, when will these pressures that we keep hearing about start weighing on the consumer? When is there going to be this switch in consumer behavior when it comes to spending, and what areas is this impacting? And so just on a broad scale, when we look at these larger macro trends, we see inflation fears at all-time highs. We see gas price concerns rising. We see a lot of economic pressures building, or at least weighing on the minds of consumers. But then when we look at actual spending, we see, spending still occurring. We see mentions of consumer shopping and buying new clothes rising on a year-over-year basis, and continuing to rise even on a quarter-over-quarter basis. I think it's interesting whenever you start to look at even, utilizing credit cards. We have maxed out credit card mentions up about 9% year over year. In contrast, we have people talking about paying off their credit cards down about 45% year over year. So for us, I think this shows us that the consumer is still spending. And I think that for us, long term, term, we're wondering, okay, is this something that, the consumer is going to continue spending, or is this an instance of pent-up demand where, consumers are excited to get back out there, they're traveling, they're going to concerts again, they're going out to restaurants again, they're, going to weddings and social events, and they need new clothes and they need new things, and so they're spending on these things, but, is it sustainable? I don't know, but at least so far in our data, we're not seeing consumers reaching a breaking point yet. So I think that that's really interesting because, based on what you hear and what we're seeing with inflation and gas prices and things like that, you would expect this stress to begin weighing. We're just not seeing that quite yet in our data, at least. And I think another thing that's interesting is you made a good point about, Ralph Lauren and TJ Maxx. These are two very different companies in terms of the, higher end or lower end. And we really see two different behaviors from consumers in these different groups whenever we look at, retailers that may or may not be perceived as higher end versus retailers that may or may not be perceived as lower end. And, this almost feels counterintuitive whenever you look on this chart, because where you want to be is the top right. You want to be that Revolve, which sells, higher fashion brands, the Ralph Lauren, the Abercrombie and Fitch, these are higher ticket spends whenever you're shopping here versus, say, a TJ Maxx, a Burlington, a Ross. And you would think as consumers start to tighten their wallets that you'd start to see these discount retailers perform better. But so far, at least in our data, we see consumers who are splurging more on the higher quality products versus the lower quality products. So, I don't know if it's a case of, perhaps the dried up stimulus spend is impacting the shoppers that would traditionally shop at a TJ Maxx or a Ross or a Burlington versus shoppers that would traditionally shop with a Ralph Lauren. But we are starting to see a divergence, at least in our data, for the retail preferences of the consumer.
Megan, when we look at a company like TJX, and they've also got Home Goods, they've also got Marshalls, that's kind of the treasure hunt look, right? Where Ralph Lauren, you could order online and it's their newest clothes. You have to go search at TJX. Do you think that's what's hurting it? Or is it the discount version that's getting hurt? What do you think is hurting them? And then I don't know if this tags me as old or out of touch or a nerd, but I don't know what Revolve is, Megan. Could you tell me what is Revolve? I know all these other ones, Megan, but what is Revolve? I don't know even what that is, and it's the coolest, best, most high quality, and I don't know what it is, Megan.
So I'm going to go out on a limb and say if you were to ask Jenny Horn that she would know what Revolve Group is. This is a traditional e-commerce space. I can say anecdotally, this weekend I had a birthday celebration for friends, and we went out and we were going out to eat at restaurants and whatnot, and girls were talking about they bought the top that they were wearing at Revolve, that this was an online purchase that they had made, but not just online, but a mobile purchase. So I do think that this is an example that kind of highlights maybe perhaps why TJ Maxx is underperforming, in the fact that, you do have to go into the store. You do have to search through a lot of things. When we look at mentions, like, I don't know if you noticed on that where TJ Maxx was located on happiness, but, it's a little bit lower from a happiness perspective versus these peers. And part of that is because sometimes consumers report that the stores feel cluttered. Sometimes consumers report that they couldn't find necessarily what they needed. I think that this is more of that seek and find discovery element versus being able to be on your phone and search through inventory and pick out exactly what you need for an event or for something that you have coming up. So that could be an area where these names like Ralph Lauren, these names like Revolve that have this online presence, that is a nice, another platform or another way that consumers can connect and shop that TJ Maxx just doesn't have.
And that brings up a good point here, Megan, because a lot of the retailers like Ralph Lauren or wherever TJ Maxx gets their products from, these are like extras, right? Inventories were low, supply chain issues across the board. They didn't have product to probably give for TJ Maxx and some of these others to resale. But I kind of wanted to focus in on the TJX full company chart that you guys sent over, where you see the sentiment just fallen to the wayside. The stock's still doing okay compared to what kind of data you're seeing for TJX.
Yeah, so whenever you guys said, you want to talk about TJ Maxx and Ralph Lauren, especially, in light of these downgrades, For TJ Maxx, we could kind of see it. You can see this green line. These are mentions of consumers who are actually talking about shopping at TJ Maxx, talking about shopping at HomeGoods. And you can see that growth is declining on a quarter-over-quarter and year-over-year basis. So, we're definitely starting to record some weakness. And especially whenever you look at it on a chart and you compare it to other names that, maybe not all names in this retail space are created the same. So for us, if we were to calculate an earnings score on TJ Maxx, we are technically neutral in terms of just the slope of that line is continuing down at about the same rate that it has been. So we are technically neutral, but I can certainly see the reason for a downgrade, especially amid some of the pressures that you talk about, like maybe there is less inventory to choose from. And, we do start to see that show up in mentions. We do start to see that weigh on happiness when consumers can't find what they're looking for, or they don't feel like there's as large of a selection for a company like TJ Maxx. But in contrast, if we were to look at Ralph Lauren, you can see that purchase intent line, that demand growth is actually building on a year-over-year basis. So if we were to put an earnings score on Ralph Lauren, for example, ours right now would be a 66, which is pretty positive. So, we saw that they had a really nice holiday season, and mentions are still elevated, especially from where they were a year ago. So, definitely a tale of two stores with these two names for sure.
Yeah, I like the sentiment data on that. And just surprising to me, you'd think with all these inflationary pressures that TJX, more people would be going there. But to your point, maybe they're just not finding what they want. Maybe inventories are low because they rely on other retailers to get that second chance to sell them if they have over inventory, or maybe the seasons are changing. All right, great stuff as always, Megan. Appreciate it. Have a great day.
Thanks for having me, guys.
All right, that's Megan Brantley, the Vice President of Research at Likefolio. But Kev, let's get to TJX and look at this one on the downgrade. They're more positive on RL than they are on TJX. It's almost like, she said that even with the downgrade today, their data's been showing that consumer sentiment, positive consumer sentiment on TJX has been falling for the last several months. So kind of going back to, hey, they're ahead of the game here. How do you want to look at this for an example trade in TJX?
Yeah, this is tricky because none of this data screams very positive things about TJX. But, Tom, and this is a big but, this stock is down 21% since early January. So how much of that is already discounted in the price of the stock? And, if I even go out 3 years, Tom, with a weekly chart in TJX, boy, this takes me back a long way here before, it's discounted basically to October of 2020 is where this stock now has moved back to. And that was, during the recovery of this. So it's tricky. It appears to me that Ralph Lauren has better numbers overall than TJX, but TJX has got what's better, Tom, in a recession. If you're looking towards a recession, it's probably going to be the discounters that are going to do better than the full price brands like Ralph Lauren. So it's tricky. My biggest problem with this is all the data that we just received from Likefolio looks like it's priced into the stock already. Mm-hmm. So therefore, I'm reiterating what I said at Home Depot. What's the next move in this name? It really firms up down here or right around at or slightly below $60, Tom. So that's kind of what I did. If you're going to buy the dip in this name, maybe do something there. If not, if you don't think that, I think it's either a very modest diagonal, play it maybe something like that. And like I said, this is an example trade, but this is a ability to buy it down at a level where it looks like it's firming up here, Tom. That being said, my commitment to this is very modest at best. So what I did, I went out to May 13th expiration, and then I bought the 60 call, which if you look on the chart, Tom, it spent a lot of time at or near $60. It hasn't spent a lot of time below there over the last several months. It's touched it several times. So I bought the 60 call all the way out till May, and I sold not this week, but next week's 63 call, because this is surprisingly a very low premium name. Not a lot of premium in some of these options, Tom. So the option to sell a put vertical not nearly the risk reward. You're not getting enough premium to even make that worth it, Tom. So that means you got to look to something in the calendar family to get it done. So yeah, I did the 60-63 diagonal, Tom. May 13th, April 14th. My conviction this trade is modest at best.
Right, and you're avoiding earnings. Earnings are on May 18th. So you're going to avoid
May 18th,
that.
right.
Yep, you're going to avoid that. You got 38 days till expiration in the May 13th weekly options that you're buying here on this one. And break even is going to be just below 61 on this type of trade. Now, the way that I look at this type of trade, Kevin, is you're outlaying about relatively about $2.50, so $250 in risk per spread, as opposed to buying the shares. It's basically just over a month in duration on that. You're selling the near-term April 14th monthly options that expire in 9 days against it. So you're not outlaying a ton of capital, but your potential return is not outsized either on this, where you just expect it to maybe continue to bounce off of the 60 level, go up and towards 63, maybe higher. But short-term trade on this type of trade, the apex of profitability, of course, is at or near that 60 strike on this one. Your final thoughts on this this potential example trade here, Kevin, that's basically bullish, but you don't need a big move.
The decision that traders are going to have to make, Tom, is how much of the data that we're seeing in the economic and interest rate data that we've seen is already priced in to a bunch of these stocks. You've got Home Depot that we just talked about down 25%. You've got TJX down 21% since the beginning of the year, Tom. So that's the question that investors have to make right now.
Yeah, 4,500 stores that they've got across all their brands. All right, good look at an example trade in there for a basically neutral to slightly bullish type of take here, as opposed to buying the shares. A little trade-off there. But coming up after the break, Kevin and I are going to take a look at UPS, which was downgraded this morning. Fast Market will be right back after this short break.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on tdameritradenetwork.com and all your favorite streaming services.
You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
Ben Lichtenstein here with your TD Ameritrade Network Futures Market Update. A sharp move lower for stocks and stock index futures products in reaction to comments from Fed speakers. We heard from Federal Reserve Governor Lael Brainerd, who yesterday said inflation's much too high and she expects the balance sheet to shrink considerably more rapidly than in previous recoveries today. She commented on how she's watching the yield curve and other data for suggestions of increased downside risk to activity. Esther George, president of the Federal Reserve Bank of Kansas today, said 50 basis points will be an option to consider, and conditions easily argue for going faster than before. The Nasdaq's back below 15,000 and leading the way to the downside, currently down 1.85%, with stocks selling off. The dollar's getting a bit of a lift, oftentimes seen as a safe haven type trade. Ukraine's President Volodymyr Zelensky addressing the UN Security Council today. The possibility of further sanctions from the EU and the US has investors seeking safety from riskier assets, and the dollar oftentimes the recipient of that. We also have rates on the rise, helping the greenback above 99. Today it's up almost 0.5%, with the TNX back above 2.5 and the 5-year yields, the FVX at 2.71. This has been your TD Ameritrade Network Futures Market Update. Now back to Fast Market.
Welcome back to Fast Market. I'm your host, Tom White, along with my co-host, Kevin Hinks. And stocks at session lows as we speak, with the 10-year yield, as we mentioned before, at 3-year highs. But Kev, the next stock we wanted to take a look at, another stock that got downgraded today, is UPS. Now, this stock's had a decent run, down about 8% so far this year. But going back to that Home Depot chart that we looked at on a 3-year basis, UPS is still up over 70% from 3 years ago, those levels that we saw. So it's had a great run. It had a great earnings event last quarter, Kevin, spiked higher on that, but now it's filled that gap back to the downside here. Your thoughts on UPS on this downgrade today?
Yeah, a little bit of a head scratcher to look at what UPS is. Came out after their last earnings report. And does anyone think, Tom, that online shopping is not going to continue to expand in terms of contract?
Right.
I don't get the long-term view. I mean, now, they downgraded it from outperform to peer perform. So not a real, strong downgrade, but they took it more to neutral. But you're right, Tom. This stock is down 16% off its highs, from 233 to 196. So another stock that has been heavily discounted, and probably is something that, it's still a relatively healthy dip in this name. So the question is this a bigger picture for the overall market, or is this a dip that you can look at in UPS? I have no idea, Tom, but I can tell you this. A 13 PE for a company like this is relatively inexpensive. A 3% dividend yield, even at a 2.5 on the 10-year, this is still an attractive dividend yield, Tom. So they've got a lot of things going for them, and the overall economy migrating towards online shopping and towards delivery is another reason why long-term this is probably a company that's going to do okay. Valuations, well, we can argue that, Tom, but all things considered, yeah, this is a pretty healthy sell-off off a pretty good earnings report not very long ago, Tom.
Yeah, just over 2 months ago on that. 25 million packages a day, Kevin, in 220 countries. They just signed up a partnership with Jumaya in Africa for that last mile delivery there. So definitely some things on the that are looking up. They continue to raise their dividend. As you mentioned, 3% dividend yield. We all know that those aren't guaranteed, but they've continued to raise their dividend year over year for this company. But you make a good point that if their margins had increased, that earnings report was a surprise to the upside. It seems like it's outperforming as far as stock price goes Federal Express over the last couple of years as it's navigated and reorganized maybe a little bit better. I think that's what a lot of analysts are looking at in there. But to potentially take advantage of that dividend yield, Kevin, that you mentioned, if you want to get long UPS, I looked at an example trade that does take advantage of that. And I looked at a simple covered call, Kevin, where for every 100 shares of stock that you buy, you sell a call against it. In this example, I'll look at the May 110 strike or 210 strike call on this particular example. For every 100 shares of stock that you buy, you go out 45 days till expiration. You're going to capture that earnings event. But the 210 strike call, Kevin, in this particular stock still has nearly $4 in option premium on it, and it's still about $13 out of the money to the upside. If you do this covered call, you're paying roughly about $194, right? So that's where you're buying the shares, because you get to offset some of the cost of the shares that you're buying by selling that upside call to the upside. If you pay roughly $194 on this one, Kevin, we'll just call it $194 just for rounding purposes, because it is an example trade. That's going to be your break even on this. This looks like a cash secured put, but you get to collect that dividend as long as they're paying it for every 100 shares that you buy in this particular stock. Kevin, now the risk is big, right? It's just like buying the shares, being offset by the cost a little bit on that short upside call. But your thoughts here on this type of trade, where it's almost a paid to wait type of strategy, Kevin, if you get to collect those dividend yields and also creating yield by selling upside out of the money calls.
Yeah, this has a similar profit graph to a cash secured put. The reason you would choose the covered call over the cash secured put is the dividend, right? You wouldn't get that on a cash secured put. You would get it here, Tom. So yeah, you've given yourselves, I mean, the May 210 calls trading about just under $4, Tom. Unfortunately, the trade-off is the only protection you have is the premium collected on that. The rest is downside protection on the stock, just like you would have if you were naked long the stock. So you do have a small amount of protection. You are collecting theta on a daily basis. This is a classic fundamental strategy that a lot of people use, selling out of the money calls to overall just collect theta and add to your return on a long-term portfolio, Tom. And at 3% dividend yield, 13 PE, right? You gotta think that maybe with the recent sell-off in UPS that this is a nice place to enter in. I don't know if that's the case, but you've certainly taken it from $233 down to $197, Tom.
Yeah, and you can be a little more cautious on a cash secured put, Kevin. Like an example would be selling that same May option series, going out and selling the 185 strike put. You're going to collect roughly about $5. That would take your break even down to 180. So you could do it that way also. But the trade-off of it, as you mentioned, is you don't collect that dividend on that, but you still have the same risk profile to the downside, but you can lower your break-even point while still collecting option premium because implied volatility relatively elevated. Kevin, if you look at those two types of strategy, do you know, that's one of those lessons real quick. If we can just give our viewers that hey, cash secured put might work for somebody, covered call might work for somebody else.
Yeah, and the difference really is, what's the situation? Why would I use a cash secured put versus the covered call? And the answer is the dividend, right? Because that's the difference between those two. Now, some of that cost of the dividend is embedded in that cash secured put, but really for pure dividend, collecting dividend and collecting theta at the same time, the covered call is really in the whole spectrum of trading options, Tom. Let's face it, this is options 101. It's selling out of the money calls against your long stock.
All right, great example on that, the difference in trade-offs between cash secured puts and covered calls. All right, great discussion there, Kev. That's going to do it for us today here on Fast Market. Stick around, though, right here on the TD Ameritrade Network, as Next Gen Investing is coming up with Alex Coffey and Jenny Horn hosting. Have a great day.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our Income Investing course. In the Income Investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on Thinkorswim for the income investing course and a whole lot more.
Binge watch the market with TD Ameritrade Network.
The dollar, interesting activity.
So now I did some deep research into this.
People are out of the house and engaging with the U.S. economy.
Tune in 24 hours a day, 7 days a week on TDAmeritradeNetwork.com to all your favorite streaming services. You can also take us on the go with our CarPlay-enabled iOS app and our audio-only podcasts. TD Ameritrade Network, available anytime, anywhere, on any device.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on Thinkorswim for the full Options for Volatility course and a whole lot more.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watch List. When the default list appears, select the name box, then Create Watch List. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Happy Tuesday, good afternoon, and welcome to Next Gen Investing. I'm Alex Coffey alongside my co-host Jenny Horn, back with us after a brief travel, or I guess you were just going somewhere here domestically. I think you went to the West Coast, so welcome back, glad to have you, but you brought with you a little bit of red here for the markets.
I know, it's extremely unfortunate because I was paying attention to the markets yesterday because I'm an addict, even though I was on PTO, but I did see things were a little bit higher. Now momentum has shifted since I returned back to Chicago, so not too happy to see it, but not necessarily surprised, Alex.
Yeah, it's been a nice run for equity markets, kind of finding this new back and forth range. We've talked about sort of this tension that the markets find themselves in for the first time, really, throughout 2022. We have a little bit of a two-sided trade, both buyers and sellers, kind of this back and forth action. We'll see if that can continue, but we've got a fun show planned.
Yes, lots to get through. Earnings season is pretty much, I would say, over. We do have some select earnings to report, but we're sort of in that lull period. But still, a lot of individual names to get through. We will go through our upvote and downvote segment. Following that, we will chart and trade our upvotes. And our FOMO discussion today is around Carnival after what they said was their busiest booking week in history. So we will dive more into what that means for the cruise industry coming up later. Then we will preview Levi Strauss ahead of their earnings report, which is due tomorrow after the market close. And our under 30 discussion today will be all things home builders from a technical stance, as well as Credit Suisse initiating coverage on several different home builders.
Yeah, it's a jam-packed show, tons to go through here. Jenny, let's kick things off with upvote, downvote, as always. List of movers. We're going to do our best to narrow it down, but of course, not recommendations or endorsements.
So our first name is one we've covered very thoroughly in the last 2 weeks, I'd say. Not only do they have earnings coming up, but they also have been in the news pending this legalization or federal legalization that there's some mixed feelings about, but that name is Tilray. Now they have third quarter earnings due tomorrow morning, and they are Canada's largest cannabis producer. And really the market will be looking for any signs of how Canada is doing, as well as future plans to expand. Now, what is so interesting is there's sort of what I think of when I think of the cannabis industry, Alex. There's several other names, Canopy Growth, Kronos, but Tilray is one that garners the most attention. But their total revenue as of January in the second quarter stood at about $155 million, with only 42% of that being derived from cannabis. So actually, their distribution revenue makes up about 57%, so more than half of their total revenue, which is something I did not know and found really interesting. Now, more than 75% of that cannabis revenue is derived from Canada, but the company has been actively trying to diversify internationally, which investors are hoping for any update on that during their report. The last quarter, their wellness revenue also was a bright spot, totaling about $14 million. Again, any sort of comparables there will be welcomed, but investors are really looking to see how they can improve their cash flow. That has been the biggest concern for a lot of these cannabis companies, as they have pretty much no federal backing, which then in turn is no banking, right? Like no loans, no funding, and that has absolutely crippled this whole space. So a name definitely worth keeping on our radar.
Yeah, down pretty heavily here today, 5%, 5.5% lower. Market maker move looking somewhere around 80 or so cents. And so for a $7 stock, that's over 10%. So interesting conversation. I'm going to say upvote here on one of our final kind of pre-earnings looks before the banks will kick off the start of the next season.
Yeah, and then we'll be right back in earnings season. See, so it's always earnings season if you believe. But now our next name so Alex, I have this theory that when you're on PTO, there's certain stories that you do not see just regarding the news. I mean, analyst calls, not so much. Corporate earnings, maybe huge economic data. But if you are a stock mover and you can garner national news like Twitter did yesterday, because Twitter was pretty much all I could see. It was Elon Musk and Twitter all day yesterday. So the fact that this got to me even while I was on PTO means it's pretty big news. And we are seeing now Twitter on pace for its best 3-day stretch on record, up 35% over the last 3 days. We saw shares surge today following Tesla CEO, of course, Elon Musk, being named to Twitter's board of directors. He also posted, though, a very interesting poll on Twitter that I saw, asking users if they want an edit button with both the yes and no buttons containing typos, and irony, of course. Now, Twitter's CEO then retweeted Musk's poll shortly after, saying the consequences of the poll will be very important and to vote carefully. Now, I could not hit yes more times, Alex. I want an edit button so badly, only because I misspell and have grammar errors and it drives me nuts. But I do think this represents a bigger transformation on the social media platform. We additionally got MKM Partners downgrading Twitter to neutral from buy with a $49 price target, saying that, well, the stock is up 55% from their March lows, and he's excited about Elon Musk's involvement. He also sees risk and reward as fairly balanced at current levels, and maybe things are a bit irrationally excited right now.
So first off, we talked about this name a ton yesterday. It was our subject for FOMO. So I'm going to say downvote just because we spent a lot of time yesterday kind of talking through this story and looking at it. But, you know, I didn't catch the irony in that poll, the misspelled words. Thought it was just Elon being kind of a goof. But now that you say it, it's so obvious. I don't know how I didn't see that. But I actually voted no on that because I think making people slow down, think about what they're going to say, be more deliberate, make sure there's not a typo, maybe you won't say things that aren't so emotionally charged and they'll be more deliberate. I don't know if it holds that many people back, especially with the anonymous nature of the internet. But I've always thought that the fact that you can't edit it makes it important what you're saying.
That is a really good point. See, that's the other side of it. I was thinking more for myself. I tweeted using the wrong form of there the other day, and I had to delete the tweet. So that would have saved everybody two of basically the same tweets with the wrong form of there. So downvote for today, but a very interesting story. One of the most important stories in the markets today. Next is Domino's Pizza, which is a name I have tirelessly stood up for. Being from Chicago, people love their Chicago pizza. I think Domino's Pizza is elite, but that is just me. Cowen downgraded Domino's to market perform from outperform today with a price target reduction to $390 a share from $480. The analysts cut their earnings estimates through 2024 further below consensus, driven by a disappointing 2022 U.S. franchise opening projection. Now, he remains concerned about Domino's international openings that won't offset the earnings impact of the U.S. shortfall, since international stores have 60% of the U.S. volumes and nearly half of the loyalty rate. Now, Domino's has suffered this year, down about 29% year to date. I do have to say that despite all their different tech offerings and their Domino's pizza tracker, and they're giving you a tip now to go pick up your pizza instead of getting it delivered, doesn't seem to yet be paying off so far this year.
Yeah, but it's kind of a quiet morning here thus far for Domino's. So I'm going to say downvote for that reason. It's kind of just taking this in stride, shrugging it off, down small, outperforming the overall market, Jenny. So kind of interesting to see how quiet it is. But the next list here, the next on the list, it includes Block alongside PayPal on kind of this sweeping analyst note in the payment space. There's some movement going on here.
There is some movement going on, and both of these names were names we kept highly on our radar over the last year, but both have seen some weakness, but not so much equal. I mean, PayPal's down 37% year to date, whereas Square is down only 16% year to date. However, the analyst note reflects an opposite sentiment. Wells Fargo started coverage on both of these names, PayPal and Block, at overweight, with a $152 price target on PayPal and a $165 on Block. The analyst launched global coverage on the payments and fintech sector with a very bullish stance, saying that he sees a $1.5 trillion annual revenue opportunity for fintech companies globally and expects 6% annual revenue growth over the next decade. So he said PayPal is actually the payments leader, currently trading at a reasonable multiple post reset, saying actually that this reset has been overdone and that some of these tailwinds on this company are not being as considered as much as they should. But he also expects share gains in both Square and the Cash App businesses, and thinks the company's investor day in May could be a potential catalyst. He also said he's interested in the long-term crypto aspiration, which is something I think that gives Square maybe a little bit of an edge, that a lot of people look at it as the pure play, or not pure play, but a way to play crypto. We also got a note a few weeks ago how kids, or like teenagers, I guess, are more interested in Cash App lately. But you can't discount scale. I mean, PayPal is the bigger of the two companies, but the worst performer of the two this year.
Yeah, and I'm not sure that there's a world where they both can't exist. It's a ginormous marketplace. In many ways, they're disruptors to the traditional banking system, but also being disrupted at the same time by the digital finance and kind of the decentralized movement that we see taking place in things like crypto. So it's interesting to see how they navigate kind of both sides of that equation. I'm going to say upvote because Block, as we know it as Square, or SQ, the symbol, is such a retail favorite, and for good reason. It's been tremendously volatile, and over time, the last few years, has been a huge winner. And I think that there's a little bit more to explore here.
I agree, and I had to write Block in all caps all over my notes as to not call this company Square, because I've joked before, but until they change that ticker, I just see Square. But to move forward with our upvotes today, those being Tilray as well as Block, not Square. And to tell us more on these two names is Ben Lichtenstein, the host of Futures. So Ben, we will start things off with Tilray, since they have earnings, and they're sort of one of the last earnings to report, really. So tell us your thoughts on Tilray.
Well, I think earnings could be pivotal at this point. We recently saw a nice rally in Tilray up to the $9 level, but since then we've kind of just been grinding lower. The move up was tied to some of the focus on individual pot stocks with the House legislation, again, moving forward, and possibility of federal legalization. Now, this has to go to the Senate here at this point, and it seems like it's going to run into a little bit of an issue there. I think probably that's why we're selling off a little bit. Lindsey Graham, senator from South Carolina, a Republican senator, said he doesn't support legalizing marijuana, and he doesn't really see the value or legitimacy in medical cannabis. Now, you know, one thing that I was looking at in terms of Tilray was the move up we've seen relative to its peers. So, for example, versus CGC, Aurora Cannabis, and, you know, it seemed like it was a little bit overdone to the upside. I think some of the upside potentially, I was talking with Alex a little bit earlier this morning, potentially could have been tied to some of the run-up we'd seen in the meme stocks, for example, and the kind of overzealous type price activity we see there as price gets a little bit overdone to the upside. So this one stood out for me. It's one of the individual names in a broad space of stocks that a lot of attention's been directed to this week, but this one again attracting attention because of the real enthusiasm it showed to the upside relative to the others, and now again kind of limited in terms of follow through to the upside as we're starting to just kind of grind lower here.
Yeah, we've really seen this risk on sentiment for the better part of the last month now going back. And you look at that, Ben, that's very much caught Block in this same group amongst its peers as well. We know its correlation to things like Bitcoin and cryptocurrencies, but these names were all beaten up tremendously. They caught a bid. We don't know yet if it's just a bear market rally or something more, but what are you seeing in Block?
Well, you guys started off the show talking about how, again, we're seeing some weakness here as Jenny comes back from vacation and some of the selling that she brought back with her. Relative to what we saw yesterday, especially, I mean, look at the NASDAQ up big yesterday and then kind of giving back those gains today. I agree with you in many ways, Alex. I think this is tied to the risk on, risk off narrative, a nice run up off the lows from earlier this year. But again, kind of limited to follow through right now. It's just not really certain at this point as we're waiting on some key factors right now. For example, China, you've got 35 million in Shanghai, which are on lockdown here, and New York, talking about numbers on the rise and potential to bring masks back. I mean, that's nothing, something that nobody wants to see. But Square, you know, established a nice base, and it's at this point here that the bulls will have some heavy lifting to do. Put it this way, the bulls for Block don't want to see what's playing out here in terms of Tilray in a very similar pattern here right now structurally. So we'll talk about that when we take a look at the charts. But again, the bulls in Tilray were unable to do the heavy lifting. In terms of Square, in terms of Block, they still have the opportunity to. So both in a very similar situation in many ways, but potentially here should be watched over the next couple days.
Hey, Ben, maybe I brought some selling, but maybe I also brought some strength in the treasuries, crude oil, the VIX. I'm glass half full here, but we'll look for more of your thoughts on both Tilray as well as Block and the technicals coming up next. Ben will stick around. Alex and myself will also be right back with Next Gen Investing.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the watch list at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. We're still joined as well by the host of Futures, Mr. Ben Lichtenstein, to walk through our upvotes. Jenny, we got a pre-earnings look at Tilray and a downward slide here in block this morning. Symbol SQ. Let's start with Tilray.
Yeah, let's start things off with Tilray. They have earnings due tomorrow morning. Tilray, though, is a name that has seen a ton of volatility. Ben, you pointed out that it might be tied to the meme stock frenzy we have seen really over the last 2 weeks without necessarily a significant news catalyst, which is typically how those meme stocks go. But Tilray specifically has also been in the headlines pending some federal legalization that, from what I've read, is not necessarily expected to happen. So it saw a pop, then saw some weakness, but regardless, overall in the last year, Tilray's still down about 60%.
Down huge, yes, and no stranger to pops, no stranger to some of the run-ups we've seen in terms of the meme stocks, and as you mentioned, big time in the news last week, the federal legalization, the possibility thereof adding to some of the volatility we saw in some of these pot stocks, which is why I took a comparison look, which we'll get into in just a second, but first and foremost, let's dive into the more granular intraday look at some of the price activity we've seen recently. This is the 15-minute time frame. We're going all the way back to the lows that we saw down around 478, the middle of March. And I just wanted to point out the high conviction move you can see here. This is a big vertical attempt here to seek value higher. And then you can see they actually did start to consolidate at a higher level. They retested the upper extreme, trading up to 908, and then have kind of struggled since, sort of leaking lower right now. As I mentioned before the break, the bulls are kind of struggling to do the heavy lifting that's necessary at this point to get this stock and shares back up through $9 and see some follow through off that 478 low. But let's take a step back and just look at a couple moving averages in terms of where things stand. You can see we're below the 200, that purple line, as we have been basically since July of 2021. Again, struggled to get back, even to retest it. Now, I do want to point out how we are above the 50-day moving average, but you can see kind of rolling back over. It'll be interesting to see if we get back down below that, similarly to the pattern that we saw, if you remember back in last fall. We're talking about the rally up into November, mid-November, and how we broke above the 50-day moving average. But again, over the last, year or so, you can see it's really struggled to stay above that key moving average. So this will be something to watch. But again, as mentioned here, in terms of some of the heavy lifting, I just wanted to point out before we look at that, take a look at the spikes that we had seen, again, tied to some of these meme stocks, run-ups, and recent volatility thereof. But here you can see, again, in terms of, a comparison, side by side. You've got Tilray on the left, and notice here, Tilray in this recent run up to $9, it got all the way back up into levels that we hadn't seen, we're talking since the middle of December. But look at a stock like CGC, you're talking about Canopy Growth, and back up into the $9 level as well, just shy of 10, but they were unable to even take out the January highs, the February highs, I should say, so unable to take out the prior month's highs, while look again, Tilray all the way back, we're going back to highs we had seen from the prior year, beginning of December. Now, I also wanted to point out, I think it's difficult or important not to compare apples to oranges in terms of these two companies. So I took a broader based look here and look at MJ, which actually did take out the February highs, but it only got back into levels that we hadn't seen since the beginning of January. So as you look at Tilray on the left relative to CGC in the middle and MJ on the right, again, the ETF, marijuana ETF, I think it's important to point out that I think part of what came into play here was a bit of meme stock frenzy, and it got a little bit overdone. You can see relative to its peers a bit of a zealous type run up there, and you can see they're kind of paying the price as they come off a little bit more extreme nature than the other two or some of their peers. So one to watch here right now. Obviously, there's going to be some focus here on the Senate in the coming days. I saw President Joe Biden's press secretary Jen Psaki saying that the Biden administration basically is with most Democratic lawmakers. They say the current marijuana laws are not working, basically, and they're looking forward to some sort of a legalization bill.
Hey, Hey, Ben, I'm all for the federal legalization. I'm just not sure if the Senate is so on board, which seems to be the biggest snag, but also the key to unlocking some kind of funding and banking regulation for a lot of these companies, which you pointed out on a chart, from a chart standpoint, it is pretty brutal. This was almost like the original meme trade, because when we initially saw some strength in these cannabis stocks, they were on fire, but they have been since sort of left for dead outside of really the last 2 weeks. So Alex, when we're trading this name, say that we believe, things have been beaten up as badly as they could be, and maybe we have some hope, some optimism for the legalization.
Well, I think that you got to look at this a couple ways. So first off, you look at it, it's a $7 stock. You could look at, you can make, if you're bearish, you can go to zero. You can make $7, but this stock traded 300 at one point. Not saying it's ever going to get back there again, but if you used even just recent highs at $9 as kind of an upside target, and recent lows of around, let's say $5, it's sort of a tight range here for this. So I don't know really how much more downside there could be to squeeze. Certainly could move lower. It's just from a risk reward standpoint, for many, it may not be worth it. From a buying standpoint, there's a lot of question marks still with this particular industry, with these particular companies. And I think that we've maybe misguided in associating this narrative of what's going on at our federal government level to the upside moves that we've seen. There was never any thought that this was going to pass through both chambers of our legislature and then be signed. So how could there be optimism in the markets in these names tied to that? And so I look at it as, I think this was caught up more in a general risk on, bounce off the lows type of a situation. And if you look at it in that context, maybe you don't get to go through the Senate, but it's not necessarily a bad thing, because it was never really going to happen to begin with. And so what I looked at here is I think there's still a tremendous amount of risk in both directions. I wanted to make sure it was risk defined. But with the stock at $7, not many are looking to define their upside either. This stock could, quite easily go from 6 to 10 to 15 to 20 if things really went positive for it. We've seen it so many times with so many different names. And I think that investors would want to profit if that happened. And so I just simply bought a call. So no short options in this trade. Just going out to next week's expiration, which is the Thursday before Good Friday, April 14th, the 6th call. So we're buying some in the money premium. Market maker move, as I said, is about 80 cents. So if it was just the 80 cents associated, let's say that was actually what happened, this moves down 80 cents from here, you're risking about $1 on this particular trade. If it moves up about 80 cents, we could maybe stand to make somewhere around $1 as well. So of course, at $1.20, that's our max possible risk if it was below 6, and we do not have defined profitability to the upside, as this will just continue on all the way up, a penny for penny, one for one with the stock.
And with this being the $7 stock, it has a typically lower price point than some of the other names we look at. So only risking about $120, which is relatively low considering, again, $7 stock, a stock that has traded up to $23 at its 52-week high range, but has been pretty much all over the place, to say the very least, over the last 2 weeks. But now our next name is Block, a name that was one of the highest flyers back in 2021. And what's interesting here, Ben, is that the fundamental picture hasn't really changed. They've just been so weighed down by this correction in these heavy growth tech names. Shares are being weighed down today as well, down over 6%, but one that there is still a lot of optimism around, with that Cash App being very cool apparently among teenagers, as well as their influence in the crypto space. So tell us what you've got from a technical standpoint.
Yeah, a stock that's kind of caught in all the selling that you guys were talking about, and we mentioned at the top of the show in terms of the NASDAQ and the strong run-up we saw yesterday versus giving back some of those gains today. But take a look at what's going on in terms of Square, and I wanted to first start with the daily time frame. Jenny, this kind of speaks to your point here in terms of the run-up that they saw in 2021 up to $289. Now, remember this pattern as we move through this discussion and look at a few different time frames, because this is a very bullish pattern in many ways. You're talking about a high conviction trend environment to the upside, sideways consolidation. Now, one thing I want to point out is this type of a pattern, you'll see it recur across all time frames, whether you're talking stocks, bonds, ETFs, futures, we're talking Again, 5-minute, daily, weekly, monthly, it just doesn't matter. And that's one of the robust natures of kind of looking at price activity through this lens. But here you can see, again, trend environment to the upside, sideways consolidation. But look what starts to happen as we kind of add a little bit more time into this chart. You can see they were unable to sustain that upper level and kind of broke down. Now, I just want to take a look at a couple other time frames here because I think we're at kind of a pivotal point here for Square in terms of what the bulls want to see. They really need to see some heavy lifting come into play at this point. Just quickly, I'll look up the move that we've seen on Square off the Feb lows and how well similarly to the NASDAQ. Again, we were able to take out the Feb highs in the month of March, but saw limited follow through in terms of its ability to do so right now. So kind of forming this high horizontal type, more rectangular pattern in Square or block. But take a look as we move away from the hourly time frame back into the daily. And in this instance, we're just looking at the move from 289 down. Remember, before we looked at the run up that we saw off the pandemic lows all the way up into this high. Now, I want to direct your attention to this area of the chart right here in terms of the most recent run up that we saw, kind of bottoming out, inverse head and shoulders almost around that 95 pattern, this right shoulder here to the upside here in the run up. We saw 5 nice big days to the upside, high conviction to the upside, and then a little bit more rotational. And as we just sort of zoom in on this just smaller area of the daily time frame, look what you see. Again, that same pattern that we started talking about in terms of the daily time frame, but here it is on the 30-minute. The high conviction to the upside and then the sideways consolidation. Remember earlier we were talking about Tilray and how it's kind of leaking lower at this point. That's why I say the bulls have some heavy lifting to do. They want to see this thing break out through the upside here, up through 145, 149, kind of get back on track in terms of this trend that we've seen. And even within this trend up here, look at these areas of consolidation that get separated by the vertical phase. So something to look at here. But yeah, at this point, I think, again, the bulls want to see us break out to the upside. They want to see if this lower test comes into play, the 130 level hold. They don't want to see a similar price pattern in terms of what we just looked at as far as Tilray and the leaking lower that we're seeing there as price comes off most recent levels.
Yeah, and Ben, this is sort of a ridiculous chart because when you're looking at it on a shorter term basis, you can see that in the last 9-10 months, it was nearly cut in half. I mean, it fell as low as $82 a share recently, but like you pointed out, longer term things do look a little bit better, which I oftentimes think is very important when we're looking at some of these tech names to sort of clear your head as of the volatility that has happened so far this year. But Ben, thank you so much for joining us as always. That is the host of Futures. And Alex, when we're trading this name, it's sort of like, do you weigh, of course, its most recent activity, its volatility, it's down 6% today, or do you look maybe more optimistically and say, on a longer term basis, things still don't look that bad?
Well, one of the things that I was looking at was on a 1-month correlation basis. So I used 23 days, some might use 21, some might use more, but I used 23 in this particular case. I looked at its correlation to the Bitcoin futures, and you're going to see a strong correlation of 0.84. So that's really saying that these two assets are very much, moving in tandem to some extent. Well, you're seeing Bitcoin hold in there kind of firm today with Square down 5.8%. I also noticed that the time where Bitcoin's correlation broke down with Square was when Square was really moving lower. And so if I'm thinking Bitcoin is possibly the carrot that is leading the horse or the donkey, and Square being either the donkey or the horse in this case, if I'm following that logic combined with the overweight rating from, I believe it was Credit Suisse, the analyst, and some of the things that Ben was talking about, maybe I look at this as a possible entry point with a stock that's sliding lower that is tremendously off its highs and still down from its year-to-date highs. And so what I looked at was a neutral to bullish strategy that stays ahead of the earnings event in order to avoid that added binary volatility that oftentimes associates or is associated with those earnings events. And so what it is, I went out to the end of the month, so April 29th. We got about 24 days to expiration, and I am looking to sell the 125, 120 put vertical for $1.25 credit. This is over $10 below where we're currently trading, collecting 1/4 or a quarter of the width of the strikes. So that means our risk reward is 1 to 3. And so in that case, what we're looking at here is a max possible profit of 125 with a max possible risk of 375, break even at 123.75. And so for those who are looking for a way to participate in Square or block to the upside, but maybe aren't so sure that there isn't a little bit more downside left, this may be a way to consider doing that.
And considering the note we got earlier from Wells Fargo saying that this will be a $1.5 trillion annual revenue opportunity for these fintech names, say you follow that same sentiment, this might be a trade that you would utilize. But that does it for this segment now, Alex. Coming up next, we will talk Carnival after seeing their best booking week on record, really. We're seeing this name be a bright spot today, up almost 4%. One of the biggest movers to the upside. We'll dive more into Carnival coming up next.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads like counters and diagonals are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on thinkorswim for the full Options for Volatility course and a whole lot more.
We empower those who act. Those who see the correlation between things above and things below the surface. Those who navigate risk by meeting every turn with a heightened awareness of what's possible. Constant assessment. Determine the best position. Catch the perfect wave. CME Group, where risk meets opportunity.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. Jenny, it's time for FOMO. Today we're looking at the cruise liners. I personally can't associate this feeling with that activity, but I know that there are people that do, and that might explain this news headline.
Well, hey, and I guess that there was a fear of missing out because this was one of the only areas of tourism that basically completely shut down. I mean, you could still get on a flight, you could still stay at a hotel, which I did, even if I was one of the only people at a hotel, because sometimes you just had to. Cruises completely stopped operating. So from a balance sheet standpoint, this was one of the most hit industries, in my opinion, from the pandemic, Alex, because they had to basically completely cease their operations. So talk about a fear of missing out when they had really a fear of, not being able to do anything. I mean,
to be fair, too, I wouldn't even say that you have to say that's your opinion. I think that's just objective fact.
Yeah, I mean, it is what it is. It was a very unfortunate last 2 years for this group of companies and this group of stocks, but Carnival actually is up about 1% now year to date, but still underperforming who I'd say its closest peers are, those being Royal Caribbean as well as Norwegian Cruise Line. Now, on a 3-year basis, things look a little bit less impressive and sort of show that ceasing of operations, with the shares down about 2% over the last 3 years. So not much growth for this company. I wouldn't say it's necessarily super negative, but it's not necessarily very positive either. But the news we got today or yesterday evening was positive. I mean, they announced that they saw their best 1-week period between March 28th and April 3rd. It was their busiest booking week in the company's history. They showed a double-digit increase from the previous 7-day booking total. And the company said, to quote, the excitement over the industry's restart, their successful return of their entire fleet, and the guest reaction to Mardi Gras, as well as the support of their travel advisor partners and the amazing work of the Carnival team have contributed to the strong demand they are seeing. The president of Carnival said that all sales channels, including Carnival.com, their travel advisors, and Carnival Guest Contact Center, aided in contributing to these numbers. Now, with the restart of cruising in Australia now set, Carnival has finalized plans for its return to operations in Australia and will be announcing those details soon. Now, I have to say that to sort of dispute their statement, they do not have their entire fleet. They have 22 of 23 ships, so we're still waiting on one, which is expected to return to service in early May. So we're not fully there yet. We're like 98% there. Carnival's also added a new ship to its fleet as of November, but if you've been looking at this name, you know that it's been obviously a difficult few years for them with basically no operations. And I have to say that in terms of travel, Alex, I've been a big proponent of getting on planes and traveling again and returning to a normal world, but I am not getting on a cruise line.
Yeah, I mean, I never would have before, though. So, like, I can't say that's a. I don't think that the pandemic changed my sentiment around this, and I'm not sure how much impact it's had for those who enjoyed this style of travel. And so to see, and I think this is echoed from the news that's been released, that this is their busiest booking week ever in the history of the company. So I think that there's still a robust demand for this style of travel. And we actually were kind of ancillary conversation of yesterday's conversation for Under 30 with Ken Rose. We talked Dave & Buster's, Jenny, and I was looking at that, and the stock had actually recovered entirely to where it was pre-pandemic. Not to its all-time highs or anything of that nature, but you don't see anything like that in cruise lines. And so to me, it was like Dave & Buster's maybe didn't get as disrupted as a cruise line, but it's been disrupted. Is it the same healthy company that it was beforehand? I think that's somewhat questionable. And you look at something like the cruise lines, they are at a steep discount to where they were pre-pandemic from where they were 5 years ago. The question is going to be how much debt did they take on? How much of this is going to be kind of an on and off situation going forward? I think there's still question marks. All that being said, for those who aren't even involved in the cruise lines, to see this type of robust demand in booking for something that's a future spend, more than likely, you're probably not booking something that's going to sail the next week. Particularly for Carnival, which is historically seen as the cheaper entry point for this particular industry, I think says a little bit about where the consumer is. I think from a macro read-through standpoint, there's still a willingness to spend on discretionary type things like travel, and I think that's a really important sign. So we'll see if this is the beginning of a larger trend or if this is just that pent-up demand that we just need to get out and do something.
And it's an interesting point that you mentioned that Carnival is maybe the lower end of its competitors because its competitors have done better so far this year, which just goes to even further prove your point, Alex, that people perhaps are willing to spend on cruises, but maybe they're saying, hey, if I haven't been on a cruise for 2 years, I'm going to really, ball out on this cruise and get a nicer upgraded cruise where maybe I could have more space and feel a little bit safer. Again, I think that the people that love cruises will still love cruises, and there's a loyalty there. But my personal thing is just that I get seasick. So, I mean, I'm a bad example, but I definitely think that the loyal consumer to cruises will continue to go on cruises.
Yeah, for me, it's always been that I'm a slave to the itinerary of whatever the cruise is. And I'm a fly by the seat of my pants, kind of figure it all out as I'm there. So I don't like the planned style of the vacation. I like to explore, and so that's always been what's turned me off on it. And a lot of it just spent out in the middle of the ocean. So I don't know if that's how I want to spend my time these days. But I think it's really interesting, too. I didn't examine, how the pricing has worked. I don't know if they're offering a bunch of deals and sales and things like that. That could always kind of add to more traffic. So that's something to consider. But all things considered, looking at this and trying to figure out, what is the fear of missing out? Is the fear of missing out at this point, given where the pandemic appears to be, where the general feeling, the zeitgeist, if you will, of the consumer wanting to get out, wanting to travel? I think the fear of missing out from potentially an investment standpoint is that these stocks continue to recover higher. So I approached it that way from a trading standpoint. And what I noticed was there's still a decent amount of implied volatility, but these stocks just don't have a ton of premium in their options. And so I thought it was unique that we could actually go out to, let's say, the 25 call calendar, May over June. So we're buying a little bit of duration, and we could get this for like 25 cents. And so we would need a pretty significant rally, Jenny, about a 25% rally to get to that level. But we got a little bit over 2 months, and we're only risking $25. And I know I say only, and I don't mean to just kind of flippantly say $25 is a meaningless amount, but in comparison to many of the other trade illustrations we look at, this is a much smaller trade. And so I think it speaks to the accessibility of this particular strategy. But as I mentioned, to get to this peak on our risk profile, Jenny, we need a 25% or so rally higher. So you're going to need something to happen. So although it's low risk in the sense that there's not a tremendous notional outlay, it's also somewhat low probability. And if we don't get that rally, that full 25 cents is likely to be entirely at risk.
No, and by saying only $25, I completely get what you're saying, because this is over a $20 stock. We looked at a trade previously in Tilray, that's a $7 stock, risking more. So you see $25 and you think, oh, only $25. So I completely get that. As Carnival, it's not like it's a penny stock. You know, it is a $20+ stock. But I mean, we could talk the travel industry all day long. This is your stand safe. You believe in that travel recovery, which I have been harping about, that I believe in the recovery of travel because I want things to return to normal. But that is, of course, just my opinion. But that does it for this FOMO segment. Coming up next, we will stick to Levi Strauss. We'll be previewing their earnings, one of the last companies to report, but still a very interesting name in this retail space. We'll dive more into those numbers coming up next.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade Network. Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Looking to improve your portfolio management skills? Our Portfolio Management webcast series breaks down key concepts like retirement planning, income generation, ETFs, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position?
You two are all set.
Choose the app that fits your investing style.
Welcome back to Next Gen Investing. I'm Alex Coffey alongside Jenny Horn. It's time for an earnings preview. We're looking at Levi Strauss. Jenny, we got this company coming out. It looks like earnings as early as tomorrow. I don't know if it's pre-market or post-market, but we're looking at this one coming out tomorrow. Gene Company, a very old company, but not a tremendously long history as a publicly traded company. So that's always interesting. But founded, believe it or not, 1853. So you're going all the way back to when? Civil War?
Yeah, 1853. I mean, my goodness, this is an old company. And I always think it's cool when you actually go to the Levi's stores and you see some of their old, like, black and white photos when they were still an operating jeans company. It's pretty cool. Now, their earnings, like you mentioned, Alex, first quarter report tomorrow after market close. We do still have an entire other trading day before their report. But what we know is that previously they reported a solid fourth quarter. We saw revenue and earnings beat expectations. We saw adjusted profits increase 105% year over year, while net sales increased 22% year over year to roughly $1.7 billion. Now, their net revenues for their DTC unit climbed by 25% from the year ago quarter. And as we know, DTC has been paved the way by Nike. So if Levi Strauss is able to emulate any of that success that Nike has seen, it is a good thing for the company. They are expected to see continued strength in their brand power and momentum, as well as strength in that DTC business. Now, with all retail, supply chain is expected to be an issue for this current quarter, but the street is expecting adjusted earnings of roughly 42 cents a share, which would signal 24% growth from a year ago. So things are a little bit mixed. Shares are down about 3% heading into the close today. But Levi Strauss is another interesting one that has operated in their stores, but then is being sold in Target, which I actually learned an interesting tidbit from Oliver Rennick that the jeans sold or Levi sold in Target are different than the ones sold at their flagship stores, which I don't really understand maybe the method behind that madness. Maybe it's a benefit to get to an actual Levi. I live right by a Levi's store, so that's usually what I would do, but interesting that Target Levi's are different than Levi's, I guess.
Well, I've been to the Levi's store, and I can say that they have a lot of different kinds of jeans at the Levi's store.
Right,
so
like hundreds,
all the different colors, all the different styles. It's a classic American staple in fashion, the blue jean, but also the brand Levi Strauss. And they've tried to explore, obviously, other products outside of just traditional denim. But I think in a world of direct-to-consumer, there's two advantages. One is you can, as a newer company, if you were brand new, starting from the ground up, startup style, it allows for access through things like Instagram ads. And I know that I'm guilty of being roped in on those from time to time. But also, if you're a very staple brand within a marketplace or a very recognizable brand, something like a Nike, something like a Levi Strauss, that you don't necessarily need a store like Target to sell your product, because if you have a loyal consumer base, if you have a price point that a consumer is willing to pay, they will find you, and you can kind of increase your margins through the direct-to-consumer. So there's something to be said when you're talking about a company that's been around as long as they have, somewhere almost near 170 years. They've established generations of loyal customers, and so it's interesting. I think it's also a look at how the consumer is spending money. Would you argue at least one or two pairs of jeans is probably a consumer staple? But the fifth and sixth pair, probably consumer discretionary.
Oh yeah, I have two go-to pairs of jeans. They're actually both Levi, ironically, but with that price point, you can't beat. Their jeans range from like $55 to $100, which with everything else getting so expensive, Alex, I need my jeans to stay at least reasonable. But that does it for this segment today. Now coming up next, we will talk all things home builders from a technical as well as a fundamental standpoint. Some of those names being Pulte Group, KB Home, Toll Brothers. We'll dive more into the home builders coming up next.
Watchlist can help you keep track of securities you're interested in. To add a watchlist to the left sidebar, select the plus sign, then watchlist. When the default list appears, select the name box, then create watchlist. Enter a watchlist name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watchlist, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
I'm Maria Schrader. Here are a few stories to watch this hour. Bank of America downgraded First Solar to underperform from neutral and cut its price target to $65.50 from $76.50 after the stock has bounced around 30% from a February low. The analyst says that at the end of the day, expansion is not backed by fundamentals and that too much good news is priced in. Goldman Sachs upgraded Generac to buy from neutral and kept a price target of $140, adding it to the Americas buy list. The analyst says Generac's products are in the earliest phases of adoption and it is growing its store footprint. He adds that negative estimate revisions are now priced into shares. And Wolf Research downgraded Ryder System to underperform from Pure Perform with a $68 price target, expecting the first quarter to be a mixed bag for the transports. The analyst says Ryder has been a major COVID and supply chain winner, but sees risk to use truck pricing ahead and thus earnings risk. Ryder hit a 52-week low in today's trading. This has been your TD Ameritrade Network Market Update. Now back to Next Gen Investing with Alex Coffey and Jenny Horn.
Thank you, Maria. Welcome back to Next Gen Investing. I am Jenny Horn alongside Alex Coffey, and we are now also joined by Ken Rose, TD Ameritrade Network contributor, to help us break down some of the activity in the home builders. Now, we got news today that Credit Suisse started coverage on both Pulte Group as well as KB Home and Toll Brothers. So, Ken, there's been a lot of excitement, or I'd say maybe just enthusiasm around the housing market as home prices have spiked, demand has been high, supply is low, a lot of attention at least paid to these home builders. So tell us your thoughts.
Hi, Jenny. Well, you know, a couple thoughts come to mind when we're looking at these sectors. It's basically home builders are facing three major challenges. One is inflation, the impact inflation has on consumer confidence, as well as the consumer's pocketbook. The median price for a home is already up 15% year over year. Also increasing interest rates. Over the last 2 weeks, there's been a 1/2 point jump with regards to the 30-year fixed rate. And then also labor shortages is also a concern with regards to this particular sector. The average age for a construction worker historically generally runs in the high 20s to the low 30s. Currently, the average age for a construction worker is in the low 40s. So we need to get some more construction workers available with regards to this sector. With regards to individual stocks, so there are some areas where individual stocks could actually benefit. One is the continued strong demand for housing. You know, if you look at the most recent three pending sales reports, all three of those reports show a decline in pending sales. Now, that decrease in pending sales is not related to demand. That decrease in pending sales is related to a decrease in supply. Also, with regards to interest rates, while there is a concern about rising interest rates, we do want to keep in mind that the forecast with regards to these interest rates is that the interest rates on the 30-year mortgage will stabilize somewhere in the neighborhood of about 4.5% to 5%. This is still a historically low level. And then also something that could benefit these stocks is actually the recent sell-off that has occurred in these stocks. If you look at year-to-date numbers, Pulte has sold off 24%, Toll Brothers 32%, and KB Homes 25%. With this sell-off, that has pushed the price multiple on all three of these stocks down into the single digits, somewhere in the neighborhood about 5 to 6. At the same time, if you look at the most recent earnings per share and you compare the most recent earnings per share to the same quarter a year ago, all three of these home builders are showing earnings per share growth of greater than 40%. You have earnings per share growth of greater than 40% at the same time the PE ratios are dropping down into these single digit areas. This does represent a potential value opportunity with regards to investors. One way you could look at it is that the stocks have already sold off, anticipating difficulty going forward. So there may actually be possibly more upside potential here rather than downside risk. But a lot of the success going forward is going to be dependent on how these home builders are able to navigate the inflationary impact, the interest rate impact, and also the labor shortages that they're currently looking at here, Jenny.
Ken, when we're looking at this information, we've started to see it from a macro standpoint. Pending home sales, not just new home sales, have started to roll over a little bit in recent months. We've obviously seen some of the weakness in some of these housing stocks themselves. Obviously, interest rates are not just moving higher. In many ways, they're accelerating higher. And we see some of the data that came out of 2021. I believe it was the median home price, rose more than, the average income in the U.S. So essentially, you could kind of say that we're almost making more now off of our homes than we are from our jobs if you're a homeowner in some cases. And that to me is a little bit ominous if there is a crack in the housing market. There's so much wealth tied to this particular sector. Should we be worried at all? Kind of final thoughts on what you see.
Yeah, and Alex, and I think you bring up a couple of important points there. One, I think, is related to inflation and just the inflationary cost of the home, and then you add on to that the interest rates and the possibility of that. But looking at those two characteristics and thinking about the average consumer, we have this rising inflationary environment, so overall things are more expensive. If we look at just the housing section, we look at it on average. The average cost of housing is going to increase by about 28% for everyone in the United States. So some of us may be able to absorb those costs, and some of us may have some difficulty doing that, Alex.
Yeah, Ken, you make a lot of great points. And I was just in California, where the housing market is absolutely maybe the most ridiculous actually in the entire country. But Ken Rose, thank you so much for joining us on this Tuesday. That does it for Next Gen for Alex and myself. Coming up next, we have the Watch List with Nicole Petalides.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you an active trader? Our active trading webcast series is designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
We empower those who act. Those who see the correlation between upswings and downswings. Those who manage risk by meeting each obstacle with a perfectly executed strategy, a measured approach, the right tools, driving accuracy. CME Group, where risk meets opportunity.
When traders tell us how to make Thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him Thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim by TD Ameritrade.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then Watch List. When the default list appears, select the name box, then Create Watch List. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select Enter. Continue adding all the symbols you want in your watch list, then select Save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then Add to Watch List. From the Scan tab, right-click a security and then Add to Watch List. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Good afternoon. Welcome to the Watch List. I'm Nicole Petalides, coming to you live from the New York Stock Exchange. Thanks for being with us. Let's take a quick look at the markets. 2 hours left in the trading session. We're really hovering here around session lows. Right now, you can see the Dow is down 142 points at 34,779. The S&P is down 37 at 45.45. And this tech swing that we saw, gains yesterday, losses today, down almost 2% for the NASDAQ 100, 287 points lower at 14,874. And the Russell is losing 1.6% at 2061 for the small caps. In today's top story, we're watching Twitter. Twitter announced that Elon Musk will join Twitter's board of directors. News comes after Musk took a 9.2% stake in the social media company, making him the largest outside shareholder. After Musk's stake was revealed, shares for Twitter climbed 27% on Monday for its best day since the company's IPO. Let's take a closer look at the big picture here, all the stock stories. Ben Lichtenstein is with us, host of Futures here on the TD Ameritrade Network. I think I'm going to start with what's going on here in tech. I mean, people love to invest in tech in many ways, but they saw some gains yesterday, only to see a sell-off today. We're not as low as Friday, but they certainly are exposed to a lot of volatility. Ben, your thoughts?
Yeah, a strong start to the week, Nicole, but we're giving back some of those gains, to say the least. Now, I do want to just kind of put this into perspective in terms of the move lower today. We're really just back to yesterday's lows, so nothing major yet in terms of price decay, and we could take a look at some of the charts. In fact, let's begin with the sell-off that we're seeing here. In terms of the move lower, you can see back down below 15,000, and here's a move off the highs from earlier, up around 15,198. You can see on the day session trade opening up here some of the weakness we've seen throughout the day as we're holding near the lows, and simply put, no rejection of these lower levels as of yet. The NASDAQ, the tech-heavy index, leading the way to the downside around 2%, but all four of the majors are lower on the day. And, well, let's just take a look here at the ES, because we talked about how recently we saw a nice run-up off the March lows around that 41.25 level, mid-March lows, I should say, and the recent run-up into the 4,600 level, but inability to really build on that move to the upside here, and mostly sideways as of recent. The question is, we're going to start to roll over at a key area right now, as all four of the majors recently in the month of March taking out the Feb highs, but again, kind of struggling to add to that move up. Now, another step back just shows the 60-minute time frame, the move off the all-time highs, if you remember back in January, up around 4,800, the move down to the Feb lows around 41. So we have a pretty well-defined upper and lower extreme at this point. And you can see, again, the recent sell-off back down through 46, and it's just kind of limited. We're just kind of coming off that recent high that we saw to begin the month of April, into the end of March, and to begin the month of April, coming off that upper level. Quickly, I wanted to point out here, Nicole, that we're still holding above the 50-day moving average, and the ES is a pretty good representation of all four of the majors, the ES, NASDAQ, Dow, and the Russell. But I did want to point out that kind of a mixed bag when you look at things relative to the 200. You have the ES still above it, the Dow and the NASDAQ kind of teetering around it or just below, and then the Russell severely below its 200-day moving average. So a little bit of a different narrative when you talk about that. But one of the products I've been looking at today is the dollar index. It caught a bid back up through 99, which is indicative or kind of about what you'd expect to see when you get that risk-off type sentiment, and the investors kind of looking for one of those safe havens, a less riskier asset. Here you can see the move up in the greenback through 99.
Yeah, you know, it's amazing as we see all these moves, and I'm glad you gave us the bigger picture there, looking on the charts, particularly for the NASDAQ, because I think folks get so excited when they start to see some rallies, right? We've had a good 1 month. I mean, this morning when I checked on the 1 month, the NASDAQ was up 12.5% for this week. It's 0.04 positive. So, but they felt good, only to see it being moved around. And there's a lot of talk about, you know, whether this is really, you know, just a bounce back rally, not really having any legs. That being said, one of the reasons for that talk and that chatter is for the 10-year bond yield, which I know you watch closely, which has surged. In fact, it's at the highest levels since the pandemic began. And so and inversions. So what are your thoughts here? By the way, I couldn't believe when I also saw that former Fed Governor Lawrence Lindsay, talking about recession this summer.
Yeah, a couple of individual Fed speakers. I think also what's weighing on the indices here today. Brainerd had some very potentially hawkish comments, but you bring up a good point there in terms of rates weighing on some of these stock index futures products, specifically the NASDAQ, and we've really seen that since the beginning of the year. And then, kind of over the last couple of weeks, we've seen rates sort of lose their momentum to the upside, which helped the NASDAQ kind of regain composure, but today a completely different narrative. We're seeing a spike, to say the least. Let's begin our look at rates with the futures first and foremost, Nicole, and I've got the bonds up here, so the longer dated ZB contract. And I want to remind everybody, when you're talking about rates and the futures in this instance, when the futures are trending lower as they have been, you can see that breaking out now to the downside. Well, that means rates are on the move to the upside. Let's just take a look quickly at all four of the majors. You've got the bonds on the top left corner, the 10-year on the top right. You've got the 5-year and the 2-year on the bottom half. So the shorter dated on the bottom half, which has really been leading. But here you can see again, all four into these new year low prints and really continuing the trajectory to the downside we've been seeing with the more hawkish tone from the Fed, and some strong numbers this morning. For the most part, some PMI, the ISM numbers were really strong. So that kind of started things off, it seemed like, in addition to the Fed comments. But here you can see the 30-year on the left here up into, well, talking 2.6 right around. Look at the 10-year up and through 2.5% again. So we're watching that. You mentioned again the yield curve. This is because we've seen the short end really rocketing to the upside. Here you can see it, the 5-year up and through, well, the inversion of 2.7 in the 5-year, and taking a quick look at the 5 versus the 30. This has been going on for a while here now. A lot of focus on the 2 and the 10 and the 3 months still, but I've been keeping a closer eye on the 5 and the 30 recently, and this has been kind of telling as of recent. Again, short-ended leading the way here, and you can understand why. More closely tied to the Fed, and with some of what we've seen, as mentioned, the eco data and just the expectations based on some of the individual Fed speakers, you can understand the move we're seeing today. And again, it ties back to the weight that the indices, stock index futures products are feeling, again, with rates into new highs for the year.
Yeah, thank you so much for that. Ben Lichtenstein, nice to see you. Host of Futures here on the TD Ameritrade Network. Thanks, Ben. I'd like to get into this bigger picture. Ryan Payne's with us, Payne Capital Management President, Payne Points of Wealth podcast host as well. It's good to see you, Ryan. We've been talking about Lael Brainerd of the Federal Reserve and the calls here, just saying, watching the yield curve, saying methodical hikes, rapid balance sheet cuts is what she's been putting out there. What's your takeaway from the language?
I mean, is this really a surprise? Let's be real here, Nicole. I mean, we have the market pricing in 9 interest rate hikes this year already. Implied inflation is somewhere between 2 to 3.5%. Looking out further. So, I mean, markets are selling off a little bit today, but again, we're only back to where we were at the lows yesterday. I don't think you read too much into that. So I think the market really now since January has been forecasting, a more hawkish Fed and a tightening condition. So I think a lot of this is already priced in, even with the 10-year now above 2.5%. A lot forecasting that the 10-year can go to 3%. I think that's very realistic here, given the fact that we do have heightened inflation. But no shock here. I really think a lot of the news around interest rates, the Fed tightening, is baked into the market at this point and baked into equity prices.
Okay, so we got the Fed moves down. We're aware of the fact that they're going to be raising rates in a big way and shrinking that balance sheet too. That being said, now we're also hearing about recession, right? Recession, we're watching the yield curve. Does that mean recession? Not necessarily. But you know what? The part that just a lot of negative sentiment, the losses. Jamie Dimon says all the losses, it's going to have 10-year effect on us. And, I was just talking about Lawrence Lindsay, formerly of the Fed, saying, look, it's basic. We're going to have inflation that is going to limit the spending of consumers. The economy slumps, the economy goes into recession.
I think this is what economists typically get wrong. It's like 2/3 of economists now are calling for a recession in the next 24 months. And, I love negative sentiment, Nicole. Nothing makes me happier to see the street when they get super negative here, because they're usually wrong. And I think what economists always get wrong is the ability of the American consumer to spend. And we're seeing that right now. We're seeing consumer confidence indexes are low, but you're not really seeing weakness in retail sales. And, my philosophy here, my viewpoint, I talk about this in my podcast, Pain Points of Wealth, maybe the greatest financial podcast in America, but I digress, is, as we get into summer here, what you're really seeing this with like every survey is people are going to travel, they're going to spend money, whether they're going in their car, going by plane. But, there's so much pent-up demand. 60% of households in the U.S. have saved a lot of their stimulus from when the pandemic began. And we know that wages are going up. And we've seen inflation go higher and higher, but we really haven't seen consumers curtail their spending.
Right.
I think that's going to continue. And the reality of it is inflation is going to come down here a little bit.
Okay. Well, that would be good because that is the main goal here of 2022, at least one of them. That being said, if they're too Debbie Downer with their economic talk and forecasts, what is your outlook and where do you see the opportunities to make some money? Is it tech? Is it something else? What are you looking to do in the next week, 2 weeks, 3 months?
Well, I think growth here is probably having the biggest bounce just because growth got hammered the most, right? If you look at the NASDAQ at one point, it was down over 20% this year. Now it's down closer to 7-8%. So that's had a magnificent rebound. But, I've been calling this the suckers rally, for lack of a better way of putting it. And I do think you're going to see more money funnel back into tech. I mean, multiples are still high there. You've seen more, I would say, speculative assets like Bitcoin have had a big bounce here, and that could suck a lot of money into a lot of those areas. But we already know historically when rates go higher, and we know that we have heightened inflation, that's probably not going away. This maybe not be 8%, but it's certainly not going to be less than 2% like it was the last decade. That's not great for growth multiples. So I wouldn't get sucked into this rally in growth. We saw this back when the tech bubble burst. You saw the NASDAQ get hammered. It had a magnificent rebound before selling off like 80% at some point. So I think the bottom line is here, I'd stick to value. Value is actually up for the year. Any companies that have purchasing power, small cap stocks are going to grow faster than large cap stocks. They trade at a cheaper multiple. And it looks to me like the emerging markets have bottomed out here as well. So there's plenty of places to put money. But I would avoid getting into that growth trap. It's not going to be pretty when it sells off again.
Oh, okay. So avoid the growth trap of technology, but you are looking at small caps, you're looking at value, and you're looking at emerging markets. Can you elaborate on any one of those so people can really start to do their homework and get in there?
I mean, I know it's like a curse word to talk about China. But if you look at the Chinese stock market, the government, the regulatory arm there is becoming a lot more market friendly. You're going to see like outside auditors come in for some of these companies where they weren't willing to do that before. We've already seen a big bounce in China. So I think that bodes well for all emerging markets and for Europe in general because, China buys a lot of stuff from around the world. And even Europe looks great here. I mean, if you look at the banks in Europe, they're getting punished unnecessarily because of exposure they may have to Russia. And you're looking at valuations back to after the financial crisis. So I think the banks, especially in Europe, are a big opportunity here. Multiples are so much cheaper than the U.S. And again, you really are getting punished more here for what's going on with the Ukrainian conflict or war at this point. So I think that's all good value. And I do think you want to have a global portfolio. You don't want to just be domestic here because the best multiples are overseas.
Okay, so the global part of it is a really good big picture. When you look at what's going on here, we're going to start earnings next week, really in the big way with banks. Is there anything that you'll be looking for within what we're hearing from these companies?
I think it's all about forecasting and guidance, right? The big question is with supply chains still not being perfectly correct, what is that going to do to margins, raw material costs? We know commodity prices have gone through the roof. And of course, labor, right? Labor is going to be the bane of this economy's existence for a long time because we know we have a labor shortage. So the question is, how much is that going to eat into margins? It's probably going to eat into margins. I think that's reality. But the question is, how much, right? So I think that's what you want to look at as guidance, how profitable companies are. But I still think it's going to be another great earnings season. Obviously, growth is slowing. But remember, slow growth is better than no growth. And that's what the market cares about. Are things getting better or not getting better? And things are going to continue to get better, just not at the same lightning speed pace rather that we saw coming out of the pandemic initially.
Yeah, and two things that sort of, I heard in the last 24 hours. One was just how much people are getting on board literally onto the Carnival cruise lines, right? They had record bookings going forward. So to your point, maybe people are underestimating how much consumers are willing to spend. I'll give you that. And the other point I heard recently was that someone said they're not going to invest any more money until the Fed pivots. I said, pivots? Stop raising rates or actually lowers rates? Like, that seems like a very long time to wait.
No, it's a great point. I think the question here could be, is the Fed going to be less hawkish than what markets are pricing in right now? And I think that's probably realistic. Yeah, I could see the Fed maybe backing off some of the more dire projections, like, Citigroup came out with like insane projections about how much interest rates are going to rise. And that could be very, very bullish, especially if we think tightening is going to be less. I wouldn't wait here. Again, inflation, it's been like 7.98%. Sitting in cash, you're losing that on your money right now. Meanwhile, if you look at a portfolio invested in stocks paying dividends that are going to go up, because as they raise their prices and their revenue goes up, companies that have pricing power, they're going to raise their dividends, and dividends have outpaced inflation now for the last 70 years. So you want to be invested. Don't wait. Any good news, markets could just go off to the races, and then you miss all the opportunity. Take advantage of the uncertainty, embrace it right now, is my advice to you, Nicole.
Yeah, okay, all right, I like it. And I heard what you said when you talked about value and looking for small caps and opportunities abroad, even emerging markets, China. Ryan, always nice to see you. Thank you very much.
Nice
Ryan
to go.
Payne of Payne Capital Management. A good conversation there. Thank you. All right, later this hour, General Motors and Honda announcing an expansion of their partnership for EVs. Let's learn more about that and what it means for you. Then we'll get ready for Tilray's earnings tomorrow morning with a preview from Michael Keeley. And our expert panel is standing by to take a look at those railroad stocks and some of the changes that we've seen in the transportation sector. But up next, Kevin Horner is standing by. He has his eyes on RH and Autodesk. Both of those names hit some recent lows. Now what? He'll be here to share those charts with us coming up.
It's a 13-hour flight. That's not a weekend trip.
15 minutes
Oh,
away.
wow, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app so you can quickly check the markets?
Yeah, actually, I'm taking one last look at my dashboard before we board.
Excellent. And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set. Have a great flight.
Hey, thanks.
We'll see ya. They're getting so smart.
Choose the app that fits your investing style.
When traders tell us how to make Thinkorswim even better, we listen. Because platforms this innovative aren't just made for traders, they're made by them. Thinkorswim Trading from TD Ameritrade.
Welcome back. Let's take a look at the biggest movers in the market right now. I was just talking about those cruise lines. Cruise lines are higher after Carnival announced that the period from March 28th through April 3rd was the busiest week for bookings in the company's history. You can see it's up 3% here today. It was, in fact, a double-digit increase from the previous record one-week toll. Company announcing that 22 of its 23 ships are back in operation, with the final ship to return to service on May 2nd. Twitter continuing that climb higher after the social media company appointed Elon Musk to its board of directors. The company comes, and this news comes, after Elon Musk purchased a 9.2% stake. Musk tweeted this morning that he is looking forward to working with the company to make significant improvements in the coming months. Here's a look at Carvana. RBC Capital downgrading Carvana to sector perform from out to perform, is saying that it sees negative risk and reward. Now, the analyst said that they need more confidence in unit growth necessary to justify the capacity hyper-expansion and cash generation. This will support Carvana's ever-rising balance sheet leverage and future capital raises. Starbucks shares are under some pressure after Wedbush downgrading this stock from outperform to neutral, lowering its price target from $105 down to $91. The analyst notes the termination of the company's stock buyback plans and a lack of catalyst could cause low double-digit EPS growth to be a risk in 2023. Here's a peek at Bitcoin. Right now, you can see it just fractionally lower, 46,065. Let's get right to Kevin Horner, who is with us, Senior Manager, Trading Services Education at Charles Schwab. You have a couple of names for us. And as I was looking at both of them, I saw something that was similar in that they both have been hitting some 52-week lows recently. Let's start with RH, formerly known as Restoration Hardware. Why is this one on your radar?
Well, Nicole, this one's pretty intriguing. It's had a really large drawdown. We've seen a 55% move to recent lows here, and it's really been leading both the discretionary sector and the home builders lower. And yet, at the most recent period here, the news hasn't been any better, but the chart action is starting to be a little bit more intriguing. And a couple of things I wanted to call out today go back to really the huge volume spike we have seen when we got beaten down after the earnings report. So we had this spike high on March 29, took us to the 50-day moving average. And then after the earnings, we got put down to new lows. Now, those new lows may not feel great, but if we look at the enormous amount of volume in that new low, coincident with a rising RSI line, what we find is that it looks a bit more like an exhaustion move. And of course, today, inevitably, Nicole, I get to you, and the stock is moving 8% up today, up a monster $27. So it's eating into the profit opportunity on the long side, unfortunately. But the trend remains the same here. So you have a decision to make on the long side at the 50-day moving average. Can we get through it? Can we get through the spike high ledge, which is around right around 390 or so? You know, the truth is it is still a downtrend, but it's starting to resemble something where a low may very well be in the short term here. So, you know, like I said, last night, this looked a lot more interesting on the long side. Be really intriguing to see how we handle it as we approach the 50-day moving average coming in here.
Well, I think you make a good point, because I know you like to bring us these and you work hard to try and find ones that have up and downside possibilities.
Right.
And in this one, as you said, you know, they must have gotten your list ahead of time. You know, where we're seeing this big move here for I'm joking, obviously, folks, but obviously a big move here for Restoration Hardware off those lows. So an interesting one at that. And, you know, retail in itself is a very can be a very volatile group, but there's a lot of credit going to the consumer these days. How about we get to Autodesk? What stands out to you in this chart for Autodesk?
Well, we've seen some improvement in software, generally speaking. And so software, I thought, had put in a new trend here. We've got higher highs and higher lows in the last 2 months on software, which actually gives you the impression that things might be improving. Unfortunately, when I went to look at Autodesk, what I found was a lot more of meeting resistance here. In fact, it had rallied in the last week into that 50-day moving average, something that the software ETF had been breaking through and using as support. On this end, though, Autodesk having made 1, 2, 3, looks like 4 out of the last 6 trading days, 4 out of the last 6 trading days showing a lower high, all of which are against the 50-day moving average. I'd love to tell you that this looks as good as RH. Unfortunately, it doesn't. We don't have volume that validates an exhaustion sell-off. We do have a slight series of higher lows mixed in with these lower highs, which just simply means we could continue that short-term uptrend. But I think if you're a bull, you want to see some closes over the 50-day moving average, that purple line on the screen here. If you're a bear, you might already be well positioned to start a short side trade with a protective order above the 50-day moving average to make sure you're limiting any damage should things rally on you.
Yeah, I'm really glad you brought both of these together. You know, this one, interesting how it's coming off the lows and pushing up against that trend line, the moving average, as you noted. Kevin Horner, always great to see you. 2 great names, Autodesk and RH. Kevin Horner, Senior Manager, Trading Services Education at Charles Schwab. Thank you, Kevin. Coming up, affordable EVs. Thanks to General Motors and Honda. They're developing a series of affordable EVs, and they're talking about millions of them by the year 2027. Let's get some details and what it means for the EV sector and a name like Tesla coming up next.
Let's walk through how to analyze a company's financials on thinkorswim. To get started, go to the Analyze tab and select Fundamentals. Enter a symbol, then select Enter. To download detailed analyst reports, select Download. By the Numbers provides balance sheet information and other fundamental data. Company Details provides summary takeaways on key metrics and what drives the stock. Takes a more numeric look at similar information. If you find any of the information particularly helpful, you can print it out or take a screenshot. For more demos on how to thinkorswim, head to the Education Center on tdameritrade.com.
When traders tell us how to make thinkorswim even better, we listen. Like Jack. He wanted a streamlined version he could access anywhere, no download necessary. And Kim. She wanted to execute a preset trade strategy in seconds. So we gave him thinkorswim Web. Because platforms this innovative aren't just made for traders, they're made by them. thinkorswim by TD Ameritrade.
Technical traders, the chart master is in the building. Trends, support and resistance, key patterns, and technical indicators. The chart master has your live technical analysis throughout the trading day, only on the TD Ameritrade network.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade network.
Welcome back to the watch list. I'm Nicole Petalides. Well, we're talking EVs here because GM and Honda have announced that they are expanding their partnership to develop a series of affordable electric vehicles. I want to take a look at the EV space, what this means. We have Dutch Masters founder, Carnivore Trading Dutch. Traditional automakers are looking here at some of these names that we look at GM and also Honda here with this. I can't get over it. They're talking about cars that are less than $30,000.
Do an all-electric fleet by 2025. They've got two that they're going to build for Honda in 2024, they say, which is just around the corner if you think about it. And that by 2025, they're going to have 30 different electric vehicle versions. So they're putting their money where their mouth is. I think it's great if the cars are built here in the United States. That's fantastic. I want, I think the big story here is that, it's not going to stop. And a company the size of a General Motors is betting the entire ranch on this future, and that's got to tell you something, right?
Yeah, and they really are. And so when I look at this here, what I saw is that they're working on next-gen battery development. It's going to be lighter, next-gen, greater energy density, more range, and lower costs. That is going to be one of the ways that GM and Honda will have millions and millions of affordable EVs for us by the year of 2027. What do you think of that?
Well, yeah, I see. So the deal is, Nicole, that, 20 years ago, I'm an old guy on Wall Street, right? So 20 years ago, 15 years ago, we had guys walking into our office to get funding for their new battery technology, okay? So I've been hearing about electric vehicles and electric batteries and the next generation of batteries for a long, long time. But as with, silicon chips and everything else that's changed our future, the technology on batteries and the storage and the weight and the ability of it to give you distance in your driving, it's accelerating like nobody's business now, because it is real. There are cars that can be sold. There are batteries that can go in those cars. So the technology is really accelerating, and I think they'll be successful at creating, electric vehicles that you'll shoot you across the country, maybe with one charge, and then maybe with no charge. I mean, we're going to see that happen.
Right. Well, one day at a time, huh? That being said, let's talk and bring in some of the other names that we follow so closely. I mean, it's really evident that GM and Honda are working so hard on this. But, we saw Hertz announcing it's buying 65,000 EVs from Polestar. Tesla's always front and center. Let's talk about some of the other names here. Where do you want to start, and what names in the space do you like?
I like, a lot of people have been critical of Tesla's valuation. And from the beginning, Carnivore Trading has said, Tesla's it's not about cars. You can't value it that way. I mean, they're a solar company, they're a technology company, they're a data company. I think Tesla is 10 years ahead of everybody. And I think that, the recent thing that you saw that Elon did with Twitter, I mean, we've come to expect the unexpected from Elon, but, he's way out in front. I think if he wants a particular market in the electric vehicle market, he will be able to get it. So if he decides that I'm going to leave the low end of the market to GM and to others, then I'm going to go ahead and leave that to them. If he decides that he wants a piece or all of that market or most of it, I think he has the capability to get it. So there's a reason why Tesla is Tesla. There's a reason why its stock is where it's at. And a lot of it is that people don't expect Elon to be able to step up and do what he does. The man solves problems. The man doesn't solve small problems. He's solving physics problems out there, and that's a different kind of guy.
Yeah, I'm just looking at some of the numbers here, the production and delivery numbers of, we know that the S and the X are less, less overall, right? 14,000 versus nearly 300,000 for the 3 and the Y, and that's the big picture. We know what sells for Tesla, and of course, Elon Musk knows what his bread and butter is. I'd love to get away from Tesla a little bit, because so many people often write to me on Twitter and say, you talk so much about Tesla, and it's not that I can't help it. This is what people talk about. Someone like yourself, Dutch, comes on and says, look, I think Elon Musk is ahead of the game. I think that they have the ability to continue to grow. But there are others that are giving them some competition in China or Asia, for example. There are other names that are on your radar, Dutch.
Yeah. Well, the name that we own is NIO, and we bought it 2 days ago, and we're adding to it as it moves up in our inimitable style. So when we take a position, we'll take a reasonable sized position in our portfolio, and then if we get confirmation in the direction of the stock, we'll begin to add to it just about every point that it moves. So NIO is in that space. I think the bigger story here is that, we basically shorted the NASDAQ this morning. We went with the SQQQ. We shorted it fairly quickly after the open. We sold our technology stocks for the most part. And we are long food and agriculture. We're long ADM and MGPI. Those are 2 stocks that we like. Russia 2 days ago came out and said that they are no longer going to ship vital food and other products to anybody they consider to be an enemy. And so for those of you watching, in case you've been living under a rock, we are the enemy, and so is Europe. So they're not going to be shipping a lot of very important things to us. And so MGPI, ADM, we've got some others that we like in that space that the Carnivore platform has been buying. But, there's going to be a major disruption in food, and U.S.-based producers of food and agricultural products are going to be big, big winners in our opinion. And I think, Nicole, if you had to look at carnivore and say, what are they really best at? We're probably the best on the street at picking the sectors that are going to move next. And so we made the ag move yesterday and today, and that's the first time we've moved into it in a heavy way. So I think that's a big part of the story. And what goes along with that, Nicole, is the end of globalism as we know it. The global economy for the last 30, 40 years has been built on everybody trading with everybody else in sort of a free market or a fair market manner. And now we're beginning to see that Russia's going to take care of Russia and Russia's friends. China's going to take care of China and its friends.
Yeah.
And so, we need to understand that the United States needs to produce low-cost products and oil and things here.
Okay. All right. We have to leave it right there. Dutch, I love our conversations. Thank you very, very much. And, a good call shorting those triple Qs today, getting out of tech, at least for today, because we're seeing, it down almost 2%. Dutch Masters, nice to see you, founder of Carnivore Trading. Always nice to have you on the show. A great conversation.
Thank you, Nicole. Thank you so much.
Thank you so much. Coming up, Tilray's earnings preview. We have Michael Keeley all over that. And we're going to look at investor opportunities in utilities and rare earth minerals. Here's a look at winners and losers in the S&P.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
Before diving into the markets, prepare for the trading day with the Market Minute newsletter. Videos, market insight, and more delivered right to your inbox. Go to tdameritradenetwork.com, click on the pop-up to subscribe now.
Welcome back to the watch list. I'm Nicole Petalides, coming to you live from the New York Stock Exchange. Thanks for being with us. So you're seeing selling across the board. The Dow was up 190 points at its high point of the day, but we've seen it sell off, obviously. Now you can see it down 150 points almost at 34,774. The S&P is down 37 at 45.45. The NASDAQ, tech-heavy NASDAQ, down 1.8% at 14,884. And the small caps, Russell, down 1.6% at 2060. I'd like to take a look here at Tilray. Now, Tilray is set to release its earnings tomorrow morning before the opening bell. We've gotten lots of news concerning cannabis. We're waiting for the earnings as well. And Michael Keeley, contributor here on the TD Ameritrade Network, has been combing through all the details and what the analysts are expecting. You tell us, Michael.
Well, the numbers themselves are forthcoming. That is the case, Nicole. We have a swirl of news-based, kind of momentum that drives this entire sector. And the latest has certainly involved the passing of the MORE Act at the House. But this is the second time that that's happened. The last time around, the Senate didn't even take it up for a vote. So there's very little enthusiasm that this is going to have complete passage for these particular firms in terms of decriminalization, as well as legalization at the federal level, which is a big deal. And the more states that do get kind of the approval for marijuana consumption, not just medical but recreational, then the more the thought is that some bills will pass. But that's still out into the future. So here we have the estimate for tomorrow morning sitting at 8-cent loss. The following quarter will be presumed to be a 9-cent loss. And Nicole, we've got losses not just for this current year, but also projected loss into next year. So, there's been some major impediments. You can see it all over the chart, the lacking traction on the upside. And really, there's been a ton of consolidation in the industry, with Tilray having done a reverse merger with Afria to create one of the biggest firms out there, actually the biggest by nature of sales revenues. But when we take a look at why they're doing this, it's to try and eliminate the competition, because there were so many players that jumped in at early phases, too many, in fact, that drove down the prices. And that's really been the major impediment. This slide right here, Nicole, it shows a lot of those hindrances on the company, and by extension, the industry group, where expenses are actually going up. Companies are dropping the prices of their products to try and either maintain market share or to grow some market share, or they're consolidating, which means they have to spend money typically to do so. And so this is dangerous waters, and the chart really reflects the fact we've been grinding lower and lower and lower without any real catalyst besides that thought that we might get, this legalization, which I know I'm throwing cold water onto it, but most professionals that are looking at this industry are doing the same right now. So you see that that news-based momentum on the upside, the reeling back down. So what they have to say about their recent merger and what kind of cost synergies they're achieving, that'll be the upside on this earnings report.
I'm glad you brought that to us, because we'll be watching that tomorrow. And so you set us up beautiful. TLRY, beautifully. Thank you. Michael Keeley, appreciate it, looking at Tilray for us ahead of the earnings. Now let's get right over to Jordan Kahn, CIO at ACM Funds. Jordan, thank you so much for being with us. So, I'm watching a market that's had a lot of volatility. We're really pretty much at session lows here today. Our last guest actually said that this morning he was shorting the triple Qs. If only we all knew that, or at least me. It's down almost 2% today. So what do you make of the rally, and even the last 1 month? Is this a real rally or not really?
Yeah, we think that the market is likely to continue to be choppy. So you're going to have rallies like we've seen over the last 2 to 3 weeks, and then there's going to be continued sell-offs as well. And I think that for the last couple of years, the last few years really, what you've had is this combination of quantitative easing, low interest rates, and below average inflation. And now all three of those tailwinds are turning to headwinds. We have the Fed moving to quantitative tightening. We heard Fed Governor Brainerd speaking about that this morning. Interest rates are obviously moving up, and there's a lot more projected rate hikes on the way. And inflation, which had been running below average, is now at multi-decade highs. So those are three pretty significant headwinds. They also tend to act as a lowering agent in terms of valuations. We know that the market has been trading at pretty rich valuations recently, so that could put a cap on that as well. But those are the reasons why we think things are likely to remain choppy, at least for the remainder of the year.
Absolutely, and I understand what you're saying when you're seeing the choppiness. We've all seen it, really, and it's tough for investors to try and figure out where to be and whether or not the Fed will actually have a soft landing. There's some concerns about recession, and others who just feel that the opportunity is there to make some money always, and they just have to figure it out. The big picture here is inflation, and we're trying to tame inflation. That's one big picture story that I certainly think is front and center. We had one former Fed governor saying that inflation is high and that consumers will just stop spending, and then the economy will dwindle down, and then we'll go into recession. Don't love that scenario. Is that likely? Will the Fed somehow figure out a soft landing here and we'll be okay?
The Fed doesn't have the best track record at engineering a soft landing, so it's certainly possible, but I don't know if that's the high probability scenario. One of the reasons why the Fed is projecting so many rate hikes is because they do want to tamp down demand, and that in turn will help bring down inflation. Right. I think that there is a good chance. And when you look at the yield curve, we've seen that the yield curve recently inverted, and that's usually an early warning signal of a potential recession down the road also. So
Right, I know. We've been talking about that a lot lately, and of course how the 10-year yield even has surged now to the highest level since April of 2019. Let's get to what you're looking at here, rare earths and utilities. So we can start here with rare earths, as you see, right? You're talking about what's happening in the next gen and EVs and, you know, a better place and all the things that we need to do that. And you have a few names here, MP Materials and lithium is another one that you were looking at, and the VanEck ETF. Tell me about these choices in the rare earth space.
So yeah, I mean, you were recently talking about EVs with your last guest. So rare earth minerals go into a whole host of products, everything from, you know, general electronics to solar and wind projects, and also into EVs. And so right now, China has the biggest market share in rare earths, and the US wants to be a bigger producer. The recent war in Ukraine has highlighted the fact that when you're dependent on a certain region for key products or key parts of the supply chain, you know, that can pose a big risk. So the president was recently talking about enacting the Defense Production Act to get investment into this area. And, you know, we really want to have a homegrown U.S. supply of things like rare earths. So one of the names that we highlighted is MP Materials. They're the only current U.S. facility that's producing a lot of these rare earths. They've been beating estimates handily over the last 4 quarters. Revenues have been growing at triple digits. So that's a name that could have some tailwinds behind it.
You know, it's interesting. There's some big moves happening here today. I mean, you know, 3% I'm used to. 10%, I mean, that's when you get on the phone and you start making calls. I mean, with lithium, America's down 10% today. I start to wonder, is there something going on? Is it the GM Honda story that they're going to be working on their own batteries? Or, I mean, there's really, I mean, does that make it even more attractive to you at this point to see it down 10% for Lithium Americas? And then I got to get to the utilities.
Yeah. I mean, I think it provides a good buying opportunity. The stock had a really, really big run up when Biden announced the Defense Production Act. So I think some of it is just profit taking. These names are more volatile, so people do buy these. I would recommend using stop losses just to be safe.
All right, and then the utilities, which I love to look at the big board and see what's going on here, right? I see REITs and utilities higher, and utilities are often higher because they're such a defensive play. You have American Water Works is one of the names on your list that you like, also NextEra Energy and XLU, of course.
Yeah, so, you know, if rare earth minerals are the more aggressive play, utilities are the more conservative play. What's interesting is that when rates are higher and bond yields are moving up, normally you wouldn't see utilities at the forefront of the leaderboard. But if you look at something like the XLU that you mentioned, it's breaking out to new all-time highs. So that's kind of uncharacteristic. And when we see that sort of thing happen, we want to pay attention. So 2 names that we've owned, you know, on and off for years, like you mentioned, is NextEra, which is big in green energy. They also have a significant foothold in Florida. American Water Works is a big water and waste utility in 24 states. And water is becoming a precious commodity of its own. So those are 2 names that we like in the area. And these names, when we look at something called earnings stability, or how stable the company's earning streams are, and these 2 names rank at the highest in our whole stock universe on that measure. So that's something that investors can appreciate.
Jordan, a great conversation. I know you expect some choppiness to continue and the tailwinds turning into some headwinds, but you found a way to give us some good ideas here too. We appreciate that very much. Jordan Kahn, ACM Funds. Thanks. Still ahead, let's take a look at the rails. These stocks have done particularly well. I want to talk about the transportation sector, some competition in the group coming up.
Many traders may be willing to take on additional risk in pursuit of aggressive growth in their portfolio. More power to them. But if you're looking for a less risky alternative, you might want to consider checking out our income investing course. In the income investing course, you'll explore investing strategies designed to generate regular income and preserve capital. First, we'll delve into risk and return preferences. You will learn about the different ways to allocate a portfolio and create a payment schedule. Then we'll take a deep dive into the assets commonly held in income portfolios: dividend stocks, bonds, equity REITs, and cash. You'll also learn about routines for managing a portfolio over time. Along the way, you'll watch videos, take quizzes, and perform paper trades to practice your new skills. So if you're looking for an edge, consider your education. Head to the Education tab on thinkorswim for the income investing course and a whole lot more.
I'm Jenny Horn. Here's a few more intraday movers to keep on your radar. Airbnb is 3% lower after canceling reservations in both Russia and Belarus. Guests will not be able to make new reservations in either country for the foreseeable future. Shares remain up 3% year to date. Meta Platforms announced in a blog post it has enabled sharing to Reels. The company said this makes it easy for people to share short-form videos directly to Facebook. Once integrated, third-party apps will have a Reels button that people can share short videos and then customize the Reels with editing tools like audio effects, captions, and stickers. The post also said Reels is now Meta's fastest-growing content format. And Piper Sandler maintained its overweight rating on Bank of America while also lowering its price target to $51 a share from $57. Bank of America is now pacing for its longest losing streak since January of 2021, currently down 9 of the last 10 days and lower for 7 consecutive sessions. This has been your TD Ameritrade Network Market Update. Now back to the watch list with Nicole Petalides.
Thank you so much, Jenny Horn, for that report. I'd like to take a look at the transportation stocks with the rails really in focus here. Jeffrey Small is with us, president of Arbor Financial. So what's the big picture here? I mean, the rails did particularly well. I saw a lot of 52-week highs, but there's some stiff competition when it comes to freight and trucking and rails. What's going on here? Your picture.
Well, the rails are a great way to transport goods, and so we now know that goods are still at post-pandemic levels, double what they were pre-pandemic levels, so the rail business is going to be good. But, you know, the rails don't yield very much, and some of them have taken a beating, so investors want to get into rails that truly are growing well, that have the best numbers and the best forecast going forward. And in a rising economy, we're going to see the rails do okay, even though they have underperformed the Russell and the S&P the last couple of years.
So if they've underperformed the S&P, I mean, you know, there's always the talk that technology can replace a lot of things, but it cannot replace what the rails do, right?
No, it really can't replace what the rails do. I mean, but 72% of all goods and services of all goods transported come from the trucking industry. The majority of the rest comes from rail. And there really was no excess capacity in rails, especially with the supply chain shortages we have now. You know, when coal started to become the demise of the energy sector, less coal was being transported, so that produced some excess capacity. But to be honest with you, we need more capacity across the board in every transportation sector. We are under capacity right now.
Right. So, I mean, tell me about being underinvested in capacity and what we need to do more of. Explain that to me. I mean, what's the big concept here, since you have mostly truckers really moving most of the stuff?
Well, they both have expanded, but nobody could have expanded to the point of the demand that we have today for transportation. We've added 35,000 truckers in the last 2 years since COVID. And so, you know, the rail industry is also expanding as well, but there's only so much we can do. We can't build tracks that fast. We can't build trucks or roads that fast. We really have to slow down the pace of consumption. And even by the Fed's revised statement, you know, we've got 3.5% GDP growth this year. That's almost double what it's normally been historically.
So at this point now, what do you tell a regular person as I see that CSX train go by? You know, the transports are made up, right, of the Dow Jones Transportation Average is 20 names. It is the truckers, the shippers, the airlines. We look at these rails. These are what I think of as the transports. You tell me if I'm missing something. Which ones are the winners? What would you pick? Where would you lean?
Great question. So the fastest growing railroad stocks, and I'm glad you asked me that, are Canadian National Railway, CSX, and Trinity Industries. Those are the fastest growing railroad stocks. So if an investor wants to start investing and they want to have a little bit of that in their portfolio, that's the direction they should go there. Railroad stocks with also lots of momentum in their business lines in this kind of economic environment, a Greenbrier, symbol is GBX, Union Pacific, CSX, of course, which I've mentioned. And so those would be my picks in that sector at this time.
Yeah, and and I don't even know, you mentioned Trinity and GVX. I mean, those aren't ones that I know as well, only because maybe they're smaller or they do something different. I mean, Canadian National, obviously one we talked a lot about, CSX, a big one as well, and some of the others that we often follow. But some of these smaller names, I guess they must be smaller. Those are names that you came up with. Why is that? Why did you pick those names over the usuals, right? Norfolk Southern,
specifically, Trinity Industries provides transportation products and services in North America and offers lots of rail car leasing. And there's going to be a lot of demand for that as we're looking to transport more goods than we've ever transported before. And so they're in line for probably good growth at this point.
Ah, interesting, very interesting. So as we go forward here, and we're moving into summer, and there's a lot of worries about an economic change, a slowdown, less demand. There's always fuel costs. Weather could be an issue as well. Any thoughts on some of these maybe headwinds?
So far, I will just say this, and not to you, but to the pundits in the inflationary land of slowdowns and recessions, it's the economy, dummy. The economy's on fire. We have the highest PCE in 40 years. And you're not the dummy. Just in general, a lot of the pundits are, not you. But we had the highest PCE in 40 years at 5.4% a week ago, 2 weeks ago. And we haven't had, let's say, any demand destruction. People are spending money like crazy. So until the Fed makes a massive move in rates, this thing is out of control.
I like how you changed stupid to dummy, and you've said multiple times that it wasn't directed at me, and I thank you for that. Because you're right. I mean, I like to be more. Thank you, as are you, Jeffrey, and that's why it's our pleasure to have you on the network. And honestly, some of those questions I formulated from reading analyst notes. So I think you're right. I think people are a little worried about a lot of things. Jeffrey Small, always nice to have you on this show.
Thank you
very, very much. And until next time, Jeffrey Small, President, Arbor Financial. That's going to do it for us here on the Watch List, live from the New York Stock Exchange. Thank you for being with me. I'm Nicole Petalides. I catch you every day at 11 a.m. and 2 p.m. Join me all the time. Market on Close is next.
Whether you're an experienced investor or just getting started, TD Ameritrade offers a webcast that's right for you. The Platform Demo webcast series is designed to help you broaden your knowledge of tools and resources available from TD Ameritrade. You'll learn tips and tricks to help navigate TDAmeritrade.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to tdameritrade.com/webcasts and start learning today.
I'm searching for info on options trading, and look, it feels like I'm just wasting time.
That's why TD Ameritrade designed a first-of-its-kind personalized education center. Their award-winning content is tailored to fit your investing goals and interests, and it learns with you. So as you become smarter, so do its recommendations.
So it's like my streaming service.
Well, except now you're binge learning.
See how you could become a smarter investor with a personalized education from TD Ameritrade. Visit tdameritrade.com/learn.
TD Ameritrade Network has arrived on the floor of the New York Stock Exchange new location with access to the biggest newsmakers in Wall Street, bringing you in-depth market coverage and real-time trade ideas. Do not miss our exclusive interviews with CEOs, bell ringers, traders, and stock pickers, keeping you informed as you navigate your investments. Don't miss Trading 360 at 11 a.m. Eastern and the Watch List at 2 p.m. Eastern, live from the New York Stock Exchange, only on the TD Ameritrade Network.
Let's walk through charts, one of the most commonly used features on Thinkorswim. Start by going to the Charts tab and entering a ticker symbol. Select Time Frame to adjust time intervals or to favorite a time frame. select Style to change the appearance of the chart. You can add drawings by selecting Drawings, Drawing Tools, and then Type of Drawing. For symbol comparisons, select Studies. This also gives you access to hundreds of pre-built studies, including a number of classic patterns. The grid icon lets you view multiple charts at once. You can even initiate a trade from the Charts tab. Just right-click anywhere on the chart and select either buy or sell. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Good afternoon. Welcome to Market on Close. I'm Oliver Rennick. It's 2 p.m. here in Chicago. Means we've got an hour left in the day, and right now bulls are getting beat up a little bit. Pretty much red since the start of the session. The stocks took a dive as yields ripped, and it's led by the NASDAQ downwards. So we've seen this before. Is it still as alarming as it was a couple months ago? Perhaps not, when we are so close to highs in stocks like Apple and Tesla, but failing here is a notable event. A few things that I pointed out ending last week and then yesterday too that it's important to revisit here. So firstly, last week we closed things out talking about how the pushback by bears that basically just put a halt on the rally. But now we're seeing something a little bit deeper than that after some failed strength yesterday. Couldn't get above last week's high. And I do think that bears really had to show up. If you recall, that was part of the analysis here, saying that this is a week with a vacuum of information data, really. Not a lot of big economic data. There's plenty of language coming out from the Fed, but without any other shock numbers or surprise events. There's not a lot of geopolitical catalyst here for downside. There's plenty of bullish catalyst for the social media stuff with Elon the last 48 hours. So to see that yields can shake up markets like they are right now, we know specifically why stocks are down. It's not hard to figure out here. Bonds are just getting crushed. Why? Data this morning was in line with expectations, pretty good. We saw services components of our economy bounce back. We see prices paid that are still high, like we got in the ISM number. And then for the services side today, you also see high prices and inflationary impulses. So, okay, what are we learning? We're learning that the market is still a little bit worrisome about how fast the Fed could move. You take data that fits exactly into Jay Powell's framework, good employment situation, good employment data the last couple of weeks, and then PMI and ISMs hitting in line with expectations, some of the best in the world. That's an economy that the Fed has told us they feel comfortable hiking in. And then Lyle Brainerd says, potentially, by the way, the new vice chair coming in, Mrs. Brainerd says that they could be aggressive in tightening policy. Hey, who wrote a couple weeks ago about 100 basis points? I wasn't joking. I think it's seriously on the table. I think it should be on the table too. If the Fed believes that interest rate hikes actually work, which by the way, is very debatable right now. I'm not saying that I know that it should work. I'm saying based on what the policymakers have told us, which is that interest rate hikes are appropriate right now to combat inflation that is in large part or in some part, it's not just pure demand, it's obviously supply side too. If they believe that interest rate hikes work, and we know that right now we're going to get the biggest inflation impulse probably throughout this entire saga because of the Russian invasion of Ukraine, then why not press the brake hard right now if their goal is to raise rates, basically to cut them later on? Because that's what the yield curve is telling us. The yield curve inversion is telling us they're going to hike rates now and have to cut them later. So if the point is to hike them now to cut them later, why not hike them immediately as much as you can and give the market a test here? If stocks go down, okay. We just had a massive speculative rally the last 2 years that put us up to dot-com levels, so we shouldn't be too concerned about what the stock market implies about the economy at this point. All right, so I'm getting off track a little bit, but this is the really important context here. Maybe they don't do 100 basis points next month, but it's possible that they could speed up the balance sheet unwind, and that's what Lyle Brainerd hinted at today. So the market doesn't like that. Bonds certainly don't. TLT is getting blasted down 2%, your long-term bond ETF, basically a proxy for many investors' bond portfolio. Credit in the corporate side is also getting hit today too as well, with yields ripping. And the dollar is zooming upwards. A really important chart to look at and a key component of the analysis I've been putting forward here over the last month, which is that as stocks rallied back and the dollar went sideways and yields calmed down, if there was one thing that could get in the way of an extension of the rally back to the highs, it would be a breakout in the dollar. Yesterday and Friday, I described it right now as looking like a race. What's going to break out first? The dollar and bonds, bond yields, or stocks and Bitcoin and the risk asset side? Because both had been now consolidating and trying to find momentum upwards, both yields in the dollar and the risk assets. But what we're seeing right now is the first mover advantage is going to bonds and the dollar. I think that's a problem for stock bulls at this point, because yields going upward I actually don't think is the main big problem. Yields are going upward because we're in a good situation. Hal's right, the employment data is great. We've got some weird kinks in our economy right now where there's a lot of open jobs that people don't want to take, but generally unemployment is very low and we've made great strides. And you should, as I've said many times, if you are a patriot, you should be rooting for yields to go up. You want the American economy to go better and you want it to improve. So yields going up is a good thing. However, the dollar is a little bit more complicated, and that's why I continue to watch the dollar as I think a more important tell. We had days where the yield was ripping. I mean, the 10-year's been on the move now throughout the stock rally. So clearly there is an ability for the stock market to rally once it's processed each level we move to in yields. It's the breakout in yields and the speed that causes volatility, but then also the dollar's signaling mechanism of tightness and liquidity coming out of the market. That's what's so important about the dollar rising. At least that's my analysis, and so far it's worked pretty darn well. Because if you try and just short the stock market every day when bonds are down and yields are up, you're gonna have mixed results. But when the two are moving together, the dollar breaking out and yields going higher, that's a sign here that inflation and the Fed's fight against inflation is ultimately draining liquidity from markets. And so, which stocks get hurt the most? If we go back to the movers, some familiar names. Remember ARK? Down 5.5%. At least right now, it's pretty easy to figure out. It's pretty easy to figure out. It's not a big mystery. This is the pain trade when you have liquidity draining out of the market and the economy, and that's what the Fed wants to do. It's purposeful. And we know Jay Powell has signaled and told us pretty explicitly he's not too worried about frothy, futuristic growth stocks that were trading at higher multiples than we had ever seen in the American stock market go down. And what's particularly painful now, though, after a year of these companies declining, it looks like we still have to describe them as in these bearish downtrends due to their susceptibility to this liquidity drain that's happening. ARK-K and some of the other growth names had a nice bounce back over the last month, but we've seen a very distinct separation between that cohort of very high growth, expensive companies from a year ago versus the more robust, giant profitability machines that are Apple and Alphabet. Those stocks are looking a lot better compared to other non-profitable companies. If you look at chip makers, a crucial chart that I pointed out on Friday that had failed to get out of its downtrend. And again, chip makers did not peak with all the frothy growth stuff a year ago. Chip makers did not even peak really back in November with the cloud stuff. It took a while, but it always made sense that they would follow when the companies and businesses that they support in those cloud sectors was in a very entrenched, brutal bear market. So as chips broke down at the start of the year and then bounced in the first week of February, we failed in the most recent bounce to get above that last previous high. So that technically on Friday kept us in that downtrend. And now for the chips, they're back. I'm looking at the SMH, by the way, ETF, semiconductor ETF, at 260 right now. Is pretty much at the midpoint of the last year of trading you can see we did a lot of trading around this level. So if we continue to break down from here, then you're targeting new lows for chips. Now that does seem right now like a pretty far ways away. Perhaps this is just a one-day knee-jerk response, seeing yields shoot up. But if it continues, then I think you've got real confirmation that we're going to be in a bear market that's not going to go away and not going to be taken lightly. That's the bottom line. So you really need to watch this group, because this is the heartbeat of the global economy that is run by tech companies. It held on for as long as possible, but it's struggling here. So we haven't taken out that new low, but it does look like chips basically are on their way to do that. If that happens, then it's going to really put a pain trade in for folks who were thinking this latest bounce over the last month was going to extend back to highs. I think it's a pretty big day today. I don't want to make light of it, so not to be over dramatic, but it is a big deal. I'm also out the rest of the week, so yeah, I might be dramatizing a little bit on my last day for the week. I'll be online, though. I'll be tweeting and I'll be watching markets. All right, let's bring in Mr. Hanks back with us. So, Kev, we had an incredible month here, this rally, but it seems like we still have that Achilles heel in this market of yields and bonds when investors don't hear what they want from Fed officials. Is that fair to say, do you think, at this point, that's our hang-up?
Well, certainly today's sell-off, Oliver, was Lael Brainerd infused, right?
Yeah.
I mean, the market moved after her comments were released. And her comments, let's face it, they were about as harsh and as hawkish as she could possibly be in a relatively short speech. She talked about creating a more neutral policy via balance sheet runoff and rate hikes. She basically put out there that they could raise rates at every meeting this year. She went through several bullet points. I've got them all here. And I don't see one of them that is not in the hawkish camp. So that's the move in rates. That shook stocks. I mean, you and I spoke this morning, Oliver, before this statement came out. Bonds and yields were already jittery ahead of the release of the FOMC minutes tomorrow. I think that will continue into tomorrow. Different sectors are getting hit harder than others. I think you're seeing a little bit in the NASDAQ, a little bit of the unwind of the strength that we've had the last few days. So it's hitting that a little harder. But all things considered, the economic data today was in line, nothing scary. And I think Lael Brainerd's comments and the harshness of them really affected the overall confidence of the market today, Oliver.
All right, so the confidence is shaken here, and in some of the groups that were the most resilient within tech. Again, some of that high growth, high octane sales growth companies. It's not surprising, right? We know that at least when the yields go up, stuff like the ARK Fund, Cathie Wood stocks, we've seen it time and time again. But what's a little bit more alarming, I think, is chips, which have very real economic implications, right? A company trying out a new battery technology for the future of EVs, hey, that thing could go belly up and it doesn't affect many people's portfolios. But if chips start suffering, then that's the economy. And that's, I think, a little bit different here.
Yeah, when you break down, you know, the S&P 500 into sectors and you look at information technology, there's very few green. There's maybe 1, 2, 3 small greens. The rest is red across the board. And there's nothing green in semiconductors and semiconductor equipment. It's red across the board, Oliver. So they've hit that sector very hard today. As you would think, that is a big part of what makes up the information and technology sector of the S&P 500. But it's certainly getting hit today, Oliver.
Okay. So Applied Materials, some of these big ones with other customers, other chip makers, it's just across the whole spectrum here. NVIDIA, AMD down.
Qualcomm down 5%.
Oh, yeah, Qualcomm getting hit. Apple down 2%, also getting hit, not quite as hard, but I mean, if we are real disciples of chart here, we did fall short and get rejected from previous highs in the likes of Tesla and Apple too, which seems like an important distinction we have to be very true to when we're looking at the charts.
Well,
close but no cigar.
In many ways, right? Tesla and Apple drive this market, both in consumer discretionary and where Apple lies a big section
100%.
of, remember, 3 of the 4 indices. So if there's a failure in Apple, chances are this market is going to lean on the heavy side, Ollie.
Yeah. All right. Appreciate it, Mr. H. Good stuff. Kevin Hanks, host of Fast Market, joining us in the morning and afternoon here on our shows to give us the updates on the big swings. Chip makers down 5%. Ugly session. Let's bring in Chris Recker, joining us from AZA Capital Management, the Chief Investment Officer. Chris, so back during the COVID boom, I gave you a little bit of a hard time on a few occasions for being somewhat of a pessimist, but I will say I think I've tried to give you the credit now the last few times. I'd say the last year, we're starting to see some of your cautionary tale really add up and look truer by the day. What right now should we be most worried about? Deflation, inflation? What's the story here?
I think your intro is right on. I think inflation is the primary concern for the Fed and for the economy, and it has to be addressed. And there are, the ways that the Fed can address it are cause a recession, and and basically hit asset markets. And I think the asset markets continue to challenge the Fed's credibility by rallying into a Fed that's trying to jawbone it down. It's trying to get higher yields. It's trying to get less frothy valuations. We've seen the bond market respond to these inflation numbers. Equities have yet to respond. I'd say, tech is, these are longer duration. You've mentioned ARC. The long duration cash flows that are out there that are yet to be paid are going to get discounted at higher rates. And we're going to have to potentially go through at least a growth slowdown, if not a recession. So those are the things. And then we also have housing. Housing's up almost 20% year over year. Mortgage rates are up. So when you look at how that impacts rent across the economy and also buying new homes, that'll add a brake, but it'll also to economic activity, but it's also going to be a driver of inflation. So the Fed is got a really a big hole to dig out of here. It's got a big balance sheet that it can really use to its benefit. And so I think that's when we look at the yield curve not going up more and faster, is that it's saying this is going to be more of a balance sheet story. And if it doesn't use its balance sheet, then then we're going to have problems. And I think you're going to see inflation. Inflation will serve as an effective funds rate, Fed funds rate increase, because you're going to have high grocery bills, high gas prices, high utility bills. You're going to see it go throughout the economy. And so, what you see here is, one of the curve inversions we see out there. This rhymes a lot like the 2000 era and the end of the housing bubble. So bond markets have a very good track record of predicting economic slowdowns, and hopefully this will be not necessarily that deep, but it could slow things down and we could get back to rational pricing. And higher rates are good for retirees and investors. Lower multiples are, in a sense, are going to be good for investors. We just need a sustainable investment climate with more stable inflation. I think the Fed can get there if it has the will to do it. That's going to be the big question.
Okay, so a few things there that I want to extract that I think are particularly unique to your view. One of them very much overlaps with what I've written as well lately. I've become more convinced by Powell's language. People are not reading between the lines properly, that he is not just willing to let the market drop, but it seems like he might desire to take out the trash a little bit, because everyone now and their brother, sister, mother, aunt, and uncle know about the yield curves. And certainly Powell and Brainerd do as well. And they're ready to just rip the Band-Aid right off in the face of it. I mean, that must scream that they don't really mind if there's some volatility.
Right. And I think, if they've really done a good job with their financial market stability programs. We know we've seen problems with commodities that are more sanctions driven, but, the markets have been extremely orderly, and markets can go down a lot. And, we've seen the sell-off in bonds, a rather large sell-off, in a historical perspective, and things are functioning very, very well. We haven't seen any financial firms blow up. Spreads are remaining very, very stable. So I think you're correct. They are going to lower what the level is of what a Fed put is. I think, we've said fair value on the S&P probably has closer to a 2 handle than a 4 handle. And, that that affects prices in a couple ways. One is you have the wealth effect that the Fed has written about, that's there but somewhat small. Then two, you're going to have the effect of rates slowing down activity in the economy, and if you do get that effect on housing, again, that creates a better environment that gives you a sustainable path for growth over the longer term. And I think we have to go through that environment. We're either going to have some deflationary aspects. I don't think we need to go into a depression. We just need to have a real rationalization of pricing.
So your bear case here is more asset price and market driven than like coming collapse. Could we double dip recession at this point and it be innocuous, or are we too sensitive post COVID? I mean, what happens if the market does really chip away at household wealth? Is the stock market truly now more tied to the economy when household wealth is tied to stocks? I mean, should the Fed pay attention if we go bear market territory? At what point does Powell say, all right, fine, uncle?
Look, I have a lot more confidence in the U.S. economy to adjust to almost any type of an environment. I think it just needs to be allowed to work. If we do get into a situation where we have more deflationary forces that are driving activity below where they could be, the fiscal power is still there to step in and make investments in infrastructure, reshore manufacturing. We still have an incentive to bring back supply chains and semiconductors, or at least regionalize these where that could be some kind of a buffer. But again, the Fed needs to worry about inflation. It's very corrosive. And what you see here is
this is a great chart.
Plot, of basically S&P 500 multiples versus the PCE deflator, year over year, which is the Fed's, probably the lowest estimate you're going to get of any inflation, but the Fed's preferred measure. And right now it is a 5.4%, and it's going to go up because of just the latest price increases. And what we see here is generally equities deserve either single-digit multiples or low teens multiples. And with the NASDAQ at 35 and the S&P at 23, 24, there's room for downside. And again, anytime we've had those types of multiples, those are very healthy equity markets. It doesn't necessarily have to be too deflationary. We were just at a 13 multiple 10 years ago. So it's not like we can't operate an economy with lower multiples and higher yields in the market.
Hey, it would be more concerning, I guess, if there weren't 11 million jobs available. So I guess if there are folks who are riding the coattails of a nice big payout from the market the last couple of years, worst case scenario, there's other income available right now. Chris, so the other part of your overall concern, kind of from a big picture macro standpoint, has been China's role in this. And not to go too far off here, but I want to make sure to hit that before we let you go. It seems like China's having a lot more trouble than anybody thought getting out of COVID. I mean, has the threat of that looming kind of albatross over the U.S. potential been lessened as they are still, I mean, there's people that aren't even getting food apparently in Shanghai. The stories I'm hearing are nuts.
It's nightmarish what's happening in Shanghai, and it makes no sense to me why they're doing these severe lockdown policies. China still is a threat. China has very serious internal economic problems. Their property bubble is collapsing. The activity in the property sector is down dramatically. In some cases, activity is down 40% year over year. And I think, China has a lot of problems to deal with, and adding, putting Shanghai in lockdown is to me is really questionable. And I think, but the from a military perspective and for the United States, the Chinese are going to build a 500-ship Navy. They're still making huge investments. Russia's weak. Sanctions against Russia are actually strengthening China. China was involved with cyber attacks against the Ukraine. They're very much on board with whatever's happening there. And so they are showing a willingness to act independently of the United States and the West that should be concerning to all of us. And the United States is having a trouble getting over a 300-ship Navy. I think we have great capabilities. Don't get me wrong, we're making a lot of smart investments. But, China is still a national security threat. It's an economic threat. I hope, I see the Congress making moves to invest in semiconductor manufacturing in the United States. Those are all positive developments for this country. And I think the biggest risk is that The West has somewhat woken up to these issues, and the relative power balance is moving in the West's favor and against the Chinese and the Russians over the next decade. And then do they have an incentive to act? And I think that's the bigger risk.
All right, nice. That sounds like a little bit of a more positive spin from Chris Recker there on the potential geopolitical threat. I mean, the world seems to be getting behind Ukraine pretty quickly, and China is just is like back to square one with COVID. So, all right, hoorah USA, something positive here. Chris, thanks a lot for the analysis.
Thanks, Oliver.
As always, Christopher Recker, Chief Investment Officer at AZA Capital Management. All right, let's flip the conversation on its head a little bit. Let's talk about stuff that's going up. Some stock picks from Andrew Graham, CEO at Jackson Square Capital. Eli Lilly and Ulta Beauty are looking pretty solid right now. Andrew, welcome back to the show. There's a lot of stuff that's kind of failing near these highs, but in particular, Eli Lilly, I think, is pretty interesting. Tell us about why you own this stock and what we should expect.
Well, it's nice to have a healthcare name, on a day like today, for sure. And a good exposure to healthcare is a fine idea, I think, almost at any time. But anyway, Lilly's got the
one that's not a vaccine maker either.
No, right. Yeah, so they don't have to deal with that hangover. So it definitely has the strongest lineup out of all the major pharma companies. It has the strongest pipeline lineup as well. So there's a lot of attention on their Alzheimer's. There's a binary event coming up late this year and early 23, somewhere in there. I mean, it's going to be an important event, I would suspect. There's a lot of attention on Alzheimer's, but before that happens, this month in April, there's going to be data from trizepatide, which is a drug that they already have, but in the obesity world. And so what they're trying to do is address obesity in a similar way that Novo Nordisk did with their Wegovy, which is wildly popular, and you can't get your hands on it, and so on and so forth. So I think you could see the data that comes out this month from Lilly showing body weight loss somewhere north of 20%. If that was the case, there'd be a good amount of upside. And I think the street's modeling obesity in 2024 at maybe $5 billion, but I think that's probably about half of what it would be. It's a major market.
Man, these two areas that they are pursuing, just huge potential markets, obesity in America and then Alzheimer's as well. How related is the connection between their attempt to deal with Alzheimer's versus Biogen's? Biogen's aducanumab seems to have caused quite a stir and generally a kind of disappointment. The stock's been getting punished for like a year straight. Eli Lilly on the other side of the equation at the highs. Is this a competitive element too? I mean, where they could really show something different? I'm not the scientific expert, but if one can't do it, can the other? Should we have confidence?
Both of the drugs are really aimed at reducing plaque, and the results from earlier trials from the Lilly drug were better than those from Biogen, and so that stands out initially, and you think you might have some more interest. But we were really surprised. I think a lot of people were surprised by the FDA approval there. I think the market really wanted a drug. And then when the approval came and the pricing came out, I think there's a lot of, talk and sort of drumbeat on that, and the efficacy numbers not being, extreme or great or anything. But like I said, the market's, clamoring for an Alzheimer's treatment. They were first to market, but I think Lilly's Lilly's drug at the end of this year. Hopefully that data will be more significant, and we have hopes for that. There's also a lineup of other drugs coming too. I wanted to get back to the obesity thing. Like after this first trizepatide trial results, there'll be more coming and hopefully showing even better results. So
very exciting stuff. Hopefully for stock owners and people as a whole, all these drugs show some pretty good results. I want to get to another consumer stock, though, Andrew, real quickly, because right now there's a lot of concern that sentiment near like the lowest in a decade. Consumer sentiment has just totally fallen off a cliff. It's lowest since 2011. And you own Ulta. You like Ulta Beauty. It's one of the few consumer names that's sitting near the highs. So makeup going to be a way through this, a reopened trade maybe a little bit, people going on dates, going out, trying to look their best?
Well, for sure, yeah, and I think returning to work as well.
True, yeah.
Work is actually a big driver. Yeah, I think there's also maybe an interest in the category because in the last recession in 2008, the category was flat in 2008. It was down 2% in 2009 versus apparel down 5%, and anything to do with home, which was down high single digits during that recession. So it's interest in the category, I think. Ulta's basic, it's the market share winner from department stores closing, and there were probably 2,000 department stores closed since 2019. So that number was, I think, 8,300, and now it's estimated at 6,300. And so they're the market share winner. They're putting in new units in stores to soak up that market share. And they're also one of the first retailers to start guiding to 23 numbers, and they'll do that when they report March numbers in May. March earnings will come out early May. So yeah, more upside for Ulta. We think the stock could extend into $500 potentially, and it's our favorite name within retailing.
Great stuff, Andrew. Thanks. Nice dose of stock specificity and some details for us. For some company trades. Great stuff. Good to have you back here.
Thanks, Ollie.
You got it. Andrew Graham, CEO at Jackson Square Capital, Ulta Beauty, and Eli Lilly. A couple trades looking pretty good near the highs right now. When we get back, options time. Tom's got a crude trade in the energy space as WTI faded today, but Nat Gas had other plans. Natty's still up 5%. We're going to check out Peabody Energy, as well as FedEx and Carvana when we come back.
Many option traders tend to focus on price and direction, but implied volatility can also be a big factor in options trades. In the Options for Volatility course, we explore what implied volatility is and how it can potentially affect the price of an option. For example, let's say an option trader wants to take a bearish position on a stock, but isn't sure whether to buy a put or sell a call. Both strategies are bearish, but looking beyond direction to consider the impact of implied volatility could help the trader choose between them. We also introduce strategies designed to harness changes in implied volatility. For instance, time spreads, like counters and diagonals, are designed to benefit from increases in implied volatility. Iron condors, on the other hand, are designed to benefit from falling implied volatility. After learning about the strategies, you can take the final assessment to test your knowledge. Head to the Education tab on thinkorswim for the full Options for Volatility course and a whole lot more.
Thinkorswim by TD Ameritrade is more than a trading platform. It's an entire trading experience. With innovation that lets you customize interfaces, charts, and orders to your style of trading. Personalized education to expand your perspective, and a dedicated trade desk of expert-level support that will push you to be even better and just might change how you trade forever. Because once you experience Thinkorswim by TD Ameritrade, there's no going back.
Opportunities can be hard to find, like catching lightning in a bottle. In uncertain times, it's tempting to retreat or simply wait and see. At CME Group, we empower those who act. We deliver tools to help manage risk and capture opportunities in every market climate, across every major asset class, to seize each possibility at precisely the right moment. CME Group, opportunity is everywhere.
Stocks are still down or making new lows as we speak, but let's talk some more stock specifics and options. This time, Tom White joining us with a couple trades that he spotted. Hey, Tom, let's talk Peabody Energy. As crude faded on the day, down 2.5% now, but Natty Gas is rocking. Where does Peabody sit in that trade-off between the two commodities?
Well, coal, in the U.S. hit 13-year highs, over $100 a ton for the first time, as I mentioned, in 13 years. So you're seeing a lot of push there. The EU potentially going to push back and not take any imports of coal from Russia. Yeah, everything wants to turn into solar and eco-friendly, but
Peabody's pure coal?
Pure coal.
Pure
right
coal,
there.
okay. I thought they were nat gas too.
Yeah,
Right.
they've got a little bit of that, but most of their...
No, I could be wrong, yeah.
Yeah, and they haven't expanded production, right, due to the fact that they've got all these regulatory issues coming forward as we try to move away from fossil fuels. But you got to remember, we still rely on it heavily, and the EU pushing back against Russia where they might not take imports has BTU basically up to 3-year highs, hit above 28 earlier in the sessions, pulled back a little bit, but still up over 2%. The stocks BTU is up over 150% so far in 2022. You see right there the chart on BTU. It's been a parabolic move to the upside based on the geopolitical risks that are out there right now. And I think somebody expecting that that mantra to continue here into April expiration next week, where they're buying. Trader came in and bought 5,000 April 28 calls for an average debit of about 90 cents. That break even of 28.90 over the next 9 days, about 12% above the current share price. I did mention, though, the stock did hit 28.40 earlier in the session, so not too far off of that break-even point. Call volume is about 3 times normal daily average volume that we normally see on a trading basis over the last 5 trading sessions. So a lot of interest in upside calls. As I mentioned, that call volume is really starting to spike here as U.S. coal hits over $100 a ton for the first time 13 years. So push into these fossil fuel stocks. Nat gas, you mentioned that one, rocking to the upside also.
Okay. All right. So with the latest sanction/energy developments, there's always some kind of winner to be found, even when a broad market sell-off is happening. Peabody making highs, kind of faded a little bit, but still up on the session. All right, so someone's got a bullish trade here. Your other 2 stocks are bearish trades, though. FedEx and Carvana. And FedEx, an industrial company. Carvana, technically consumer discretionary, but an auto selling a business, obviously. So, I mean, both these trends have kind of been getting punished. But let's talk FedEx first, because that sell-off is pretty intense the last 4 days here.
Yeah, and I think a lot of the move today that we're seeing where the shares are down over 2% is based on that UPS downgrade that we got earlier in the day. And UPS has been severely outperforming FedEx over the last year or so. FedEx CEO was out yesterday in an interview stating that, their competitors UPS and DHL have done well, but FedEx is going to start to concentrate more on business to customer as opposed to business to business, which they led in. Stocks down about 18% so far this year, off about 33% from all-time highs that we saw last May. So it's been in a downtrend for sure. And as I mentioned, UPS got downgraded out of Wolf Research, cut their price target. Slower volumes could begin to weigh on pricing at some point, and then you start talking about the fuel costs that they're running into. But if consumption starts to pull back, like we've seen in a lot of stocks that rely on that last mile type of delivery service, they've seen pullbacks pretty substantially over the last month as people switch from items to actually experiences and travel. So that could be a headwind for them. And Trader came in and bought 7,000 of the April 8th weeklies that expires this Friday in just 3 days. The 200 strike puts in here. Average debit of only 20 cents. They weren't outlaying a lot of premium on these, but that break even of $199.80 to the downside, still about 5% below the current share price of FedEx. And we've seen that massive pullback over the last 10 months or so in there. So put volumes about double what we normally see in FedEx on a daily average over the last week of trading. So people piling in here to the downside or protecting maybe long stock positions by buying some cheap puts to the downside, but really short-term bearish positioning here in FedEx on that UPS downgrade.
Okay. All right, so with downside here on FedEx, downside on Carvana, and these are stocks already getting punished, so it's pretty interesting that the options volume is skewing so bearish. But look, for companies that have been in long-term downtrends like FedEx, failure to break out kind of means you go and test the lower end of the trading range. Just seems natural, right? This isn't a market that has a lot of potential to go sideways, at least in my opinion. There's just too much happening to be quiet. So if you failed to break out, then maybe you break down instead. FedEx, that would be around $200 at the lows. For Carvana, I mean, $20 down from here would be the low we put in last month. Where's the strike? What's the payout that this trader's looking for in this one?
Yeah, I mean, this stock's down over 70% from its all-time highs that we saw last year. We saw some pressure in CarMax and some of the other competitors. Vroom in here, they don't have a lot of inventory, right? I think we've seen a top off in used car sales, and maybe that's going to start to hurt margins a little bit. But they're buying puts too out in the April cycle, so about 9 days till expiration in here. The 115 strike puts, trader bought nearly 2,000 of those for an average debit of $4.50. That break even 110.50 to the downside over the next week and a half is about 7.5% below current share price. You did mention just last month this stock did hit 97.70 on a 52-week low, but put volume is about double what we normally see on a daily average in there over the last 5 sessions. So a lot of put buyers in here on this downgrade that we saw today. As I mentioned, stocks down nearly 50% on the year and down over 70% from those all-time highs in 2021.
Okay. All right, so buying some downside, not even selling upside. I mean, the bearish trades here are looking for another breakdown in some of these long-term bearish trends. Okay, thanks, Tom. Bearish on FedEx, bearish on Carvana trades, but the bullish move on Peabody, old dirty coal, is working. All right, when we come back, let's check out some more of that bond action. Really started with treasuries today. Lyle Brainerd plus, pretty good data. Nice recipe for a treasury bond bears to come roaring back into the market and breaking the 10-year yield out once again to a new multi-year high. 2.6% right now. It's the highest since summer of 2019.
Thinkorswim Trading equips you with customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim Trading from TD Ameritrade.
Oh, yeah, I gotta take off.
Now, you downloaded the TD Ameritrade mobile app?
Yeah, actually, I'm taking one last look at my dashboard before we board.
And you have Thinkorswim mobile?
So I can finish analyzing the risk on this position.
You two are all set.
Choose the app that fits your investing style.
I'm Maria Schrader. Here are a few stories to watch this hour. MoffettNathanson initiated coverage of Toast with a sell rating and $19 price target as part of a broader note on the fintech sector. The analyst thinks Toast and Affirm are two disruptors whose longer-term growth trajectories are likely to disappoint versus current expectations. He adds that Toast specifically is in a tough competitive environment. Credit Suisse initiated coverage of D.R. Horton with a neutral rating and $89 price target. The analyst thinks D.R. Horton's return on equity in 2022 will be 33% and will be 21% in 2023. He argues the company can benefit from efficient home building operations due to its scale and focus on sales absorptions. And Piper Sandler cut Dutch Bros' price target to $75 from $85 with an overweight rating. The stock is down over 7% in today's trading. The stock has generally been moving sideways over the last year and has stayed below its November high of $81.40. This has been your TD Ameritrade Network Market Update. Now back to Market on Close with Oliver Rennick.
Bond bears are back, pushing the 10-year yield to the highest since summer 2019, with a little help from the soon-to-be likely Fed Chair Lyle Brainerd. Let's bring in Scott Bauer, CEO of Prosper Trading Academy. Scott, you shorting bonds, buying dips. Seems like the 10-year yield is our focus again.
It's unbelievable, Oliver, and you can absolutely pin this today on a person, Lyle Brainerd. and also the timing of what she said today ahead of tomorrow's minutes. So we all know she is typically one of the more dovish Fed members, and for her to come out and say with almost definitive nature today what she said about inflation, that it's too high, subject to risks, that we've got to get this down ahead of tomorrow's minutes, pretty much has told the marketplace, or let the market, interpret that these minutes that we're going to see tomorrow are not going to be friendly to the bond market. In fact, if you look at the CME FedWatch tool for the May meeting going out now, there's now a 77% probability baked into the marketplace of a 50 bip hike.
Wow. Get ready, basically, is the message. They're not messing around. We heard from Chris Recker, AZA Capital, at the top of the show, that Powell will intentionally target risk assets, something that I sympathize with. It seems like they are very comfortable with bond volatility and stocks, too. And even if they weren't, after the big rally we had, even more room for them to try and test it a little bit. I mean, we rallied, we almost went back into a bull market.
Exactly. I was going to say that when talking about the timing of what she said today. Not only is it, Fed minutes tomorrow, but what better timing for them to have a little bit of a cushion safety net, if you will, based on the rally that we've seen over the last couple of weeks in the marketplace. So, to see the S&P's down 50 points today and the Dow down 300, that's not really that big of a move. If you think about where we were 4 weeks ago, 6 weeks ago, 8 weeks ago, when we were getting 2.5% intraday move, right? This is not that big of a sell-off from where we were. So I think this message today was as much about the timing as anything else.
Yeah, it really does seem like that. Just one of those moments where it doesn't look like coincidence on charts. You kind of fail at previous highs. A lot of these groups that were trying to make a comeback, the ARK Fund, cloud stocks, falling short, right where you would draw a line basically down trending. So what's the tradable event here, Scott? Do you want to project what's happening from the Fed and bonds into stocks, or do you stay in bonds, in the dollar, to try and trade macro changes by the Fed?
Wonderful question, Oliver. I honestly don't have that answer here. It's so dynamic. There are so many moving parts. And you know what? We have not seen the dollar move, lockstep with the bond market. We certainly haven't seen it move lockstep with the stock market. And there's a very big disconnect, in my opinion, from the dollar to commodities to what's going on with rates and the stock market right now. And I think it's a very difficult trade overall. I think longer term, if I were to make a longer term prediction, and I'm talking, 6 months down the road, or maybe even end of Q4, equities, in my opinion, are going to be much higher from where they are right now. Now, what's much higher? My guess is 8 to 10% higher from where they are. Yields, rates will probably be higher, than where they are right now. Obviously, that's kind of a no-brainer given what the Fed has said. But I think that the market overall on the equity side has really digested the inflationary, kind of macro environment that we are in right now. I really have. I really do think that the equity market has done a real good job digesting it.
So this is a digestion period that leaves us kind of stuck in the middle, right? We didn't get the bull 20% off the bottom. We barely got it off the high, 20% for the NASDAQ and the Russell, but we didn't get it for S&Ps. So at this point, Scott, what's the next move? Do you think there's potential surprise in tomorrow's minutes, or do Brainerd just get this out of the way? I mean, if we sell off again tomorrow, then I guess if it's based on Fed minutes, there'd have to be something really juicy in there.
Absolutely. I think the surprise tomorrow at this point would be to say that they're still watching employment, which I think that is kind of a foregone conclusion right now. That a little bit of relief tomorrow. I think that maybe was today with Brainerd's comments, and maybe when the news comes out tomorrow, maybe it's going to be one of those, good old-fashioned buy the rumor, sell the news. In this case, sell the rumor, buy the news tomorrow event.
Okay, if it doesn't happen, does that mean we're going to retest those lows? What happens if we don't get the follow through from bulls here before the end of the week, Scott? Does that mean we go test the other side of the range?
I don't think we do, Oliver. I think there's still some downside to go here. I don't think that we test those lows again. Okay. Listen, the Nasdaq is now 12% or so off of its all-time highs after coming out of bear territory. Made a remarkable comeback. I don't think that we go down another 8% or so to get to that bear market territory again. I really don't.
All right, great stuff. Thanks for the thoughts here, Scott. We'll follow up as always. Mr. Bauer, CEO of Prosper Trading Academy, joining us. And when we come back, let's talk some more stock picks. From macro to micro, macro to micro. But one other quick headline update, by the way. Little M&A action in airlines. JetBlue making a bid for Spirit. And investors don't like the report from the New York Times here, a $3.5 billion bid for Spirit, which had been in talks with Frontier. But wow, check out Spirit go. Got to get that discounted airliner at a time when tickets are going ballistic. Spirit's looking pretty good, even though the seats might be a little bit rocky. They're the cheapest out there, and getting to your destination's what's important. JetBlue shares are down, though.
Watchlist can help you keep track of securities you're interested in. To add a watch list to the left sidebar, select the plus sign, then watch list. When the default list appears, select the name box, then create watch list. Enter a watch list name. To begin adding securities, enter a ticker symbol in the symbol box, then select enter. Continue adding all the symbols you want in your watch list, then select save. The existing list is replaced by the new one. You can also create watch lists from the Market Watch tab. After creating a watch list, you can add symbols to it from different locations across the platform. From the Charts tab, select the list icon and then add to watch list. From the Scan tab, right-click a security and then add to watch list. And that's how you make a watch list. For more demos on how to think or swim, head to the Education Center on tdameritrade.com.
Trading isn't just a hobby, it's your future. So you don't lose sight of the big picture, even when you're focused on what's happening right now. And Thinkorswim is right there with you to help you become a smarter investor. With an innovative trading platform full of customizable tools, dedicated trade desk pros, and a passionate trader community sharing strategies right on the platform. Because we take trading as seriously as you do. Thinkorswim by TD Ameritrade.
Trading has changed forever as a new generation of investors make their impact on markets.
It's more important than ever to navigate through the frenzy of meme stocks, IPOs, and the next wave of tech.
And that's where we come in, discussing strategies and example trades on trending names.
Take control of your financial future. Next Gen Investing, weekdays at 1 p.m. Eastern, only on the TD Ameritrade Network.
Okay, time for another dose of stock picks as we need a little upper before the bell here. NASDAQ trying to stabilize near the lows of the day, down almost 2.5% right now. Burns McKinney is back with us, Managing Director and Portfolio Manager at NFJ Investment Group. Hey, Burns, give us some positive outlook here on some companies that you like as we close up a pretty brutal day for bulls failing to really break out here in the stock market. One of the ones that stands out to me is D.R. Horton on your list. Home builders have gotten a little beat down too. Is that going to change?
We think that for long-term investors, there's definitely an opportunity there. I mean, this is, as a value investor, you like to make contrarian plays, and in an environment in which long-term mortgage rates have been really spiking over the last year, that's as contrarian as it gets. As you've seen, the 30-year mortgage rates go from 3% last year to over 4.5%. That's really caused the home builders to get hammered. And as a result, investors have valuation on their sides. Right now, a name like D.R. Horton you can get for 5 times earnings. It's historically averaged about 12 times earnings. So you have a steep discount to itself, a steep discount to the S&P, You have a name that they demonstrated confidence last year in hiking the dividend by 12%. And you've got secular trends that do actually favor the home builders include the fact that really ever since 2008, you've seen far fewer homes built than you've seen household formations. And so, they really worked off supplies and inventories to historically low levels. And on a company specific level, in the case of D.R. Horton, I mean, they've been gaining market share over the last 2 decades. They've gone from 2% to 10% of the market, making them the largest builder, which, in a world in which you have supply chain bottlenecks, that scale really gives you an advantage. So they've got that. They're located in great areas, places like the South, like Texas, like the West, where you have people moving. And really, I think another key is that they specialize in entry-level homes, which really positions them. There might be some near-term challenges, but for, again, investors looking out 2, 3, 5 years, really positions them well for a lot of the millennials who are just getting into household formations.
D.R. Horton went from 60 to 110 during COVID. We've been having a conversation today about language from different Fed officials. Today, Brainerd, but Powell has hinted before pretty clearly he's okay with market volatility. Is there a possibility, Burns, that the Fed would be willing to depress housing prices as part of their program, asset prices? Are houses going to be susceptible if they really want to try and cut off the potential for inflation and speculation in markets?
Yeah, really all risk assets are somewhat susceptible. I think the Fed, in many ways, by getting behind the curve, has kind of, painted themselves into a corner whereby, a way of thinking of it, if you're driving down the highway and you have an exit to take going up, but you want to get past one more car to do it. And so the problem is you have to accelerate and speed and then quickly slow down. And you have to slow down much more quickly than you would like to otherwise. And they've kind of put themselves in the position that because they've let inflation accelerate to a level that's, that really is causing overall economic risk to the economy, that they're going to have to sort of tap the brakes and slow things down much more rapidly than they historically would. Typically, it's that the Fed doesn't have a great historical track record for creating soft landings, and that gets exacerbated when you have a world in which you have energy price shocks